see a pullback from those kind of levels. The longer-term targets, of course, are still much on the higher side. But yes, with 90 and 92 of a RSI, this is absolutely overbought. But not just gold. Take a look at silver prices, and we are up by nearly 68% for silver at this point in time. 7 straight weekly gains, and the markets are looking at almost 49.5, which was an all-time high that we have seen silver hit a couple of times. And a quick one on platinum as well, because we're looking at higher highs onto that one. And 82% of gains is what platinum is trading with right now for 2025.
Manisha, thank you for that update from the commodity space. And with that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a fresh new week. And it's not a bad-looking screen if you look at world markets. And it looks like global bulls are everywhere. Stocks, currencies, commodities, even Bitcoin for that matter. Will some of that rub off here in India is the question, which we will start talking about here in just a bit. This is Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Surbhi and Nigel. Guys, good morning.
Hi, morning folks. So back after the weekend, and hopefully the Bulls will want to, retain control, keep building on some of that ground. But you know what? It's women on top in global markets today because the new Japanese Prime Minister, first time ever, I think the country's gotten a woman leader, and Miss Takaichi. I mean, her presence is leading to a 4% rally in Japan. So that's a big global headline.
Well, that's right. And the Indian markets at least found their form towards the end of the week. So let's hope we continue with that sort of form.
Absolutely. And actually, it's pretty good-looking screen overall with markets, financial markets and all kinds of markets doing very well. As I said, I mean, I was looking at Bitcoin over the weekend, look at gold this morning. You, of course, look at, the unloved, under-owned equities in Europe. Forget about US, which has been doing well anyway. So it's really, it's a global bull market. Even actually for emerging markets as a pack, I'm not talking about the Asia ex-Japan pack, which we normally sort of associate and sort of put India into. But if you look at the broader EM basket, this has actually been one of the great runs going back the last 15, 20 years or so. So that's where we're at. Now, no signs of course, U.S. shutdown relief. That was the big story from last week carrying into this week and out of the U.S. So no jobs report as well. And that was supposed to be the big data point as we sort of started this week for global markets, etc. And that's had an outsized impact one way or the other, but no data because the U.S. government's shut down. So Friday, in terms of equities, it was directionless. S&P was up a little bit. NASDAQ was down a little bit. You had ISM services data. So there is a bit of mixed commentary here. The headline number is above 50, which means it's still in expansionary territory. But the business activity printed the lowest since 2020. Anyway, I mean, I think if you look at yields, dollar, etc., not very much by way of a move. Now, the market in Japan, the Nikkei, which anyway has been rallying hard and strong, another 4% higher. So Madam Takaichi is set to be Japan's first female Prime Minister. And she, I mean, her policies, and if you read about her, what she said in speeches, etc., is not very drastically different from other candidates, but maybe at the margin a little bit. She's okay with the bond issuance, the unending bond issuance program in Japan. Little more than others, maybe a little more expansionary in terms of government spending, etc. And things that, it's too early to hike rates, interest rates. So I think those are reasons, primary reasons why you've got the Japanese stock market, which is rallying up a little bit more. Now, OPEC is adding more oil into the market, more supply into the market. So there are already concerns of a global glut. Remember, oil prices, even on Friday, Friday on Friday, over the last 1 week, basically, are down some 10%. So, prices have already reacted coming into this event. And I think, if anything, we got a bit of a move on the other side. China, nothing out of there. China, the Golden Week holidays, the onshore market reopens on the 9th of October. Now, to tie in, a bit about India here, and, those trade talks and, Indian delegation, US delegation meeting, trying to work out things, etc. It's quieted down, hasn't it? Especially over the last fortnight or so. But there's this Kautilya conference in Delhi at which the External Affairs Minister of India, S. Jaishankar, spoke. And he basically said that, he basically confirmed in a way that we've not arrived at a landing ground for our trade discussions. So not trade discussions themselves, but basically at a place where both parties can sit face to face and start to talk about how to resolve this. So that common ground has yet to be found. I said it has to be an understanding where our bottom lines and red lines are to be respected. And there's more from that speech, which we'll put out later on. But I thought this was the operative and the critical part in that sense. So no real movement, I think, is the takeaway at this stage as far as the India-US bid is concerned. And that perhaps, as you've heard from many who've appeared on this program, on this channel over the last 1 month or so, is a big deal in terms of sentiment towards India, even if it's not really hurting at least the organized, the listed universe in a more meaningful, direct earnings-related way. I'll just tie in the levels. So the market, of course, has had a decent move last 2 days. Of course, especially after the Reserve Bank of India's measures for the banking space. So we closed around the 40-day exponential moving average. So we moved away from the hourlies to the dailies. The resistance now is the 50 and the 61.8% retracement of the prior falls for the market. So 25,018 is the 50% retracement. 25,120 is the 61.8% retracement. The support here, 24,587, it's the recent low, and that will be the same for the Nifty Bank as well. The Bank Nifty has continued its momentum. It's actually, if anything, done a little better, especially even prior to the RBI moves and after the RBI moves as well. And here the resistance now at about 56,528. Gift Nifty will give you a quick sense of how we're likely to start. We'll pick it up from there. I mean, banks and financials should be in focus. Plethora, it's a long list of pre-quarterly updates. Is a kickoff of the earnings season as well, which we are going to focus on. 50 points lower on the Gift Nifty. How's the F&O positioning looking like? Nigel's walked across to the wall. Nigel, over to you.
Well, a quick word on the cash market flows first. The FIs, they continue to remain sellers. However, the selling has come down to around 1,500 to around 2,000 crores. And though we have seen a bit of a bounce in the last few trading sessions, no big signs of them covering their shorts as yet at least, because they added close to 13,000 short contracts and the short positioning is at around 93%. And we keep talking about the FI net short positions, how it's gradually moving towards that 2 lakh contracts. For the time being, the net shorts are at around 1.9 lakh contracts. However, the client positioning, they have been building onto longs. And the long positioning now is at the highest level we have seen all the way since March 2025. So the clients and the FIs, they're in opposite ends of the spectrum. Sometimes that's not such a bad thing, because when you have shorts in the system, that's what could cause them to get squeezed out a little bit. But on the on the option side, they've continued writing some puts. And for the second straight day, the number of puts that are written are double the number of calls that were written. So that's heartening. Maybe in the near term, they as well are not factoring in the Nifty to go below that 24,300, 24,500 odd levels. Moving to the options data, then it appears there's a bit of a strategy that's playing out. Tomorrow, you'll have both these two strikes that will expire, because you have the Nifty weekly expiry now on a Tuesday. 24,900 call as well as put. Fair bit of open interest built up. You combine the premium between them, it's close to around 150 rupees, which gives you a broad sense in terms of the band. There could be possibly a short straddle that works out here. So 150 minus 24,900, 150 added to 24,900. And that's the broad range you're looking at. 24,750 to 25,050, important mark that we're looking at. But, you're looking at a couple of technical levels in the near term, both on the Nifty as well as on the Nifty Bank. So on the Nifty, the first line in the sand is around the 25,000 mark, which is the 20 DMA. And on the Nifty Bank, the 100 DMA comes into play. Keep in mind, the Nifty Bank went through 6 straight sessions of losing, and now we're on a 4-session winning streak. So the Nifty Bank has been leading the way, and a couple of big banking names, HDFC Bank and Kotak Mahindra Bank, the operational update is quite good. So we'll have to see whether or not the Nifty Bank can drive home the advantage. That's going to be important to track today. 2 stocks I'm looking at. Well, the government has gone ahead and they have revised the CGHS rate revision. That's the first revision we've seen in 15 years. A lot of stocks will be in focus, but Yatharth, since they get a bulk of their revenues which have exposure to the scheme, that's why, in fact, I'll keep an eye out on Yatharth. That could possibly be the stock of the day. I think we should get that one up for you on the screen. All of them have some exposure, but Yatharth could be the one. And we'll also look at AB Lifestyle. Remember, the stock has been under some pressure post its listing. There's a large trade. Once that gets cleared out, maybe you keep an eye out on that one as well. So both these 2 stocks will be on the radar for today.
Okay, all right. So those are the stocks to watch. In Asia, of course, many of the markets are shut for regional holidays. The one that just takes your breath away is Japan. And imagine that. I mean, from the April lows, the Japanese market has rallied 55-56% already, making it among the best performers around the world. And that's only continuing. today. Let's just bring up the implied open. So the suggestion is that it'll be 50 points, lower once again. That's been the problem with our market, that it's one step forward, one back, or maybe two back at times, or two forward and one back. And that is a pattern that has not broken. Will it this week? Well, we'll find out as we keep going through the cues. Matt Orton, Chief Market Strategist at Raymond James, is with us. Matt, good morning. Great to have you in. So, when we talk about foreign money and competition for India, it's been South Korea, it's been China, it's been Taiwan, and clearly Japan's not going out of the window. I mean, I was just looking at the past gains when the tariffs were announced in April. I mean, they were among the first countries to get that deal done, and the market's just been skyrocketing. So do you see these patterns changing in the near future at all? We know you like the Indian market, but the money's still been going out, foreign money.
Hey, good morning, Surabhi. And yeah, you're right. It's been a really strong market for a lot of the emerging markets. International developed markets, including Japan, just continue to push higher. And I'm optimistic about it. I have exposure to Japan. I've luckily recently increased my overweight prior to a lot of this news coming out with the LDP. But I think the bigger picture is really, really important here. It's that a lot of these markets are pushing higher because either they have exposure to the artificial intelligence theme. That's really been the critical driver of South Korea, of Taiwan, of China, even is the enthusiasm around artificial intelligence. Japan, on the other hand, has some of the best corporate earnings revisions across all markets in the world, coupled with stronger share buybacks, plus optimism around trade, and now hopefully a lot more fiscal spending that can support the market. So there's reasons that investors have been going there. I think India has fallen short just because of lackluster earnings coupled with higher valuations. But the Indian market's been pretty bifurcated. There's been a lot of very strong winners across the Indian markets for investors who do their homework, and it's been decorrelated from a lot of the rest of the world. So I like India as a risk management tool across my emerging market exposure. And for those investors who are willing to invest in high quality businesses that continue to compound earnings, India's been pretty good. And I think if earnings season's positive coming up, I think you start to see a change with respect to foreign investor flows.
Matt, morning. With regards to what you said, right, the AI theme and money going into this AI thing globally, just a quick word, this latest, if anything, and it's quite remarkable, if you look at the investment commitments which were made for the next 4 years by OpenAI, right? And you kind of sort of try and look through where all this money, who's, it's what, $500 billion or something, right? So almost all of it is essentially going to a large US, Japanese, Korean, Samsung, for example, etc., right? It's a very large sum of money, and this is over the next 4 years. So, sitting here, you kind of sort of feel a little, it's a little underwhelming in that sense, right? You got this huge capex super cycle build out in terms of AI, which is happening, and it's accelerating, if anything, this OpenAI order. So what's your sense? How do you think about it?
So when I look at artificial intelligence CapEx, Prashant, I think it's definitely the lion's share has been going to U.S. companies or the semiconductor exposed companies in Korea, Taiwan, like you mentioned. But there's going to be bottlenecks that start to come up. As I look forward to realizing a lot of the gains that are going to be associated with AI, a huge amount of those dollars are going into data center development. That's why electronic equipment companies have done so well in the US. That's why data center construction companies, connectivity, all of that chain has created a very virtuous cycle. But there's not enough power that exists in the US. There's going to be regulatory problems that come up. So where I've increasingly been focused is where else can data centers be constructed that might not have such a big demand or imprint on power. That's why I think looking to Europe could be interesting as you see fiscal efforts start to come to fruition in countries like Germany. Maybe you're going to start to see a pickup with respect to AI data center demand, and you have a lot of the companies producing components located over in Europe. I think the same thing could potentially play out in a country like India, that geopolitically is still very strategically important for the U.S., still friendly to the U.S., and also has exposure to power, the ability to construct more power with less regulation. So I think that's something that's underappreciated by investors. And there's also companies in India that are starting to better integrate AI in the software layer that I think ultimately is going to be the long-term investment theme of artificial intelligence, that could provide a lot of enthusiasm, say, over the next 3 to 5+ years. So it's all about picking your spots and how you want to be positioned and how long-term you think about this sort of trade.
All right. Hi, Matt. Good to see you. And as always, give us, a couple of stocks then. How have you rejigged your portfolio in the past? I think you were positive on the likes of Interglobe. Mahindra & Mahindra is a stock as well that you have liked. I think ICICI Bank, you've taken some money off the table. So tell us, what has been the recent rejig that you've done with regard to the India-based portfolio?
Absolutely. So I've actually started to add back a little exposure to ICICI heading into earnings season. I think the potential for retail loan growth might be a little bit underappreciated by the market. And the stock looks pretty cheap to me. So I like it. It's a solid execution management team. Building on this idea of artificial intelligence, there's names like Paytm that I'm looking at adding potentially some more exposure to my position if we see a little bit more weakness, because again, they're powered by integrating AI into their ability to convert active users and build a better integrated payment system. And a name that I've recently added into the portfolio is Apple3i. And this is another name. It's an ad tech company that's positioned around consumer engagement, but a huge portion of the revenue growth is levered to artificial intelligence and using tools.
Matt missed the stock. Which one are you talking about?
Apple3i.
Apple. Okay, got it. Yeah, please go ahead.
Yeah, so I like their integration of artificial intelligence into what they're doing. And given that they're an ad tech-led company, they do have an incredibly strong tech stack platform that I think is far and better than what a lot of other competitors offer. So I think it's not loved by the analyst community because it's expensive, but revenue growth has been there. Margins have been very, very strong. And I think that's another name that can surprise to the upside, that's levered to these longer-term growth themes that we've been talking about.
All right, Matt, thanks very much for joining us. You'll find those themes, those AI, the tail, and many of these themes actually, and some are up front as well. Looking at something like a GE Vernova. I mean, stock's done phenomenally well. It's up 10x in the last 3-4 years, but trades at some 100 times earnings. And but it's a play on the infra build out for AI data centers, etc. And they are a supplier to OpenAI globally, and of course, I mean, it's showed up here as well. Thanks very much for joining us, and good talking to you. We'll take a quick commercial break. Let me just tell you what the interactions are that are lined up here over the next 2 hours. So now 8:35, Nitin Agarwal of Motilal Oswal Financial Services talks about the banking updates, and there are many of them. 9 o'clock, we'll have Manik Taneja of Access Capital. He'll discuss his expectation in the IT sector ahead of the second quarter earnings. 9:20, Sanjay Mookim of JP Morgan talks markets with us. 9:35, Tata Capital IPO, big one, opens today. Ashok Chandra of PNB will be speaking with us at 9:45 to talk about their business update. And towards the end of the program, it's our special segment, Indianomics, Radha in conversation with former RBI Deputy Governors. HR Khan and SS Mundra. We also have Suresh Ganpati, analyst at Macquarie Capital, on the new banking dispensation post 1st of October policy.
Time to slip into a quick break. Got a lot of stock-specific action track for you in our top 10 segment. For the time being, I'll give you a sneak peek. HDFC Bank, Kotak Mahindra Bank, Marico, Nykaa, Bajaj Finance, all of them will be reacting to positive news flow. Add to the list, Fortis Health. On the flip side, Aditya Birla Lifestyle, IndusInd Bank, Avenue Supermarts, and Vedanta is a stock that we'll be tracking. Take that break, come back, we get into further detail on all of these names.
Okay, so the cues across Asia are a little thin because some of the regional markets are shut. The one that is, up and about is charging ahead, and that's Japan, 4.5% higher. But that's not really rubbing off on the sentiment here for obvious reasons, because the suggestion right now is that it could be once again a slightly truncated or muted start after the good pickup on Friday. So let's talk about stocks because the market has been very, very stock specific all these last couple of weeks. So what is today's list looking like? Well, our team is standing by with a list of top 10 stocks that you need to watch out for. Guys, good morning to all of you. I think we're going to start it off with Gaurav first up because he's been very busy over the weekend looking at all of these NBFC and bank second quarter updates that have come through. Which ones stand out for you, Gaurav?
Well, let's talk about HDFC Bank. Now it seems that the pace is finally picking up because the loan book growth has been at around 9.9%. Remember, that reflects 4.4% growth on a sequential basis. When it comes to deposit, that increased almost by 12%, but on a sequential basis, there was a slowdown. And as a result, the LDR ratio, that came to around 98%. Remember, bank wants to take it at 85 to 90% level. Another bank is Kotak Mahindra Bank. Again, this bank stood out well in terms of quarterly updates. Loan book growth was at around 15.8% on a year-on-year basis, and deposit growth, that also remains strong at around 14.6%. But at the same point, let's not forget that in the last quarter also, bank came up with good set of numbers, but it was driven by the corporate banking, and at the same time, credit costs also increased during the results. So we'll be watching out on that point. Lastly, let's talk about IndusInd Bank. Well, here we saw weak set of numbers, loan book that declined almost by 8% and deposits that declined almost by 5.5% on a year-on-year basis. Remember, this is the second quarter where the bank is actually reporting decline in loan book as well as deposits. So definitely a bit of a negative news for IndusInd Bank. So on the back of that, we will be watching out on this bank as well today.
Okay, so there are banks and there are NBFCs as well which reported, and we will talk about Bajaj Finance. Remember, created a big flutter when they reported the last quarterly numbers and that commentary after earnings on the earnings call. But what are the numbers, the pre-quarter numbers looking like, Gaurav?
Well, when it comes to Bajaj Finance, they actually reported good set of numbers. When we look at AUM growth, that is around 23.6%, and that also reflects around 4.7% sequential growth. Now, remember, this stock is again in focus because of all the GST reforms. Every brokerage is actually being a bit bullish on Bajaj Finance because of the GST reforms. And on the back of that, Q2 numbers at least seems fair. Remember, management had also guided that 23 to 24% AUM growth is what they were looking for in FY26. So definitely in line with their guidance as well. Specifically, when it comes to customer base, now that has increased almost by 20% on a year-on-year basis, and they also added around 12.2 million new customers, which is addition of around 26% on a year-on-year basis. So definitely good set of numbers for Bajaj Finance. In fact, Bajaj Housing Finance, they also reported good set of numbers. Disbursements were strong. AUM growth again was in line with what the management had guided. So definitely Bajaj Group and specifically Bajaj Finance doing well in second quarter so far.
Okay, all right, Gaurav. Busy weekend, prepping for the big day as well. Thanks a lot for joining in and giving us all of those details. Moving to the metals pack, Vedanta as well as Hindustan Zinc came out with their operational update and it looked a little bit subdued. So the stock could open up in the red. However, there will be some buying interest going by the kind of melt up that we have seen in metal prices. Hindustan Zinc first up. Out there you have the saleable metal production that's down by close to 6%, and bulk of that will be refined zinc. That production is mildly up by close to 2%. However, refined lead production, that's contracted big time by more than 25 to around 30% or thereabouts. And because of the contraction we're seeing in lead, silver production continues to lag, and that's a bit of a dampener. However, silver prices have moved up, so they'll continue to remain interest in Hindustan Zinc. But the better way to play the entire theme is normally with Vedanta, which holds more than 60% stake in Hindustan Zinc. Out there, the alumina, that's the Lanchigar refinery, has gone through an expansion. So the numbers up by close to 30%. Aluminum production is up mildly by close to 100%. And the international zinc business on a low base, that in fact popped up by close to 38%. So that's looking pretty okay. The problem is oil and gas. Out there, it continues to contract down close to around 15% on a year-on-year basis. While power in million units, well, that's on a seasonally weak quarter, so that as well was mildly lower. So give and take anything, it's a little bit of a subdued operational performance that's coming in there. So maybe some red on Vedanta, but don't rule out some kind of buying at lower levels. But the big stock of the day could possibly be Fortis Healthcare. Ekta joins us to fill us in with more details. Ekta?
Well, yes, it's after a delay of 7 years that IHH has received the SEBI nod to go ahead with the open offer for Fortis Healthcare and Fortis Malhar Hospitals. Now, to just give you a recap, IHH had bought 31.1% stake in Fortis for 4,000 crores in 2018. IHH's 26% open offer was set to open on December 18, 2018 and close on Jan 1st, 2019 for around 3,300 crores. However, it was stalled by the Supreme Court litigation. So in September 2022, IHH said that Supreme Court basically paved the way for the open offer subject to SEBI approval. And now SEBI has given that approval for the open offer. Fortis is waiting for full information and should have clarity in a few days. I did speak to some sources in Fortis and this is what they had to say. But the interesting part and the conundrum that they are going to face is that the offer price in 2018 for the open offer was 170 odd rupees. The current market price is 980 rupees. The stock is up 4.7 times since 2018. So it'll be interesting to see what the updates are going forward.
If I were IHH, I'd be feeling a little concerned with that stock price appreciation and the regulatory need to launch an open offer now at current market prices. But we'll see how this goes.
Yeah, absolutely. Well, AB Lifestyle Brands is the next one we're going to focus on. Vivek has got details here. Vivek, over to you.
Well, that's right. So AB Lifestyle Brands, watch out for this particular name. A large block deal is expected today. Flipkart Investments, that holds close to 6% of the total equity, is expected to completely exit its stake in this particular company. The offer price range for this particular block is at in the range of 130 to 136.5 rupees per share. And total of 6% of equity is expected to change hands. But remember, this is a clean-out trade. After this particular deal, Flipkart will no longer hold the stake as far as AB Lifestyle is concerned. Now, the total deal size is a little over 950 crore, a little over $110 million. So it's a large block deal. Expect some red at the opening, but may recover given the fact that the overhang of the Flipkart stake sale would be behind this particular stock.
Okay. All right, Vivek, thanks a lot for joining in and giving us that important information. That could be another stock that we'll be tracking today. Mangalam joins us to help us out with a whole host of business updates that have come in there. Mangalam, run us through the list.
Well, a lot of numbers that came in terms of pre-quarter updates. We start with DMart. What we look at is their standalone revenue grew about 15.5%. Not particularly bad because the last 3 years CAGR has been around 15.8% itself. So it's been largely in line with that. The good part is they've added 8 stores in the second quarter. First half of this year, they've added around 17 stores. Importantly, year-on-year store addition has been 14.5%, which implies a low single-digit same-store sales growth. The most important thing to watch for in DMart will be how the revenue pans out post GST rate cuts, because optically the revenues will reduce because prices of things have reduced as well. So that's something that the street will monitor in the second half of this year. Going with mild red on DMart. Marico, mild green out here because the consolidated revenues, that has grown at 30% plus. That's a big positive. But remember, it's because of pricing. Underlying volume growth in India has been high single digits, but there has been some moderation quarter on quarter due to high inflation in copra, and which is why the company expects modest operating profit growth on a year-on-year basis. So despite a 30% revenue growth, going with just mild green. And finally, bright green would be on Nykaa. Why is that? Because gross merchandise value expected to grow near 30s versus mid-20s in the last few quarters, and it's been led by fashion business. Beauty vertical has been doing extremely well, a revenue growth of mid-20s, so that's a positive. But fashion, which had been lagging for the last many quarters, has now come back, and they expect the growth to improve to low 20s from mid-teens out there. So a bright shade of green on Nykaa, mild green on Marico, and mild red on DMart.
Okay, all right, Mangalam got it. So we'll keep all of these consumer stocks on our radar as well. Let's quickly actually recap the list of stocks to track today. The ones that have positive news flow around them are on your screens. It includes HDFC Bank, Kotak Mahindra Bank, Marico, Nykaa, Bajaj Finance, Fortis Healthcare. The ones that have some negative news developments around them or earnings picture around them would be Aditya Birla Lifestyle, IndusInd Bank, Avenue Supermarts, and Vedanta. So mixed set of cues coming in terms of our stock list today. Let's now head across to Manisha to take stock of what's happening with the commodity markets, because we know that oil was making all the headlines last week. I think it fell 8%. And then there was this OPEC Plus meeting in focus over the weekend. Manisha, good morning. What's the latest?
Thank you for that. Well, almost everything in commodities seems to be doing quite well right now. After that decline that we saw in the crude oil prices in the previous week, and after that OPEC Plus meeting, which now tells us that the OPEC Plus increase in production for the month of November is much lower at 137,000 barrels per day, as much as it was in the month of October. You've seen some gains come back into the prices. So a percentage point and more is how Asia is trading. all-time highs, continuing in case of gold prices. We've now not just broken above 3,900, but we've taken $39.25 an ounce at this point in time. With that, it's 50% up for gold. The prolonged U.S. government shutdown seems to be impacting buying in many of these tangible commodities. So you have silver yet again trading at around $48 an ounce. The Indian markets, as it opened, will be an all-time high for gold and silver both. Copper seems to be trading on a firmer note as well. We're looking at a 2-month highs onto this one. Bitcoin is trading at an all-time highs in the Asian markets as well. So as I said, many of these safe havens, alternates, tangible commodities seem to be doing quite well in the Asian markets right now.
Okay, all right, got it, Manisha. Thank you very much for a quick roundup. With that, let's quickly, head to Sudarshan. He's been watching out for a couple of the interesting brokerage notes this morning. Good morning, Sud. So what's catching your attention today?
Good morning, Surabhi. So we'll start with JSW Cement, where there is an initiation. Jefferies has initiated with a buy call, and here target is rupees 170 per share. It's saying that despite the late entry in the sector, company has become among top 10 players, and now it has seen 13 to 17% capacity volume CAGR over FY15 to FY25, and it's diversifying from a regional focus to pan-India presence, and it's positioned for a profitable scale-up, and it estimates EBITDA CAGR of 35% over FY25-28. Next is PVR Inox. Investec maintains hold call and target is raised to 1,215 from 1,147 per share. It says FY26 is shaping up to be a strong year at the box office, and with this Q2 earnings are also expected to be strong, with revenue growth seen at 15.4%, and with this visibility to achieve FY26 revenue growth is now higher. But Investec continues to hold its thesis of content volatility risk in the long term that company might face. Next is Avenue Supermart. Most of the brokerages have come out with their notes post Q2 updates. First one is Goldman Sachs. It maintains sell call and target has reduced to 33,370 from 3,450 per share. It says growth is weaker than expected, with 15.4% growth that company has reported for Q2. Also, there is no meaningful acceleration in store growth, and because of these two, it has cut FY26 sales growth expectations to 18% from 20%. Also, it has reduced EPS estimate for FY26-28 by 2%. JP Morgan maintains neutral call and targets for 4,350, but it says Q2 revenue growth of 15% to weigh on near-term stock performance, and MS maintains equal weight call and targets 4,552 per share. It estimates implied same-store sales growth in the range of 3 to 4% for Q2 that company will be reporting very soon.
Okay, all right. So thank you very much. More later, but that's a flavor of the kind of brokerage calls that are coming in this morning. We'll take a quick commercial break here. We'll come back. There's 25 minutes to go for market pre-open. Dharmesh Kant of Chola Securities. We'll talk some stocks with him coming up on the other side.
Welcome back and hope you're having a good morning. Well, while speaking at the Kautilya conference yesterday, External Affairs Minister Mr. Jaishankar spoke on the need for an understanding between India and the United States, where bottom lines and red lines are respected. Let's listen in.
Whatever happens, at the end of the day, there has got to be a trade understanding with the United States. There has to be one because it is the world's largest market, but also because it is, much of the world has reached those understandings. But it has to be an understanding where our bottom lines, our red lines are respected. In any agreement, there are things you can negotiate and there are things you can't. And I think we are pretty clear about that. And we have to find that landing ground. And that's been the conversation really which has been going on since March.
Okay, all right. Well, let's get in. Dharmesh Khan, the head research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning and good to see you in. Well, there's been a hike that's come in for various hospitals, and the effective rates could go up drastically. I was looking at a DAM Capital note, and they are mentioning that that could be a big kicker for earnings in FY27. What's your view on this hospital change? For Fortis, we have their additional news that the green signal has come for the open offer. But at what price is going to be crucial? Because it's come after 7 years. Your view on the space?
Yeah, very good morning to you, Nigel, and everybody in the studio, and to all the viewers. Thanks for having me on the show. The news flow is positive. If it gets implemented, definitely there would be incremental EPS accretive with most of the hospital chain out there. And there will be some burden, getting off the public sector hospitals, which are already overburdened with the demand out there. So I think it's a move in the right direction and a welcome note. To our mind, I think Narayana Hrudayalaya remains the best beneficiary if it comes through in totality. The reason being their pricing has always been on the lower end of the curve compared to other private hospital chains. So, patients will find it more easier and still more price competitive as far as Narayana Hrudayalaya is concerned. And it is focused in Eastern India and certain parts of, Bangalore. Where Eastern India still caters to the majority of the patients who are very, very price sensitive kind of a patient. So to my mind, valuation wise is comfortable. It's still trading at 45, 46 time on a P multiple on a trading basis. 1 year forward is 37, 38. And ROEs are the best in the industry. It has a ROE of 24, 25. So still a lot of scope and catch up can happen out there. Others are also well. They all are taking capacity expansions, but the valuations are far higher, 60, 70 kind of a P multiple. As far as Fortis is concerned, IHS has already turned around the company. 2018, they were reporting losses from there to 800 crores of profit. And with margins rising from 6% to 20%, they have demonstrated their, efficiency. And going forward, I think with this clarity coming in, more focus on aggressive capacity expansion can take place. But the catch in the point is at what price the open offer is now going to materialize, and there's a significant differential. So we all are excited to know that how this pans out. Stock prices moved up quite a bit, but I think this is more a positive news flow on the space. So entire space is we are bullish on, but we like Narayana as the best topic out there.
Yeah, I guess on Fortis, that open offer has to happen because, well, it's regulation. The question is now, how do they come to a pricing, if it's an average or what formula or how they come about it? We'll see. Interesting, as you said, Dharmesh morning. I want to talk about the lenders and the biggest of the blue chip names to figure out now how you would read it. So Kotak's growth rate in this quarter is 15%. I'm just talking basic, book growth of the book year on year. HDFC Bank is not bad, almost 10% growth coming in. And then you have a, blue chip marquee NBFC like Bajaj Finance still clocking 24-25% growth. So as an investor, if I want to make a fresh investment between these three choices, give us your rank and pecking order and the reasoning.
Yeah, good morning, Sarvi. I think I will still go with Kotak Bank, and the reason being HDFC Bank did surprise with the kind of numbers they came out with. 9.9% was quite a good number. I was expecting 7 to 7.5 kind of a growth number out there. But the catch point with HDFC Bank is that CASA grew, but 7% was the CASA base, and term deposit grew by 14%. So there would still be a hit on the NIMs going forward, and Q3 as well can see a normalization of NIMs for HDFC Bank. Asset quality, it has always maintained a good set of asset quality. And so there may be some trading pop up there. But Bajaj Finance, again, on the expensive side, they have done well. I would love to see the management committee this time around, because last time around the numbers were pretty good. But the management said there is a concern in the two-wheeler, three-wheeler segment, at the same time MSME segment. So what is the commentary now? Are those concerns over in light of the GST cut and all? So again, it's as pricier stock, 6x price to book it is trading it. But Kotak has a comfortable and a evenly balanced kind of a run rate. They are maintaining 16%. At the same time, deposit growth has also been fairly robust. Asset quality, last time there was a bit, turbulence out there, but I think this quarter things should settle out. Valuation-wise, it's comfortable as compared to others in the group. So out of the three, Kotak remains a topic. Bajaj and SDFC would be a market performer to my mind.
Okay. We're just going to talk about banks with Nitin Agarwal, who's going to be with us in just a bit as well. But Dharmesh, good morning. Did you look at the DMart update? And what did you make of it?
Yeah, good morning, Prasad. Yeah, I mean, 15% kind of a growth was there, and going, I mean, it's better than what they have done for the last 2 years. There has been a slippage again, it's been gaining back. Stores count remain the same, I think nothing great out there. And if you look at DMart, Prashant, 2021, it was 5,400 was the stock price, it is 4,400 now. And the reason being in last 4 years, the tapering of the CAGR has seen on the revenue and the PAT side. So last 2 years, it was 6.7% kind of a CAGR growth. Going forward, we think 10-12% is still doable. At the best, it can go to 15%. But nothing beyond that is the likely scenario. In light of that, if you look at DMart, is still trading at, depending on what kind of a valuation multiple, I mean, unless you are seeing 75 to 80 times 1 year forward. And on a TTM basis, 102 times, P multiple with margins being where they are 14%. So to my mind, it's more of a, down rating, I mean, negative rating for DMart rather than a progressive growth. So stock will continue to languish where it is with signs of correction setting in.
Okay. Just stay on. We'll have more questions for you in just a bit, Dharmesh. But let's go back to the banking and the BFSI updates that have been coming in. We do have Nitin Agarwal, Senior Group VP Head of BFSI at Motilal Oswal Financial Services. Nitin, great to have you in. So I'll come to the big lenders later. We were just discussing this, the same thing with Dharmesh before you joined in. Let's start with the non-Nifty names that have reported, and a whole host of PSU banks in that list, including PNB. There are a lot of the small finance banks that have reported. So what stands out for you? I mean, I noticed that most of the SFBs, I mean, no one's lighting up the charts with growth. It's largely, single-digit growth. So just tell us your trends, reading through the weekend updates.
Yeah, hi. Thanks for having me. And I think this time the business update has come out to be fairly strong. If you'll see, not much expectations were there from 2Q, while we did see some pickup in the business activity in the last 10 days out of September, especially after the GST cut. Otherwise, the commentary and even the RBI numbers that were running, for most of the quarter, were fairly kind of soft. And in context to that, most of the PSBs have reported a fairly strong growth. Across the board, we have seen growth ranging between 3 to 6% on advances on a sequential basis. And for SFBs also, the growth is for our coverage, SFBs is between 4 to 5%. So both AU and Equitas have reported a fairly healthy sequential pickup. And this is when MFI sector, we are still expecting trends to remain soft. There could be again a decline on a sequential basis in that segment. And only a Union Bank, as I see amongst the PSBs in our coverage, has reported a softer trend, and which is probably as the bank remains mindful of the pricing and is not growing aggressively in the corporate book at all. Otherwise, RAM growth, I guess, across the board for all PSBs will remain fairly healthy, something that we will see.
So in this universe, when we are talking tier 2 financials, tier 2 banks, would you have any picks before we talk about what HDFC has done and the other big boys have done?
Yeah. So certainly, we wrote our PSU bank thematic note just 8-10 days back, and we continue to remain positive on the space. And within the pack, we like PNB and SPI, of course, within the larger names remains our preferred buy. But besides that, we like PNB and Indian Bank within the PSU banks. And amongst SFBs, AU continues to remain our preferred idea. The stock has done very well over the last few months or few quarters, you can say. Only in the last after the last results, we did see some decline because of the MFI stress and some uptick in the credit cost. But we remain confident that by the time you end the year, I think the earnings will be on an upswing. And that, in context to how the bank will shape up as a transition to universal bank happens, will continue to drive a very strong earnings as well as a balance sheet CAGR.
Got it. Hi, Nitin. Good morning. Good to see you. Now, what about RBL Bank? You know, there's some news that the street has been sniffing for a bit, unsure whether or not that will come through with regard to any kind of fund infusion. But for the time being, that operational update that they put up is pretty good. You know, 14% growth is what they've delivered on the loan book. It's crossed 1 lakh crore or thereabouts. The stock has run up considerably from the recent lows. What's your view on the counter?
Yeah. Certainly. So RBL has, the stock has done really well. We upgraded the stock around 8-9 months back. And while we continue to maintain a positive view, and we believe that as the MFI stress continues to recede and provisioning therefore comes down, you will see ROAs inching up towards 1 by Q4 is what the bank is guiding. And in our numbers, we are estimating somewhere around 1.2 in the following year. So as you see that earnings momentum is catching up and the growth run rate, what they delivered in this quarter is also pretty strong. Like it's a 6% sequential growth that the bank has reported. And it's the only bank in our coverage wherein we are expecting NIM expansion in 2Q. So as this also strengthens further, that will give more confidence in the earnings and their ROA delivery. And that will help the stock continue to do well in the coming quarters, we believe.
Okay, all right. Nitin, if I remember correct, I think you're also tracking the credit card business, right? SBI cards. The stock, obviously, over the last few years hasn't given much returns. But what's the view right now? There is an entire talk that, you know, credit card spends will go up and the likes. Do you believe that the stock could perform from here on?
I think while the overall retail spends continues to track well, though it's not comparable to what it was, say, 5 years back, but last year we did see some overall moderation in spends that was mainly because of the corporate spending, which came down very sharply. And retail growth continues to be somewhere in the mid-teens, we believe. And that number we feel fairly confident about. But the problems around asset quality is something that has impacted the stock performance. Like the running credit cost continues to remain elevated. And though second half should be better than the first half is what we are penciling in. But given that the overall number per se in terms of credit costs sustaining above 9% currently is something to be watched for. And margins, another key parameter, it has been trending up, but it's a very calibrated uptick that we have seen in margins, despite a very sharp decline in repo rate cuts. Now, if we go on to see some more repo rate cuts, which is a good possibility, then I think this will continue to aid the earnings recovery for the stock. As of now, we have been maintaining a neutral rating on SBI card.
Okay, got that. Now let's talk about the private sector big boys. And here it's getting, I mean, it's a very interesting pitch, right? There's HDFC Bank, which is back to delivering almost double-digit growth, almost 10%, 9.9%. Though Dharmesh was just telling us that he, for instance, is still a little concerned about margins. So give us your view there. There's Kotak, no growth problems, 15% year on year. And there is IndusInd, where, of course, numbers are weak and it's not a patch compared to its peers. But there is clarity on leadership now, and a very well-respected leader has taken over the bank. So could this be the time to be looking at IndusInd beyond the near-term subdued performance?
Right. So 3 stocks you talked about. Yeah. HDFC, I guess, yeah, pretty strong business update. Advances growth certainly has come in better than anybody's expectations. And like after a long time, we are seeing such a sharp rise in CD ratio. Otherwise, the focus for the bank has been to bring down CD ratio. But I guess Q4 will normalize it because Q4 is the time when seasonally they typically report a very strong deposit growth. So on a full year basis, they will still be lower on CD ratio versus where they were at Q1. And but this advances growth certainly instills the confidence the bank is well positioned to deliver growth in line with the system. That's what their guidance is, that they will look to grow somewhere closer to the system, which we believe will be around 11. And so with this pickup in the advances, they are tracking well on that. And on margins, I think the decline will be very limited. We are penciling around 10-11 basis point decline for margins, and Q2 should be the bottom on margins front. Next quarter, because of the CRR cut and because of the gradual deposit repricing, I think margins will start to recover from the next quarter onwards.
And would you buy IndusInd now? Going against the near-term concern, and obviously their growth is no comparison to the others for obvious reasons.
Yeah. I think IndusInd is a stock wherein this quarter one should not really look too much on the numbers, on the business update, because it's a management clarity and the execution, therefore, in the coming quarters, which matters more. And this quarter, while, yes, both the advances and deposits have been a slight decline, but the strategy going forward and the recovery in the core business, both in vehicles and microfinance, because these are the two segments which have induced a lot of stress, that will be critical, alongside the pickup in the rest of the business lines. And which is where we believe at the current valuations, downside definitely is limited. And as you get more clarity around execution and the management focus on the segments and the outcome of therefore the profitability estimates will matter more. And we currently have a neutral rating on Anderson, but certainly there is not much of downside that we see on the name as of now.
Okay. All right. Got it. Interesting take. Thank you very much. Lots of numbers there. Thank you for making sense of all of them. Need to take a very quick break. We'll come back on the other side. We'll have our technical experts, Sudarshan Sukhani and Mitesh Thakkar, joining in with some technical ideas.
Okay, welcome back. Let's focus on this 5 minutes to go, by the way, for the pre-open session. Let's focus on the big movers from Friday. Stocks which saw large price action, heavy volumes, and of course, we're looking at delivery stats as well. Hormuz is here with all of that. Hormuz, morning.
Morning, Prashant. And you start off with Astra Micro because defense was one of the themes that was buzzing in Friday's trade after that Goldman Sachs note. And Astra Micro's 10% move was the biggest single day gain it saw since April of 23. And the stock also, and you look at the volumes here as well, it was close to 40 lakh shares that changed hands, the 20-day average of just over 5.5 lakh shares. And almost 6 lakh shares were marked marked for delivery compared to a 20-day average of just 2.5 lakh shares. So 3x in terms of the delivery volumes as well. We spoke of Sai Silk Kalamandir almost all through Friday's session after the business update, the way the stock moved, the biggest single day gains since listing, close to 4 crore shares changed hands there. The 20-day average here is less than 6 lakh shares. Even in terms of the delivery volumes, 50 lakh shares were marked for delivery, which is the sum total of the last 17 sessions combined, and that was a comparison to the 20-day average of just 3 lakh shares. And Friday's turnover that the stock had of 680 crore was 25% of the company's overall market cap as well, which is just over around 2,500 crore rupees. And of course, despite this move, the stock continues to remain below its IPO price. Now, Orient Technologies was the other one that had the biggest single day gain since listing in terms of price action and volumes action as well. We had close to 70 lakh shares that were traded on the stock. The 20-day average here is just over 5 lakh shares. But out of these 70 lakh shares that were traded, only 1 lakh shares were marked for delivery. And the 20-day average here is only 15,000 shares when it comes to delivery volumes. And in comparison to its IPO price of 206, the stock has more than doubled. And lastly, an interesting name is KIOCL. And is the biggest single day gain since October of 23. The Friday's volumes were nearly the highest in 2 months. Now we had close to 1 crore shares that were traded on the stock. The 20-day average here is only 14 lakh shares, and close to 19 lakh shares were marked for delivery compared to a 20-day average of just over 2 lakh shares. Now the interesting bit here is that this stock does not have any free float in the market. The government holding here is 99%, and Friday's turnover was higher than its free float market cap, and a market cap of around 32,000 crore rupees. And the stock has negative EPS and negative return ratios, with KIOCL on your radar 20% higher on Friday.
Okay, all right, got that. Thanks, Ormaz, for the interesting buzzers. We'll take a quick break on that note, come back on the other side. We'll get the pre-opening rates and, of course, also focus on the expectations from the IT sector. Second quarter earnings season about to kick off. We'll get you prepped up. Okay, well, the pre-open rates have started trickling in. So we've got about a 40-point up move on the Nifty for the time being. We'll just get some of the major names, the banks that have reported earnings. Look at HDFC Bank. But it's very early right now on the pre-open, but still the indication is it's going to be a higher start. Ditto for Kotak Mahindra Bank as well. And let's look at Bajaj Finance. Bajaj Finance is flat. The reported numbers are about 24% growth for Bajaj Finance. We'll keep flashing these stocks as we go by, but let's also bring in our technical experts to understand today's trading setup and, of course, some of the stock ideas. Sudarshan, Mitesh, good morning to both of you. Hope you had a good weekend. So, Sudarshan, what's it going to be? I mean, index, long trades for today or for this week, or no, or staying out, only focusing on stocks? What's the idea?
Yeah, good morning. See, there is a mild uptrend. I don't know how long it will last and where it will go. But there is that big up move we saw on Wednesday tells us that we should be buyers. Look to buy on minor corrections. Keep a very tight stop at 24,800. This is not the beginning of a real up move. I don't think so. But for short-term traders, it may give something and may not. Buy on a dip, keep a stop at 24,800 and have very modest expectations.
Got it. Okay, all right. Got that, Sudarshan. Morning, gentlemen. Mitesh, coming across to you. What's your view? Last couple of days have been good, but now we're reaching that crucial 25,000 odd mark. What's your view?
Morning, Nigel. So I think that's the level which I'm watching very closely. 25,000 is an area where we have some moving averages as well. And the 20-day average, though, is at about 24,920. But I think 25,000 also has some weekly averages. So my sense is that while the market has managed to bounce back after a good decline, we have slightly come off the oversold levels. If we don't cross 25,000, then I think it could be a range between 25,000 to about 24,500. And that's where, the markets will consolidate for the next couple of weeks to come by. The interesting part in this entire equation is the Bank Nifty. One, it gave a very good breakout on the intraday charts on Wednesday and saw some follow through on Friday. I think 55,800, 900 is the first target area. We are not very far from there, about 300 points. But in case we start getting past that, then the Bank Nifty could lead the charge, and then the Nifty could also possibly have an upside move from the range.
Morning, gentlemen. Mitesh, what are your trades?
Morning, Prashant. So I have more of buy calls very clearly, more buys to sell. I have one sell, and that is on Lora Developers, which made a fresh swing low. Sell here with a stop at 1136 for targets of 1,070. While on the buying side is Nuvama, gap breakout, good price and volume action on Friday. So buy with a stop at about 66.90. Look for targets of around 68.90. Also a buy on Shriram Finance with a stop at 635 for targets of 665. And a buy on MCX, which I would recommend buying with a stop below 80.50 for targets of 83.50.
Okay, all right. So those are mostly all long ideas from Mitesh. Sudarshan, what about you? What do you have?
Yeah, I'll just tell you. But Prashant, are you aware that the NSE IX is going to start daily zero DT Nifty options from 13th of October?
Yes.
Essentially, Nifty options that will expire every day.
Yes.
Obviously, it's not for Indian residents, but that's very interesting, and I wonder how it will affect us.
No, absolutely. Yep.
Granules is a buy with the stop under 549. Kalyan Jewelers is a buy with the stop under 481. It's an all-buy list. United Spirits is a buy with a stop under 1337. And Tata Tech is a buy with a stop under 693.
Absolutely. Thanks very much. And Sudarshan, thanks for pointing out. We sort of planning to do something around it to on those options, daily options products, of course, on the Gift City. Thank you very much, both of you, for those trades as well. Now it's time for our special quarter segment where we are kicking it off with IT in focus. Rima is here to set the stage for Q2 expectations across large cap, mid cap companies. Rima, take it away.
Thanks so much for that. So this quarter for the Indian IT companies is expected to be stable. But so far, there are no signs of a demand recovery. The good news is that unlike in the past few quarters, there is no further deterioration in demand. So here's what the CNBC-TV18 poll looks like. So constant currency revenue growth for TCS could be muted, just about 0.2, 0.3%. Off the lot, Infy is likely to lead with about a 1.8% gain. HCL Tech stands at 1.5%. What will work as a tailwind for Indian IT companies is the INR depreciation. The rupee has fallen nearly 2.5% against the dollar, and that will act as a tailwind for margins and protect the margins against any AI-related deflation or pricing pressure. So margins will look better. For Infy, margins are likely to go up by 50 basis points. For TCS, close to about 20 basis points. Company specifics will matter. For TCS, for instance, continue to watch for the tapering of the BSNL deal, and even if this whole JLR rover cyber incident has had any impact. For Infosys, as always, the FY26 guidance will be at the center of all investors' attention. The current guidance stands at 1 to 3%. The guidance could be tweaked. Maybe it stands at 2 to 3%. But the guidance for Infy will be material only if the upper end is raised. That's the 3% mark. For Wipro, as always, it's a test of the company's turnaround story. For Q3, the street is penciling in a guidance of 0.5 to 1.5%. HCL Tech, FY26 guidance likely to remain unchanged at about 3 to 5%. For Tech Mahindra, watch for the margin reset story and the commentary on the telecom vertical. But across the sector, what investors will watch for, whether the AI-led renewal deals are getting traction, if AI is getting monetized beyond pilot projects. And the other, watch point, and which has captured, so much of the investor attention, is the impact of the H-1B visa costs. Is that going to hurt on-site delivery, the cost structure? What about fresher onboarding, headcount, overall attrition? All these will be important signs of demand visibility going ahead. And of course, markets will wait to see what TCS and Wipro have to say about a potential buyback after Infosys recently announced one. The big question all investors are grappling with when it comes to IT is that it's an unloved sector. It's not done anything. It's a serious underperformer from the start of the year, down about 25%. So does it turn into a value buy? Just to put the valuations in context. Now, historically, large cap IT companies used to trade in a band of 15 to 20 times forward multiple. TCS right on top. Then you had the pandemic boom, and the valuations dramatically increased to about 25, 30 times. And for mid-caps, it went as high as 60 times. But again, over the last 2 years, as demand has slowed down, valuations have actually come down and come back to long-term averages. So today, an Infy, TCS, HCL Tech are once again back in the 17, 18, 19 times range, valuation multiple, which is fine until you look at the growth expectations. For FY26, this is the Jefferies have pulled that up. Look at the numbers, right? No growth for TCS, just about a muted, 3-4% growth for Infosys, HCL Tech at 6%. So we're talking about low to mid-single digit kind of a revenue growth. And that is the big question. Is it a contrarian value buy today, or is it still too early to buy? Back to you.
Okay, all right, Rima, got it indeed. And that's the interesting question as we get into the season, that you have to look beyond the near-term weakness and look at a tactical buy or not. Manik Taneja, Executive Director, IT Services and Internet at Axis Capital is with us. Manik, great to have you join in. So let's talk about the bare basic numbers like Rima's put on the table, that, expect between 0.5% to, in best case, maybe up to 2% growth, if at all, this season for the large cap IT services companies. Now, going beyond looking at the second half, do you expect any acceleration or pickup in spending? Or do you think this year will be more or less the same? So let's get the growth question out of the way first. Are you expecting a pickup this year? And then how does FY27 look like?
So first of all, thank you for having me. And with regards to your question as to whether things pick up or not, but in general, over the course of last 2.5, 3 years, every few months, we tend to get excited about CY24 becoming better, CY25 getting better, and CY26 as well. But almost all the time, these hopes have got dashed. And I would say it's a combination of aspects at play. As of now, with whatever Accenture has guided for their fiscal, they are not pointing to a significant acceleration. Street, including us, are building in some normalization in growth, but do we see a flush in terms of spend similar to what we saw post-COVID? I think the answer to that is no. And it is continuous, basically reset in terms of growth expectations that are now finally essentially getting acknowledged in the multiples for the sector as a whole. And today, if you look at, as Rima was also pointing out, tier 1 techs trade at similar to lower multiples compared to last 3-year, 5-year averages. We've seen multiples even come off for the tier 2 coverage. but they are still trading at on par to slightly higher compared to last 3 or 5 year averages.
Absolutely. Manik, one more point on growth. Now, we saw the reaction when the whole H1B news was announced. We saw that play out in stock prices, and stocks have corrected as well. So has the market fully priced in the H1B overhang, or could it continue? Because we know that it's not a near-term hit, it's a one-time fee, etc. But the point is that given the chatter around offshoring in the US, could it now start being an overhang on deal closure conversations? Could it then therefore push back deal timelines and getting any fresh business? So to that extent, when the commentary comes out of the second quarter, are we at risk of hearing another negative?
So certainly, as we've also mentioned, that H1B is a far more manageable risk for the sector as a whole. But as you have also pointed out, this plays a role in terms of potential deal discussions as to how customers are approaching it, and thereby do they take a more calibrated approach, especially with the way US administration essentially is thinking about outsourcing / offshoring from American companies. And thereby I would say no American corporate would want to be very vociferous in terms of saying they are signing up a large mega deal with an Indian outsourcer and then be in the eye of storm on Truth Social the very next day. So thereby that does impact the setup for Indian companies. Do these companies have an immediate way out? I would say the answer is no. Some of these global companies work with these vendors, also have their GCCs, and whether it is an Accenture or an IBM or even the JP Morgans of the world, all of them essentially use Indian talent for supporting their technology needs. So I would say people will try to essentially work around with these regulations, but certainly have an impact on the way deal discussions progress.
Yeah, which is why that question of is there another growth risk? But okay, very quickly, we're hitting market opening. In terms of stocks, what to do? Is there anything on your buy list at all? If not large cap, maybe mid cap, where the growth rates are relatively better off.
Sure. So I will first of all say, since you guys have been highlighting that the stocks have come off and it's an unloved sector, just look at global tech services. Over the course of last 5 years, the likes of Accenture, likes of Cognizant, likes of EPAM, Globants, the world would have delivered very modest returns to probably even negative returns. So the despondency in Indian IT is only catching up. The second thing that I would say from a sector standpoint, from a rating standpoint, Infosys and Wipro essentially remain our preferred picks amongst large caps, emphasis amongst the tier 2 techs, and we have a buy on both First Source and Citility in the tier 3 universe. So we'll continue to stay very selective in terms of our ratings.
Yeah. All right. Thanks very much, Manik. Appreciate you joining us. We've got about 22 points on the Nifty and about 70 points on the Sensex at this point. And that is essentially where the pre-open rates have settled in. I don't think we have time to look at stocks and how they're opening up in the pre-open. So we'll just sort of come back in a bit on these names. The first rate starting to come through shortly. So 24,916, absolutely flat. Nifty Bank is up about 0.4%. Small cap index is up about 0.25%. And this is where we are at. So it's a very, very staid, but decent open. 900 up and about 650 lower is where we are beginning today's trading session at. Nifty heat map will give you a quick sense of where we are starting, and then we'll get to individual names, lots of pre-quarter updates, and some other movers as well. So it's kind of evenly split right down the middle. So some of the hospital names like Max, Apollo, etc. are there. On one end, there's HDFC Bank. On the other end, there's Power Grid, Sun, Nestle, etc., which are coming through as well. So this is the market open, 40 points higher to start this Monday. Surbhi. Yeah,
absolutely. It's all the banks, frankly. 0.5% up on the bank Nifty. And that's the only silver lining, so to speak, was these updates have looked pretty good. To almost robust in some cases. So HDFC Bank with its 10% growth year on year, stocks up about 0.7%. There's ICICI Bank, which is rising slightly as well. Axis is managing about a move of a little over 0.5% at this point in time. Kotak Mahindra Bank is flat. It reported 15% growth, but for the time being, the stock isn't doing anything. The hospital stocks, of course, are excited because finally, after a good 10 years, CGHS has decided to revise hospital rates, how much it's paying for patient charges across hospitals. Max has a good exposure, so 3% up, making it the best performing stock on the Nifty right now. And Apollo as well, in quick succession, up about 2%. Okay, then I'm back to financials. Shriram Finance, 1.5% up. Bajaj Finance showing a growth of 24% in the quarter gone by. 1.2% up. So it's really financials that are saving the day. And the other good part is that at least IT is not falling. TCS 0.25% higher, Infosys also at least slightly positive right now. So it's not a downside drag. Actually, on the downside, there isn't too much. For the Nifty, there's Cipla, there's SBI Life. Some of the defense stocks like BEL are cooling off. Last week, we had a good rally in some of these large defense names. And then you have something like Titan and L&T on the lower side as well. But otherwise, it's financials all the way. Nigel?
Well, that's right. On the downside, Hemisphere properties, I'm not sure what's happened there. But, that's down close to around 15%. So sharp downtick is what we're seeing on that particular counter. We'll just check. It's falling on rather large volumes as well. So just keep an eye out on that stock. In terms of hospital stocks, the CGHS rates have been revised. And a company that's a listed company that has a fair bit of exposure is Yatharth Hospital. So that one, in fact, is opened up with a gain of close to around 4%. Volume's not very, very high, but that has a relatively higher proportion of their, revenues that are linked to the scheme. So that's why, in fact, that stock is up and about. The other one is Aditya Birla Lifestyle. That large trade had to take place, 6% equity getting sold out. And, that happened in pre-open. So that's up close to around 10%. Big up move is what we're seeing. I recall when it got listed on the exchanges, in its new form. At that point of time, we did see the stock listed on 165 odd. From there, it pulled back. Now that this large trade is out of the way, well, it's popped up in trade 9% or thereabouts. On the downside, L&T Finance is under some pressure. That's down close to around 3% as we speak. So some bit of selling pressure out there. And metals continue to do well, because of the melt up we're seeing in pricing. So Vedanta, no great shakes with regard to their quarterly update. But the street is looking ahead now, with regard to what's going to happen with regard to the demerger. That hearing is due. And that's why the stock has recovered. Even Hindustan Zinc, the only way to play the silver big catch-up that we're seeing. Silver is approaching $50 an ounce yet again. So that's why that's up close to around 1% or thereabouts. And Hindustan Copper as well. With copper at multi-month highs, well, that one continues to move ahead. Demand is relatively strong. And we have a bit of a supply issue globally as well. So that's why that one up 2.5%.
All right. It's a quiet start. 24,925 or so is where we are at. Sanjay Mukim is now joining us. He's a head of India equity research at JP Morgan. Sanjay, good morning. Great to have you with us here in the program. Thanks very much for joining us. I don't know if you heard our External Affairs Minister S. Jaishankar at that conference in Delhi. Talking about India, he was essentially basically saying that we are yet to find common ground for talks to take place with regards to resolving these issues. So I'm just sort of summarizing this in one line. So it does give you a sense of where we are at. If this is an issue, an impediment for the market, sentiment-wise or otherwise, the minister essentially saying we are perhaps still in very early stages trying to establish the broad framework on the basis of which we have to agree what we are going to talk about in that sense. That's what it seems to me. Sanjay, how do you see this and implications for markets?
Morning, great to be on. I think, look, you can't deny that it is an overhang for markets. What degree of an impact the lack of a India-US trade deal is very difficult to assess, of course. But what I'd also suggest, is that, look, other markets around the world are doing very well for intrinsic reasons. So the tech rally everywhere, the rebound in China, the rebound in Korea. So yes, maybe let's say an India-US deal could alleviate some of the pressures on the Indian equity market, and you may see a bounce on the announcement of one. But it may not necessarily be redemption for the underperformance that we have seen so far for MSCI India. You'll need a little bit more bottom-up push, I expect, for this underperformance to close.
Sanjay, hi. Great to have you with us this morning. So much going on. We are running into yet another earnings season. And, if we just go away from the global noise and what the US administration is doing or isn't doing, at the end of it, it boils down to earnings, right? And that is where we are yet to see any sort of a meaningful pickup. Now, are we at an inflection point where that changes because of all the policy stimulus, GST cuts, RBI, etc.?
Good morning, Surabhi. I think we could be at one, and this was one of the themes at our conference that we recently concluded. And I was worried that participation might be soft given that markets been flat, but there was a big vote of confidence. A lot of people showed up, and one of the things that everybody was trying to explore was this: there has been a lot of, let's say, stimulus affected through the tax cuts, the GST rationalization, of course, combined with the rate cuts that you've seen, and this could lead to a revival of consumer expectations. Now, this is not likely to show up in numbers for the September quarter because the cuts happened very late, of course. But I think the results season this time around, there will be a lot of focus on how companies talk about the upcoming quarters. Have they seen a change in inflection? Have they seen a change in consumer trends? And therefore, there is this possibility that you get a little bit of momentum in earnings, especially given that we've already cut our numbers quite a bit in the last few months.
All right. Hi, Sanjay. Good to see you. And as always, what about the FI behavior? What are they thinking with regard to India? We used to be a darling till, 12 to 18 months ago. And that selling has been relentless. Though, thanking our stars in the last week or so, that cooled off a little bit. But they continue to remain net sellers. Their holding in the Indian markets is at a multi-year low. And in the FNO market as well, they're net short. Do you think that there are signs that gradually at these valuations, with the kind of measures taken both on the fisc as well as on the monetary side, and the hope that earnings come back, the FIs gradually start piling on the Indian stocks yet again? Or do you think that still has some time?
We'll see how the plays are. These are very difficult things to anticipate in the short term, of course. See, India, everybody agrees, has a lot of potential in the long term or the medium term, right? There's all the known tailwinds of continued urbanization, the manufacturing drive that the government's pushing, urbanization, that's likely, the demographics that everybody agrees to. So those factors sustain, and India therefore remains a place of inquiry for everybody for the long term. I think the challenge, at least in the near term, is the fact, like I was saying earlier, that other markets have delivered much sharper bounces. There's greater clarity on many others, let's say tech-related sectors, of course. And a lot of investors were not necessarily positioned to participate in those rallies early on. And therefore, you see continued rotation out of India, which had been owned by them for a while, into these newer momentum areas. So until you see that reverse, the relative argument reverse, I'm not sure you're going to see too much of FI flow come back just because the markets underperform.
So Sanjay, what you're saying is it has to be someone else's loss for the market here to do well. So let me explain. I don't mean it literally. Basically, from what I understand, what you're saying is money is going into themes like artificial intelligence, infra build out there, etc. You don't have very much here to as plays on that. So at some point that reverses, and then people start to sort of look at other areas. Right now, it's all concentrated in one big theme globally. Is that what you're saying?
There's not just one. There's let's say the stimulus in China, the rebound in Korea that you saw as well. The tech being just an example that I was using, Prashant. So I'd argue that, look, equity investing is a relative game. And if you have greater confidence of earnings momentum, and let me just highlight this one point. EPS expectations for the S&P in the near term are actually being upgraded. Right now, you can debate why it is happening. It's only tech-driven, or that you had cut them too much after the Liberation Day tariffs, etc. But nevertheless, for equity investors, you're seeing upgrades in the S&P EPS number. How sustainable they are, we can all debate. But in India, we have not seen that earnings momentum as well. So you need to start to, let's say, catch up on those trends, deliver some bottom-up momentum before you can claim some interest from foreign investors.
Sanjay, on that point, I know it's a little out of subject for us sitting here talking about India stocks and India earnings, but since you have that worldview as well, and you met so many people at the conference, there is some chatter that's starting about whether global markets, starting with the US itself, is now, in the build-up to a bubble stage. And I read some stuff over the weekend as well. I mean, private credit in Europe has gone all over the place, and there was a bankruptcy over the weekend, and then there was some, murmur of, we all remember how we got to that point of 2008, right? So I'm not saying this is anything similar, but is that a concern? Because then all bets are off, right? I mean, if we are at that point in global markets where perhaps there's a bigger correction coming. I mean, look at what's happening to gold. It's just going up, and central banks are buying, not just speculators. So just your views.
Well, this can be a very long discussion, of course, Surabhi. But look, Archie suggested that the markets or economies seem to be in some sort of bubble stage. Whether we are mid-cycle or late cycle is extremely difficult to pinpoint. But there are excesses clearly. The only saving grace I'd argue is that corporate balance sheets nowhere seem to be very leveraged. So unlike, let's say, 2008, as you referred, there doesn't seem to be a leverage problem in the corporate sector, but possibly a leverage problem in the government sector, where governments have borrowed, debt to GDP has gone up materially. And consequences of those might actually filter through into economies. But we don't expect, at least personally, I wouldn't expect much of a corporate sector blow up because there isn't much leverage in the system.
Yeah, that's good to hear, and good to have that reminder, so we don't have to get too worried. So which brings us back down to, how people should look at their India portfolio. I mean, and there's this other debate, capex versus consumption, saying now, do you need to unload a bit on capex and move some of that money to some part of consumer? And where are you on that? And within consumer, where should the focus be? Because it's a very large basket overall, consumption.
In the near term, I think the answer is very, very evident, Sulpi, that the stimulus that the government has affected, I mean, we should hesitate in calling it a stimulus. It's a shift in policy preference, if you will, because the fiscal deficit will remain at, I would expect, 4.4. You're just taking, some money I expect from capex-related spends to the tax cuts that have gone through. And combined with the rate cuts, there is enough of a momentum for mid-income households to reconsider their purchasing decisions, right? There is that consumer stimulus. So looking at more consumer-related stocks in the near term makes a lot of sense. Now, the challenge, of course, investors face is many of the stocks have already gone up. So the question is, where is it not priced? Where are further surprises likely? And we would argue that where there is elasticity to the price cuts that have come through is where we would continue to look at. So maybe some of the auto-related names make sense. The discretionary, obviously, you'll have greater elasticity to price cuts than staples. So those are the sectors where, I would agree with the consumer over capex in the near term, but more discretionary over than staples.
Yeah, and that's been your call, Sanjay, for earlier this year as well, I recall. And that call actually has gone very well because staples have still not picked up. The growth is extremely anemic. And with this GST 2.0 boost, discretionary could get a further boost. That said, how are you feeling about the markets? You're sounding a little bit somber still, and earnings have not yet picked up. If earnings don't pick up to the extent possible, a lot of newbies in the market, they are frustrated last 12 to 15 months. In fact, the index itself is lower. Do you think we could brace for a couple of years or maybe single-digit returns itself on the index, and that would be a good case outcome?
I would lean towards that. Now, the issue, of course, is that the higher multiple that you buy it, and this chart is clear over the last 20 years, the higher the entry multiple, the lower the future returns. Right? These are very self-evident, I think, pronouncements. And so if you do buy equity assets at current valuations, your expectation of future returns cannot be in the double digits on the index ETF. If you are able to, let's say, buy stocks and some of them deliver returns, that's separate. But on an index ETF, you should not expect very high returns if you're buying at current multiples. On your first question, of course, Nigel, is on what we think of the markets. Look, it looks like you could see a little bit of a bounce because, like I said, expectations have been right-sized, earnings have been cut. Valuations for the Nifty are at 10% on discount to the S&P 500. And India tends to track the S&P multiples reasonably well. Plus, of course, we have this hope that December's March quarters turn out better for the consumer-facing stocks in the economy. So I wouldn't get too negative on the index itself. In fact, I would argue that there's probability of a little bit of a bounce in the near term.
Yeah, no, absolutely. I'll just quickly run you through what's happening. Just take a quick look at some other stuff which is happening, right? 10 points, by the way, on the Nifty. So 24,885 is where we are at. BSC is picking up a little bit. It's up about 3.5%. And stocks at about 2165 right now. Of course, lost a fair bit from the highs of about 3,017 or so. Basically lost $1,000 clean from the highs in August to where the lows were recently. The one bit of news flow, and we'll have to, see. There's actually, the thing is, there is no news flow, and that's the reason why the stock is going up. The news flow which was that consultation paper on futures and options segment, and whether weekly options should be, just discussing whether weekly options should be done away with, and the focus should be on longer tenure derivatives, etc. Now, the SEBI member who's kind of spearheading this is retiring this week, end of this week, and will we see something over the course of the next 5 days, or will it be a new person who sort of starts to come in and kicks this off, in a fresh way, fresh look, and does that provide some amount of relief to that category of weekly options product? I mean, I think that is what remains to be seen. I'm not sure this is related, the move is related to that, but I thought it's interesting to just highlight what's happening there.
Just one more point, Prashant, on BSE, the stock, I was just reading a sales note that came out. The stock is trading at around 38 times its forward multiple. And that's a 15% discount to the last 2 or 3 year average. The stock has corrected, as you said, 30% in the last 4 months. And another note is suggesting that the impact of this weekly expiry swap hasn't been as much as what they feared earlier. So, looks like a whole host of factors that are coming together, and that could be one of the reasons why the stock is up. Just one more stock, Hemisphere, we were talking about it. Hemisphere Properties, the stock is now down, I think, close to around 15%. On the exchanges, they've noted that they put out, a property in Pune on e-auction, and the bids didn't come, on expected lines. So that's the reason why that one is down close to around 18% or thereabouts. It was put up for auction between the 1st and the 3rd, and no bids came in. So that's why that stock is down close to 17 to 8%, probably the reason.
The other big stock, not big stock, but the big M&A which we reported on last week was Sammaan Capital. Now, Sammaan ended kind of flattish, slightly lower, 1%, 1.5% by close on Friday. It's down 3%. It's got the largest volumes on the NSE right now. Number one volume traded loser. The 3% cut, not very large, but 150, just under 160 is where it is at. Some of these are just pure reversal moves. I mean, AG's logistics went up sharply on Friday, so it's giving back a little bit. I can spot Premier Explosives, which is up very, very sharply right now, which is up about 6% or so. So lots of new things into the mix as we track markets. E2E Networks is up another 5%. Maybe we should look at NetWeb as well. NetWeb, I think, had a blowout September, and it's, I think, taking it a little easy this morning, down about 0.5% or so. Let's just focus on Avenue Supermarts, which is D-Mart. And let's go across to Mangalam to run us through what the quarterly update looked like. Mangalam, over to you. Morning.
Good morning. So, D-Mart, is lower in today's trading session. There were no great shakes in the quarterly update. Nothing really to write home about on both the upside or the downside. Why do I say that? Because, the standalone revenue grew at around 15.5%, which is pretty much in line with their 3-year average of 15.8% growth. So, no great shakes on either the upside or the downside. They've added 8 new stores in this quarter, which is basically, the first half of this year. Around 17 stores is what they've added. The company has been looking to accelerate their store addition, so that's something we'll be watching out for going forward. Year on year, the store addition has been 14.5%. So you would say 15.4% revenue growth, store addition of 14.5%. Implied same-store sales growth is on the lower side, closer to around that 1% mark. The reason why the stock is sharply lower, despite having corrected from levels of around 4,700, 4,800 earlier, is because the street believes that going forward, the reported revenue would be a lot lower than historical rates because of the impact of GST cuts. So now something that was charged at around 18% or 12% coming down to 5% would imply that the MRP goes down, and as a result of which the D-Mart selling price goes down, and that would reflect in their revenue. So volume growth will be very important to track. Performance of D-Mart Ready is something that the street will be tracking, as well as quick commerce speaks about competition easing out. And finally, the store addition outlook, because that's something that everyone's pinning their hopes on when it comes to growth for D-Mart coming in, especially from Uttar Pradesh, where they recently opened a store.
Okay. All right, so Avenue Supermart under pressure today after that Q2 update coming through. Mangalam, thanks very much for that. But for the timing, let's move on. And it's IPO Street, which is buzzing and as alive as ever. Today, it's all going to be about a large issue that's coming to the market. Tata Capital's 15,000 crore rupee IPO is opening out. It is the largest issue of the calendar year so far. And we have the main gentleman with us, Rajiv Sabharwal, Managing Director and Chief Executive Officer of the company, joining in. Mr. Sabharwal, thanks so much for joining in. And, it's a pretty momentous time. Every time a Tata Group company comes to the public markets, obviously there's a lot of excitement. Now, people really want to understand the business and what your vision is going forward, because if I look at the FY25 performance, then the overall growth was, absolutely, it was a blitzkrieg over there. I think 40% growth, right, on the book. However, there are those who also point out that your yield on advances and margins have been lower than your, peer set NBFCs. So, is this going to continue, that you will focus on that kind of growth even if margins, say, remain slightly lower than the average? Or is there going to be a change once you become a publicly listed entity?
So, if you look at our overall growth, we had the impact of the merger of Tata Motor Finance last year in FY25. Though we got the merger approval in May of this year, the merger dates back to 1st April 2024. So if you exclude Tata Motor Finance book, we've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. If you look at our housing business, affordable housing is the fastest growing segment there. It is growing at over 30% over the last few years. And we are among the top 2 or 3 companies in that space. We always look at that.
On affordable housing, Rajiv, good morning. Most NBFCs we speak to, they kind of lament the fact that affordable housing is a segment. When there's not enough stock on the affordable category to fund. That's the feedback that we have gotten occasionally. Is this on Tata? I mean, is there a lot of group? I mean, are you lending to, say, Tata Housing and developments, etc. there?
No, that is a very small portion. Okay. That's not the big thing. But, when we talk about, affordable housing and the stock being limited, we are actually talking about the organized developers. But if you purely look at affordable housing, it's largely a self-construction market. 80% of what we fund there is actually self-construction. When we go deeper into the markets, that's where we realize the real India is throbbing and alive, and there is a lot of activity.
So how does the loan book break up? I mean, so retail is about 60%, right? And that includes housing is within that. So just give us the broad areas where...
So, Brian, if you look at our book, about 63% is retail. Roughly half of that would be housing, and half of that would be other consumer loans. About 25 to 26% is SME, and the balance 11 to 12% is corporate.
Just to go back to the point on margins and yields, I guess it's also a function of, because all put together, I think over 70% of your book is secured, right? I mean,
actually speaking, if I talk about retail unsecured, which was in
the big talking point
last year, that is just short of 12% in our total book. So largely our book is secured in nature.
And do you intend to keep it that way? Because for a lender, that's always going to be that question to ask, the trade-off between higher yielding unsecured assets versus secured, slightly lower yielding assets. So do you intend to keep it at 12%?
So our approach is to create a very resilient book, an asset book which should not only do well when times are good, but should do well also when times are not so good. In terms of our mix of retail unsecured, what we have seen in the past few months, that the worst of credit cost is behind us. We will watch it over the next few quarters. And if things go well, we will look at accelerating that growth too.
Consumer segment,
the unsecured part of it.
Rajiv, consumer segment is 30% of the loan book, right? Consumer finance. And SME is another 26 odd percent. The GST cuts that happened, it's supposed to show up in a big way. I mean, I've spoken to companies like Bajaj Finance, etc. as well. Yeah. These are the two areas where it's supposed to have an outsized impact. Are you already starting to see some of it?
Absolutely. This is actually, if you look at it, it's a very significant cut. It's not a small tinkering, it's a big cut. And the impact is visible whether you talk about PVs, CVs is still taking some time, but if you talk about two-wheelers, tractors, I think this is clearly visible. I think there are some products where the impact is immediate. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year.
All right. Hi, Mr. Sabharwal, and thanks a lot for coming down to the studio. A couple of quick questions then. Part of the issue will be a fresh issue. So how does it change your return ratios? If you could give us a sense on that. And also, if I look at some of your peers, whether the commentary that's coming in from Bajaj Finance or even in HDB or even Chola, which is, one of those companies that has been the leader in the last few years. They said, one of the comments that they made was, this year is a year of collections, not of disbursements. That's giving you some sense of the industry. What is your right to win? Because some of those shareholders in the unlisted market bought the stock at a much higher price. So there will constantly be that concern on that front. So return ratios and your right to win.
So if you look at our offering, it's a mix of primary and offer for sale.
Yes.
With the primary offering, our cap ad, which is will go up to over 22%. Our leverage will come down to below 5%. As far as returns are concerned, I think you need to give the organization another 1.5 to 2 years to fully utilize this money so that the return ratios keep getting better. I feel when you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Okay.
And we should start seeing only better things. The reason also is because the market also has become far more responsible, both on the retail unsecured side. The other side which faced a problem was microfinance, and MFIN brought in a lot of regulations. So those things, I believe, have made the market more stable.
Okay. So, talking about capital support, like Prashant mentioned, because less than half of the issue is a fresh issue, the rest is an OFS. How well capitalized will you be? Will there be the need to look at any further equity capital support from the parent? Just a bit on the capital structure going forward after the IPO.
We've always had tremendous
support from your parent. Absolutely.
Both our Tata Sons chairman, Mr. Chandrasekaran, and Saurabh have been extremely supportive. As far as this money which we are raising at this point of time is concerned, this should allow us to grow along with our own profits for the next 2.5 to 3 years. And post that, we may be in the market again to raise money.
Okay. 2.5, 3 years. Okay. And any sense of, you're saying that, so obviously you see a lot of growth in the future. But what would be the capital requirement if the growth expectations are met? And you say you've been growing at about 25% anyway, ex of the Tata Motors Finance business.
If you look at it, the market right now, we are raising about 6,846 crores.
Correct.
Plus, there will be internal accruals through profits coming in. I think a combination of this, we do believe, will be sufficient for us to give us a growth rate, which should last us for the next 2.5 years. We can't talk about the future growth rates, but if you look at the past few years, we've been growing at 25% plus.
Rajiv, on a lighter note, not a lighter, it's a serious question, but maybe prefacing with a lighter comment. By the way, missed you at the Banking Financial Services Summit this year. I had you on the NBFC panel, I think it was last year, the year before that. This year we had an interesting gathering, and I was just saying that banks are like airlines, right? I mean, they carry heavy loads, regulated, strictly on schedule, etc. Fintechs are like, ride-sharing platforms, sleek, sophisticated, kind of sexy. I mean, if you go there. And NBFCs are like railways. I mean, they take a load of people and go where others don't want to go. So there'll always be NBFCs which do well through cycles, and we've had a few of them. But in terms of the ability of what banks can do now and what NBFCs are able to do, allowed to do, you just saw, right? I mean, RBI's measures, nothing on the monetary policy side, but lots of regulations, really unshackling banks and allowing them to really do a lot more. Is that going to be an issue? Not an issue, but banks are big competitor in that sense. In many areas which so far were largely sort of served by NBFCs.
So that's always been true, Prashant. You know, in the Indian market, competition is given. You know, whenever you find a segment which is profitable, there'll be 10 more companies wanting to jump into that. Luckily for us, this is a more regulated market, and things are more sane here. You know, if you look at the whole set of banks, you know, you will realize that there are top banks and then there are another set of banks. Even if you take the top private banks and when you look at us in size, we'll be in the top 6 or 7. Similarly, there are NBFCs which are at the top and there are other NBFCs. So if you talk about us, what we are seeing is because of the trust which we enjoy, the credit rating which we enjoy, we do get the benefit of one of the lowest cost of funds in the market. And the ability to then target the best customers is possible for us, which again leads to that whole virtuous cycle of getting a lower credit cost and then again getting a lower cost of funds. So I feel this market will remain competitive. We will all have to figure out our own niches to play in. And the good part, what we are seeing in India is it's huge. We continue to expand and we continue to see opportunities. So that's the plus point, and the growth is visible in all markets.
Which brings me back to the same point. I have to ask you this. On growth, I don't think the market has any issue. On the pedigree, absolutely no issue whatsoever. The only bugbear has been margins. But you've said that if things remain stable, you may want to, build on the unsecured book as well. So your margins have been between 5.2, 5.3% largely. Is there an aspiration to start going towards 6, maybe 7, and inching towards high single digits at some point?
So if you look at NIM plus other income, we are just above 6, around 6.1%. And clearly, in terms of what returns come in, one benefit does happen from margins, as I mentioned, that we are adding more of high NIM products, which should give us better things. The other benefit which accrues to entities like us is cost to assets. Because of the significant benefit which we are seeing on account of digital and now Gen AI, we do believe that there will be a step change in cost to average assets over the next few years. Just to give you a sense, our housing company in March 23 had a cost to income of 40%. In the quarter which just went by, it was 31%. Because of the huge impact of digitization and our investment there and Gen AI, you will start seeing a big plus also coming in from cost to average assets.
Okay.
Well, Rajiv, we'll leave it there. Thank you very much. I hope this is the first of many discussions as you start your listed journey. Good luck for the IPO.
Thank you so much.
Thank you very much. Well, I think we're going to take a quick commercial break here. We'll come back in just a bit from now and chat with the management of PNB. It's financials and focus second quarter business update from PNB. So a chat coming up with Mr. Ashok Chandra in just a bit.
Welcome back. You're tuned in to Corporate Radar. Well, the next guest on our show is Ashok Chandra, the MD and CEO at PNB, who joins us on the show. Hi, Mr. Chandra. Good morning, and thanks a lot for joining in. Just coming to you in a bit. First, we'll just lay out the big focal points that we're looking at. Loan book growth to outpace guidance. Is that a possibility? The corporate loan book is showing some signs of revival, and also support from Treasury book to be visible in Q2 or not. That's something that we'll try to gauge. Mr. Chandra, thanks a lot for joining in, sir. Pretty impressive update is what you're put out there. So let's revise a couple of numbers. What's the guidance with regard to the loan book growth? Point number one. And if you could tell us, it's going to be led by retail. And are you seeing signs of green shoots in the corporate book as well? Give us an outlook on that front.
Yeah, good morning. See, I will not be able to talk about the Q2 numbers, whatever we have disclosed on the SEBI. I think it is already known. Let us wait for the final audit to come, and then we will disclose all those numbers. But yes, the guidance which we have given in this financial year, that is credit guidance, we have given 11 to 12%. I think definitely for the full year, I think we will be sticking to that guidance, and there will be some good momentum will happen. Deposit guidance, which we have given 9 to 10%, and already we have shown a good growth in the deposit, and we have already indicated what is the deposit growth that this quarter it has happened YOY, and it is more than 10.5%. I think the full year, the guidance which we have given 9 to 10%, definitely we are going to achieve those guidance. So I'm very much confident that the Q1 and Q2 put together and the full year, whatever guidance for the full financial year which we have given in the beginning of this financial year, I think definitely we will be going to achieve those numbers.
Mr. Chandra, we just had Tata Capital Management with us, morning Prashant here, and they're saying bumper third quarter, fourth quarter on the back of this GST cuts, especially consumer finance segments, SMEs, etc. Of course, I mean, for you, the book is much, much larger, but could do you echo that?
Yeah, I fully agree with that. And in fact, if you remember my discussion on the GST implementation on 22nd also, and when the GST rate cut had happened, on that day also, I had interacted with all of you. And I had indicated that it is a landmark movement that has happened in the GST space, the simplification and the rate cut which has happened. I think that is going to bring a lot of momentum in the credit portfolio in the various segments. And see, this is not the short-term effect. We need to look for the long-term impact of this GST rate cut. And I'm very bullish about the credit offtake, which is going to happen in the retail, agri, and MSME, because the GST rate cut has impacted all those segments. And second important factor is that many of the items which a household daily uses, the rate has been made zero now. So definitely the purchasing power capacity of the individual is also going to increase. And this impact has been to every citizen in the country now. So definitely that impact is going to happen. And we are seeing those impact in the retail, MSME and agri, all these sectors put together. In the 10-15 days span itself, good momentum has happened. And going forward, I think definitely there will be good uptick will happen in this entire portfolio.
Mr. Chandra, great to have you with us on the show this morning, sir. So retail, agri and MSME, I mean, these have been growing very well in the past as well. Your first quarter performance was very good across these segments. My question is now on corporate, especially in light of what the RBI did in the last policy, right? I mean, pretty historic steps. They have made it easier to lend to large corporates, removed some of those earlier 2016 restrictions. They have allowed banks to get into M&A financing in a bigger way as well. So what is your sense? Do you see any signs of pickup in corporate credit? And my question is really that the RBI is enabling banks to lend more to corporates. But there has to be on-ground demand. Just, loosening the framework won't help. Your thoughts on this?
I think RBI has done whatever is required to be done. And for the last 7-8 months, a lot of facility it has been given to the banks to go for the project funding and the infra funding and all. A lot of things have happened. And if I can talk about our bank itself, I had indicated last time also that we had a pool of 1,38,000 crore sanctioned book for the corporate. And this has further gone up now in this Q1 and Q2 put together. I'm very confident that the sanctions which has happened in the last year and this year put together, the size is very, very high. And my request to the corporates now, they should come forward and they should avail the facility. I think it is not, there is a dearth of proposals. Proposals are there, and that is the reason we have the good sanction book. Only thing is that the disbursements are taking time. To some extent, see, a lot of project funding we have done, project financing we have done, and there you know that it takes 1 to 2 years to take the full disbursement. That is one of the reasons why you are not able to see the impact immediately now. I think definitely in a span of 1 to 1.5 years, you will see the good impact happening on the project funding. And PNB is one of the largest banks in the country.
Yeah,
and
so absolutely. I mean, your words are very encouraging. So overall, you are expecting your book to grow 11-12%. If I were to ask for some sort of a reference guidance for the corporate book particularly, the growth this year would be what? I mean, mid-single digits. Can it touch double digits? If not this year, at least as we get into next year?
We are very hopeful, and the book size which we have, which is the sanctions pipeline and the proposals in hand, all put together, I am very bullish that definitely in the end of the financial year, definitely we should be in a position to touch double-digit growth in the corporate loan book also. I am very bullish about it.
All right, Mr. Chandra, a few other factors. When you join us, post your numbers again, we'll push you for some more numbers. But a few factors, PNB Housing Finance, that appointment, the new MD at the helm. When do we expect that, sir? The names are submitted, I believe. But when do we hear about that big announcement?
See, PNB Housing Finance Board they and the NRC, they are already running the process. I think you are all aware that advertisement was there and they had sought for the names and final selections are going on now. I think we are expecting that maybe by end of this month, I think definitely the board and the NRC should come out with the name now.
Okay, all right. So that's out of the way. We'll wait by the end of this month. So we've got a timeline at least. The other one is in terms of consolidation of PSU banks. Have you heard any directive that's coming from the center? Because that buzz again has come about. Even today I was reading a couple of papers and we as well have been reporting it, that there could possibly be some kind of more consolidation in the PSU banking names. You've heard something?
I think let us wait and see what it comes out. As far as I'm concerned, I'm not fully aware about this news item and this consolidation piece. So let us wait and see how the government proposes it and the DFS and the RBI, how it comes out.
All right, we'll wait by for that. And finally, the Canara HSBC Life Insurance, out there, that IPO, I think the date has been announced. I think you all have close to, PNB has around 23% stake in that entity. So you'll be offloading some stake. If you would give us rough clarity on what is the money you'll be getting from this and what is the quantum you'll be selling in the IPO?
Yeah, we have 23% holding in Canara HSBC Life and 10% we are going to dilute in that and the price band and the valuation all put together. I'm expecting in the range of around 900 crore we should get out of this, the selling now.
Okay. All right. Mr. Chandra, always a pleasure, sir, speaking to you. Wishing you all the best. You're sounding very optimistic about the core business. And you've given us some guidance with regard to PNB Housing Finance, consolidation, as well as the stake you'll be selling in the next IPO of Canara and HSBC. Wishing you a good day ahead, sir.
Thank you.
And looking forward to speaking to you soon. Well, we have got the markets to look back at. And gradually, we saw an intraday dip. But on the Nifty, that dip has got bought into. And the Nifty bank is holding its ground. It's gradually moving towards that 100 DMA, while the Nifty has moved towards that 20 DMA mark as well. The Nifty bank actually has taken out the 100 DMA. So now it's trading above most technical levels. Vinay Rajani joins us on the show. Vinay, what do you do? Take money off the table? Or do you say that this market is looking good for more? You'll want to trail your stop loss now on the upside.
Yeah, good morning and thanks for having me on the show. So it looks like that one should continue to do the trading in the on the long side in the sectors which have been doing good. As we have been discussing, the financials and Bank Nifty have been performing well. In fact, Bank Nifty has taken out its previous swing high well. If we see the Nifty is way below that the previous swing high. So definitely the sector rotation is going on. Some sectors are showing great amount of strength. So financials and banking is the space where we can see strength building in and some more gains can be expected from here as well. So yes, overall we are bullish on the stocks and sectors. And definitely Nifty is having a strong resistance at 25,020. It is not showing any momentum. But even if we have the Nifty as a long position, then we would suggest a stop loss at 24,880 in the spot, and we can expect it to go up to 25,020 odd levels in the immediate term. But Bank Nifty definitely looks better than Nifty, and one can trade long in the financial stocks.
Okay, Vinay, morning. What about individual names? What would you focus on?
Yeah, so in the private sector banks, City Union Bank is looking good to us. So around 219 one can go long. 215 should be the trading stop loss. On the upside, we can expect a short-term target at 226. The second pick we'll take from the financials, that is Bajaj Finserv. So after showing some running correction today, Bajaj Finserv has resumed its uptrend. So not only Bajaj Finserv, if you see Poonawalla, Bajaj Finserv, Finance, Shriram Finance, all these stocks from this particular space after RBI policy announcement, they have been doing good. And I think Bajaj Finserv is one of the stocks one can look at for the long trade. So around 20,301 can go long. 2,000 should be the trading stop loss. On the upside, we can expect a target of 2090.
Okay, all right, Vinay, we'll leave it there. Thank you very much for joining us. Those are individual trades coming through. Well, we're going to focus on Bajaj Finance. Once again, Gaurav is here with that update that the company put out. Gaurav, take it away.
Well, yes, when we look at Bajaj Finance, a strong update is what we are seeing from the company. Around 23.6% growth on a year-on-year basis in terms of AUM. And at the same time, let's not forget that management had also guided the growth to be in the range of 23 to 24%. So it definitely seems that they're actually achieving this number. And in fact, they're achieving this number at the upper end of the guidance. Apart from that, when we look at the customer base now, that has increased almost by 20%. Now the total customer base stands at around 111 million. And at the same time, they have also added new customers. Around 12.2 million new customers have been added in this quarter itself, which shows 26% growth on a year-on-year basis. Let's not forget this stock is also in focus because of all the GST reforms, and given that they have a majority of their portfolio in the retail. At the same time, when we talk about Bajaj Housing Finance, there also we saw a good set of numbers, around 32% growth in disbursements. AUM grew almost by 24%. So definitely both these companies doing well. In fact, when we look at Bajaj Finance, the stock is up more than 3% given that the numbers are strong. So definitely watching out a discounter specifically because of the strong numbers. So let's see how they are also delivering their ROAs in their results going ahead.
Okay, all right. Thanks a lot for that, Gaurav. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting. She'll tell us what's going on in the commodity space.
Okay, welcome back. We've got commodities in focus as promised. Markets up about 60 odd points, much better than the opening that we got at 9:15. Manisha is here with what she's tracking and what top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at precious metals as a whole because another day, another month, and we're looking at new all-time highs coming in for many of these commodities here. Well, I'll start with gold, and we're looking at all-time highs in the international markets, all-time highs in the Indian space as well. And with this, we have crossed $39.20 an ounce for the global markets in sense of gold there, and we are trading nearly 50% higher for this year. Now, if you look at the last couple of years, gold is almost doubled now in that sense in prices. Well, it has to be about a prolonged U.S. government shutdown, which seems to be impacting the markets right now. And then it has been about the U.S. Federal Reserve officials. Various speeches are slated starting today itself. And Thursday, you have Powell testimony as well coming in. And that is where the markets will take further direction from. If you look at the all-time highs in sense of gold, the first half of this year saw all-time highs being hit 26 times. In the month of September alone, we've seen that happen 13 times. And today, 6th of October, we've seen gold prices hit all-time highs 3 times already. So gold clearly on a run there. But it's not just about gold. Take a look at silver as well. And we are trading above $48 an ounce. 67% of gains coming in for silver as well. And markets have seen 7 consecutive gains in sense of weekly gains there. Also, silver is approaching $49.50 an ounce. This has been an all-time high. We've seen that happen twice already in 1980 and 2011, and it's happening again in 2025. Markets at this point in time is pricing in near 100% probability of a yet another U.S. rate cut for the month of October. And that really seems to be supporting gold and silver and then platinum as well, which has broken out of its 17-year consolidation. And we are looking at 12.5-year highs coming in for platinum there. And platinum clearly seems to be outperforming with nearly 82% gains in this year, with expectation that a third year of deficit in 2025 could be taking prices higher, and we could be looking at premium continuing into this space. Finally, I also want to talk about Bitcoin because we're looking at all-time highs into this one as well. $125,000 for a Bitcoin is where we are trading. 33% of gains in this year, and Bitcoin is up nearly 99% if you look at the last 12 months there. Well, clearly it has been about the U.S. government shutdown. That has been supportive. There has been this buoyancy that we've seen in gold and Bitcoin for most of this year, with an expectation that you could be looking at an outperformance coming in from Bitcoin for the last quarter as well. If you look at the spot ETF inflows, well, they have been quite high, the second highest since ETF was launched in Jan 2024. The weakness in US dollar, all of those factors continuing to support as well. So markets are looking at further gains coming in for precious metals and cryptos.
All right, Manisha, thank you very much for that. Poonawalla FinCorp up 8%, and that's the second quarter update, which I think has been put out this morning. It's a big, sharp. AUMs are up some 68% on a year-on-year basis, and about 15.5% on a quarter-on-quarter basis. AUM at close to about just under 48,000 crores. So very fast growth coming through from Poonawalla. And I think it's kind of technically also broken out after many months of consolidation, the Poonawalla FinCorp stock. We take a quick commercial break here. We're going to come back with our special segment, Indianomics. Lata in conversation with 2 former deputy RBI governors, H.R. Khan and S.S. Mundra. And they'll be joined by Suresh Ganpati of Macquarie Capital. And we'll discuss the new banking dispensation post October 1st policy. Stay tuned, coming up.
Welcome to Indianomics. The one sector that rallied last week in an otherwise ranged market were the banking stocks. After the Reserve Bank removed or proposed to remove a bunch of constraints and brought in more pro-market steps. The most important, according to me, banks can now fund corporates to do acquisitions. Second, the limit of 10,000 crore on total banking exposure to one group goes, that cap goes. Banks and their group companies can do overlapping businesses, which of course benefits a lot of people like HDB and, Canada Housing Finance. Risk weights or the amount of capital that banks have to set aside for home loans and MSME loans are likely to come down with the Basel III norms. And finally, very important, on the deposit side, premium to insured deposits won't be a flat rate. It will depend on how less or more risky a bank is perceived to be by investors. Now, to discuss how much banks and the economy will benefit, and also if the RBI has been too bold in removing some of the guardrails, I have with me two former RBI Deputy Governors, Mr. H.R. Khan and Mr. S.S. Mundra. And in a bit, we will be joined by Suresh. Okay, Suresh Ganapathy is there with us, the Managing Director and Head of Financial Services Research at Macquarie Capital. Gentlemen, good morning and thank you very much indeed for your time. Mr. Mundra, this deposit insurance marketization has not been discussed enough. Last week, we all went to town with this acquisition financing and this 10,000 crore cap. But the SBI chairman, when he spoke to us, said he spent 5,400 crore rupees in FY25 on deposit insurance and he expects it to come down. You think this is going to be a very big benefit for, SBI, BOB, HDFC, ICICI types?
Thank you, Lata. But I think, of course, this is a no-brainer. It's going to be an advantage. Those who are running their shop well, and when you do the risk assessment and risk level is found to be low, obviously, as it is proposed, the rate of premium would be low. So, it's going to be only one way only, that whosoever is working well is going to be beneficial.
But how much, sir? How much can it benefit? Any ideas?
Pardon?
How much can the benefit be in terms of lower costs?
So it depends on ultimately what kind of slabs RBI proposed to say come out with. But it could be even, I would say to begin with, it could be even 1/4 of what you are paying today.
Oh my God. Okay.
It could be quite substantial. Yeah, this is how it should be. Otherwise, it has no meaning.
No,
Having said that, Lata, let me quickly, is a great package. There are long outstanding demands and long overdue rationalization which has happened in this. Only there are a couple of areas where I feel probably is a kind of leap of faith by RBI.
Mr. Mundra, I'll come to that in 1 minute. Let me just finish this deposit thing because it is under-discussed. And I will come to where you see the leap of faith, which is a little scary. Mr. Khan, do you think the Reserve Bank has put this leap of faith even on deposits? I mean, are we not, for instance, the trouble that RBL went when Vishwa Rahuja left, or Yes Bank, or even more recently, IndusInd. Already these banks, private sector banks, they don't have the, the sovereign guarantee which public sector banks are perceived to have. And over and above that, there have been one case or the other. Do you think the RBI is being too bold with respect to small private sector banks on this deposit issue?
No, just before I talk about deposit issue, let me just quickly add one introductory sentence to what you say, slew of measures taken by RBI for the banking sector, and you said about banking sector rally. I think if you see the last few months, it has been a phase of simplification, liberalization and rationalization. Yes. And the whole concept is what is being called as optimum regulation, with bias for liberalization for the banks and ease of doing business. So this is in line with all those overarching principles. Coming to deposit insurance, I fully endorse my former colleague and friend Mundraji about this is a long-standing thing. It has happened. It's a good thing. But knowing the maturity of Indian market, one has to be a little careful about how it is communicated. If it is not communicated properly, there is a risk of run on some of the banks. So we have to properly communicate that and do bit of customer education about it.
Yeah.
Otherwise, but there could be some problem down the line.
It's just about 3-4 years ago, because of LVB, because of Yes, because of RBL, even unrelated banks like IndusInd suffered because people were just moving out deposits. So I'm a little worried that this flat one has gone away. Suresh, your thoughts on whether you will up the ante in terms of margins and lower operating costs for banks because of the deposit insurance. As Mr. Mundra says, it can be 1/4 of 5,400 crore for RBI, for SBI. That's a big deal. I didn't expect it to be so much. And are there more credit opportunities because of, acquisition finance?
Look, I mean, this is, if I were to really look where my analysts at and look at the overall numbers, at an overall operating expense level as well as at the overall PAT level, I mean, even if it is a number as large as 1/4, which I doubt, but could be the case in certain entities, it doesn't move the profit parameters in a big way, Lata. I mean, right? So it is not that my earnings have to be changed about 10-15% on the back of this particular issue. There would be some 2-3% impact on earnings coming from a lower deposit cost. Just one point here that I would like to mention for the benefit of audience here is that the way the scheduled commercial banks in India have operated, never in the history, at least the time that I have tracked, a single depositor has lost money when it comes to scheduled commercial banks failing. Because at the end of the day, the RBI steps in, a forced merger takes place, and eventually the depositor gets back the entire money, right? So there is never a single rupee of deposit that is lost. It happens in cooperative banks, not in scheduled commercial banks. Okay. The premium pricing has to take that factor into account because depositors have never, ever lost money in case of scheduled commercial banks.
Okay. No, my only fear is that the Reserve Bank has made life difficult for itself. We know that in Yes Bank's case, in several other LVB case, they went and looked for the buyer. Correct. They made life more difficult for themselves, is what I thought, especially for small private sector banks. Mr. Mundra, your leap of faith, I want to come to that sentence. Where are you uncomfortable with the removal of constraints?
Yes, Lata. I was telling, of course, I say great package, over 22 measures, and some of them were really long overdue. Some of them really had become outdated. But there are a couple of areas where I feel it more like a leap of faith. Of course, RBI, I'm sure RBI must have done its best. But having said that, let me just say, one thing, it seems from the total package that a lot of faith, a lot of belief has been put into the market mechanism and the board oversight. Now, as we all know, there is a sizable section of industry whereby, not by any motive, but by their whole construct, by their design, and also the tenure of leadership. Both the things, board oversight as well as market discipline, may not be equally effective on them or equally applicable to them as it is on the other section of the society.
Okay.
In that situation, how much could be expected from this discipline, self-discipline to come is something I think maybe RBI will have to keep supervisory antenna very, very sharp.
Which specific rule? Which specific rule are you referring to?
Specific rule would be difficult because how do you distinguish within an industry? But probably the level of supervision, constant supervision, those are the kind of things. At least in initial years, it has to come into play. Okay. That is one area. Okay. And second area, when it comes to M&A financing, again, it was a long outstanding demand. Nothing wrong in that. It opens an avenue for the banks. I am a little more worried about the aftermath of such financing. Yeah. Because if I go back to my experience with infra financing, what typically happens, let me tell you, that generally these are some of the large players who would be playing a major role in assessment and deciding the finance which is to be done.
Yeah.
Then it gets distributed among the smaller players also.
That's right.
Who normally follow the assessment done by the large
bank.
Fine up to that point also. The point comes later on because these large players, they have two things. They have a better capability to absorb the losses if they come out of this kind of financing. Or second, which I have seen in most of the cases, I think they have seen the early signs and they have been able to exit from the exposure.
Yeah, that's
they have distribution and all that.
Yeah.
While the smaller players, they continue to hold it.
Yeah.
And it's a temptation because if you can't go and do a large scale lending and all that, and if you have liquidity and you have to beef up the balance sheet, it looks like a very, very convenient avenue.
No, that's
so great level of underwriting, but I think if it is not sharp enough, then it was an experience. We have seen it. It's not a.
I agree.
I'm little worried about it.
I agree, sir. And that's my question to Mr. Khan as well. Are we sowing the seeds for the next AQR, sir? I mean, now things are brilliant. Low leverage, banks, very low credit cost, ultra low. We haven't seen those numbers in our lifetime. I'm sure you will know, your memories stretch back. But, if you get into, at this point, over 10,000, okay, that 10,000 crore I thought could have become 20,000 crore or 25,000 crore. Do you want to remove the cap altogether? Are we inviting trouble? And also, that little bit of a leg up we thought bond markets are getting, that also goes. So are you happy with this 10,000 crore cap going?
Oh, Lata, I have a vested interest here. I was part of the committee which had recommended that part of the borrowings by the large corporates, they have to move to corporate debt market because the whole idea is that the banks are getting overexposed and they are not really, they will have asset liability mismatch, they will have a skill gap. So let it be market mechanism to a certain point. That was the whole idea. And it has run for a while, but there has not been really any assessment. Actually, it was brought down from 25,000 to 15,000 and 10,000. As you said, possibly we could have increased the threshold and seen how it is working. So that is one area one has to look at, because the rationale given is that individual bank level, there is a group exposure limit.
Yeah.
So we need not so much worried about the system level exposure. But there could be some risk lying there. So one has to be very, very watchful.
Yeah.
On the merger and acquisition finance, I think this is their demand for a quite long time. In fact, you should know that it is not totally no. In fact, there is some element of merger and acquisition finance exists now. For example, if you want to invest overseas, buy a company overseas, there is a finance available from bank. And if there is a joint venture partner in infra project to buy out his share also, acquisition finance is available. But what is being done is a broad sweep. But let us wait for the draft guidelines. I hope they will maintain certain minimum level of equity from the promoter, because let there be no gold plating happening. But on the point of, just quickly on the point of what my friend Mr. Mundra said on board oversight and supervisory antenna, I think they are very, very important points. And if you are giving so much of relaxations in the board and corporate governance standards.
Mr. Khan, I'll come back with those details. We have to run into a commercial break. One word from you, Suresh Ganapathy. Do you think credit growth is going to sizably improve because acquisition finance has come in? I mean, banks don't know whom to lend to. There aren't even any takers. Will this open an avenue sooner rather than later?
Look, these things are good supply-side reforms in the longer run. In the near term, there is a significant demand issue, right? For example, a lot of these acquisition financing, Lata, in the private credit markets, if you look at it, happens at an IRR of 15, 16, 17%. Now, that's a portfolio that banks won't take necessarily, right? So you are looking at a reasonable chunk of acquisition credit which banks won't finance because it will not fit their risk appetite. So you have to look in that context. So while I'm not specifically put a particular number to this particular M&A related thing, but maybe perhaps a percentage point here or there could be an improvement in credit growth, but not more than that. Longer term, obviously, corporates are flush with liquidity, there is excess equity, capital markets are buoyant. So, and even ECB rules, for all that ECB rules have been relaxed. So why not? Corporates can move towards ECBs rather than relying on some of these markets.
Only it is coming at a time when the currency is on a slippery slope. But I guess once it stabilizes, that is going to be a very big source of financing. Quick break. We have lots more questions for our guests. Bazaar viewers, you will be watching Chartbusters. You'll get to watch the entire argument and show after market hours.
Shares of Bajaj Finance rise over 2% as the company's second business quarter update reflects strong AUM growth of over 23%. New loan bookings as well rise 25% to around 12 million.
Nykaa moves up after growth momentum accelerates in quarter two, driven by fashion and beauty segments, both of which see revenue growth of over 20%.
Avenue Supermarts slips around 3% as the company's second quarter business update disappoints. Brokerages Goldman Sachs also bearish with a sell rating a target of 3370 amidst weaker than expected sales growth.
Aditya Birla Lifestyle surges after a block deal sees nearly 6% equity change hands. Sources tell CNBC-TV18 that Flipkart Investments is likely to have sold the stake.
The Supreme Court will hear out the Vodafone Idea plea seeking relief on AGR dues later today. The stock trades with cuts of about 5% ahead of the hearing.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets are continuing the form that we saw last week itself. So the Nifty is up more than 80 points, almost at around the 20 DMA mark. The Nifty Bank up more than 300 points. It's crossed the 100 DMA. So it's a good-looking screen, Mangalam. It's a good start to the week. The bulls will want to drive on the advantage from here on.
We take that point entirely, Nigel. You know, staying above that 25,000 mark will be extremely crucial from a short covering standpoint as well. The markets are going from strength to strength. After opening mildly in the green, there was a slight dip. The dip was vociferously bought into and currently at the high point of trade for all the frontline indices. But around all of this, we do have a new listing. We have Pace Digitech. The shares listed at about a 2% premium to its issue price. Currently holding around, flattish, as close to the issue price as possible for that stock as well. Closer to 220 was the issue price, around 219. We have Mr. Rao Madisetti, who's the chairman and managing director of the company, now joining in. Thanks a lot, Mr. Madisetti, for joining in and explaining, or rather, congratulate you on the listing that has taken place. We understand your business a little bit from the red herring prospectus. What we really want to know is that this over 800 crore issue that you have, 600 crores will actually be deployed towards your energy segment. What will actually be the return on the capital that you invest in this business? What are the kind of asset turns that we're expecting? And how big do you expect this battery energy business to be over the next 3 to 5 years?
Yeah, thank you very much. And the IPO proceeds, we'll be using it for the battery energy storage system project that is underway in MSCDCL, that's Maharashtra. We have about 1,500 megawatt hour battery energy storage system plants that are to be deployed in the next 15 months. And we are working already on that. And this project will be giving us about 14% of IRR on the equity. And we do have the further backward integration in terms of project execution as well as the products that are going from our own factories. So put together, the IRR is going to be much better than the industry standards.
And what kind of revenue can you make from this?
Energy storage system.
Yeah.
It's an annuity model for 12 years, and the annual revenue is about 238 crores. It's a fixed fees model for 12 years. We'll be getting that much revenue. And also this energy storage system, which is actually it just started. I would say it's an emerging sector. It is coupled with the renewable energy to store it, whenever there is renewable energy in excess during the generating hours. And then we give it back to the grid during the other peak hours, probably in the evenings where the generation is not there. So that is the new business that we have diversified into, and we have a factory built in Bangalore, and that is producing 5 gigawatt hour battery systems.
Okay, all right. Hi, sir. Good to have you on the show, and congratulations on the listing. A quick couple of questions. So bulk of it, you're saying they're going to be using it for this BESS project with the Maharashtra government. So we've got that out of the way. You also reduced part of this 800 crores odd to reduce debt. So could you tell us what is the updated debt number?
Out of this IPO proceeds, 630 crores will be using it for this project, yes. And then the balance is for the general corporate expenditure.
Okay.
There's no debt,
no debt.
Much debt except some, we have some CC limit. So there's no debt on that. So this is majorly for the project and then for the general corporate expenditure.
All right, sir. You know, a couple of queries then. FY24 was blockbuster, while FY25 was more or less subdued. The numbers seem to be a little lopsided. So on a steady state basis, what kind of revenue growth could you guide the street for, if you could help us out with that? And since bulk of your revenues are actually coming in from governments, what about your receivable days, your working capital days as well? Where do you see that number stabilizing at?
Yes, FY24 was kind of, the major growth came from the previous year. FY23, we were about 500 plus crores. And we had jumped from 500 odd crores to 2,400 odd crores. And then we had stabilized at, the same figure around that in FY25. FY24, the major supplies have been completed as per the contract. So the numbers were shot up majorly. Whereas the FY25, it's more of the execution. So the execution, as you know, it takes time. So the numbers were, we could not grow beyond that because the earlier year was for majorly for supplies and the FY25 was more of execution billing. So that is why it was little, flatter. But we do have the project coming to end and other projects are in. Now this year, FY26 would be better than FY25. But
how much better, sir? What growth?
500 crores to, we are seeing a better growth and we would be, I think we'll be announcing our the FY and the H1 results also soon, so it would be better.
Right. If you could give us a sense on two things, how much better it will be, because FY24, FY25 was around the 2,400 crore mark. Do you see a jump towards 2,800 crore or closer to 3,000 crores? That's point number one. And secondly, you said that FY24 was strong because of a big order that you won in FY23, and over the next couple of years you had to supply on that order itself. Now that order is nearing completion, do you anticipate any other order wins as well? So what's your order book in hand right now? What is your expected order inflow?
Yeah, we have about 7,000 odd crores order book in hand coming from both telecom business, that's ongoing business, as well as the new business that we have entered into, the battery energy storage system. Both put together we have about 7,000 plus crores, and which will be executed over the next 18 months to 24 months. So we would see a strong balance sheet getting built over the next 2-3 years. And as we know, the most of our FY25 balance sheet was constituted by the telecom business, but in this year of FY26 there will be some recognized numbers would be coming from the energy sector, but FY27 we are hoping to have about 50% of the revenues coming from the energy sector. That's a new sector. And thereafter it would be even stronger. That's what we are anticipating.
Sir, your numbers are looking pretty good. You have a good amount of order book as well. The key concern I think the street will have is the dependence on government tenders and government orders, since currently it's more than 90%. And if I got that number correct, I think your working capital days is around 150 days. Are you comfortable at these level in terms of working capital days? Because cash conversion is going to be most important and the street will track that very closely. So please comment on this.
Absolutely. Yes, see, in a large project, what happens is there are milestones for the payments. Though we do the invoicing as per the standard tender conditions, whereas our contract conditions, that payments would come in only when there is a, that particular milestone has been hit. So what happens is that we raise the invoices for the contract obligations, but some of the, we will not be able to get the entire money against that invoice, whereas that will be coming in the future course, whereas it's a cycle, like, we keep getting the payments and then similarly the project billing will be happening. Coming to the working capital, we have done this 2,500 odd crores in the last 2 years without much working capital requirement. These projects are funded well. Point number one. The point number two is that it also comes with the mobilization advances. So with a small debt about 140 crores, which is the CC limit we have, and we don't have, other than that, we don't have any other, the debts on the books. So with that, we are able to handle such a large business. So that itself is the testimony that these payments are in line and they are expected as per the milestones, and we are able to manage our business with that.
All right, just a final question before we let you go. You said that, in 3 years from now, by FY 27-28, you will have 50% of your revenues coming in from energy, which currently is about 6% of your business. You have orders worth 7,000 crores in your hands, executable over the next 18 months, which implies that, you would do at least 3,000 crores in FY 26, with the remaining happening in FY 27 itself, because you have to execute the order books that you have in your hand. What kind of margins are you likely to do over the next couple of years? Because margins have seen a big jump. Last year, they were closer to 20%. Do you think this is a level that it will sustain over the next few years, or it can go higher from here?
We'll be sustaining that for the simple reason that we have the backward integration in our businesses, like, whether it's telecom or the energy, we have our own products. So that helps us in executing the projects in a better way in terms of profits and the performance. So we do see that the profits are going to be either maintained or improved further. So we see that particularly this energy storage, which is a new and emerging sector, and we are the front runners in this. So we do hope that our the top line as well as the profits are sustainable.
All right, take that point. Thank you, Mr. Venugopal Rao Madisetti, for joining in and giving us a detailed outlook on what your business is likely to look like over the next 3 to 4 years. Wish you good luck for this diversification, order execution, margin expansion and backward integration as well. But for today, celebrate the listing. Pace Digitech is up around 0.5%. Meanwhile, we'll take a short break, come back, get you more on the markets and stock-specific action on the other side. Stay with us.
Welcome back. Well, let's focus on the bottom of your screen. The government is weighing the resolution of Vodafone dues to bolster the UK ties. That's the news that's coming in from Bloomberg. The government is considering a one-time settlement. So that explains why the stock has seen a big recovery from the low point of the day. So that's the information we are getting from Bloomberg itself. The government weighs resolution of Vodafone dues to bolster the UK ties. So that's and they're considering a one-time settlement. We wait by it for further clarity, but for the time being, this is the information that's coming in on the Bloomberg wires. So we'll try to get some further clarity on this front. On that note, let's welcome Shivangi Sarda from Motilal Oswal Financial Services for a technical check. Hi, Shivangi. Good to have you on the show. What's your view? Markets have seen a good
talking
bounce.
About the markets, we've seen a relief rally and an excellent, momentum that has continued in the October series. We're recommending a buy on decline on both the indices. Of course, Bank Nifty is outperforming, but Nifty is no less. We are, touching the psychological 25K marks in the index. We're looking at 25,200 on the upside with a support of 24,850 levels for Nifty. Talking about Bank Nifty, we are, of course, now accompanied by the rally in the private banking space as well, earlier, which was started by the PSU space. We have surpassed a previous, hurdle levels, and we're looking at 56,500 as the next marks for Bank Nifty with a support of 55,850 levels as support.
All right, we take that point. Thank you for that. Shivangi, individual stocks, what do you have on your list? Because we are seeing some big moves on a few names which have news backing them. Fortis Healthcare, for instance, up now 6%. We're seeing good traction on Nykaa as well. A good update coming in the second quarter, up 4%. Angel One too has moved to the high point of trade. Any of these make your list of trades? And what are the others that you're recommending today?
So talking about stock-specific action on my radar, first up is Hindustan Copper. We've seen excellent amount of action in the metal pack, and Hindustan Copper has been one stock which has been resilient from the last 5 weeks. So recommending a buy here on Hindustan Copper. Now, of course, we've seen that the entire metal pack has been shining, and ahead of the festivities, we are recommending a good action to continue over here. So target would be 350 for this one with a support of 333 levels. And the second pick on my radar is the second pillar.
Sorry, go ahead. Go ahead, Shivangi.
Yes, Bajaj Finance is on my radar next up, and we have seen that a good short covering move can be seen here. So this one would be on radar for the next targets of around 1,050 with a support of 990 levels.
Okay, all right, Shivangi, thanks a lot for joining in. Wishing you a good day ahead. Well, it's time to slip into a break. Come back. We'll continue our focus on the markets and individual stocks. Vodafone Idea, by the way, has recovered from the low point of the day. We'll wait by it, though, to hear the outcome of the hearing that's scheduled in the next 1 hour or so. Stay with us.
Welcome back. The stock on our radar is Sammaan Capital, down around 5.5% right now. It's nearly down 10% from its pre-deal high of close to 170 rupees. So continues to see some selling and profit booking post the deal that was announced, where IHC would invest about $1 billion in the company at around 140 rupees per share. The stock seeing a sharp knock from levels of 170, to which it had run up ahead of the fundraising board meeting. But let's get you some more ideas for profit coming in from our colleagues at Money Control Pro. Today we have Anubhav Sahu joining with the stock. Anubhav.
We'll talk to you about HEG, which can be key beneficiary of anti-involution policy of China. So in last 5 years, China's domestic steel demand has come down by about 10%. Excess production was diverted to exports, which as per our estimate is about 13.5% of global production ex of China. Now, high supplies in the rest of the world impacted steel prices, and which in turn impacted the profitability of leading steel companies. Now, China has announced plans to cut steel production by 50 million tons. This, if implemented by itself, can reduce exports by 40%. Now, low steel exports from China directly benefits graphite electrode industry, as it means more revenues for electric arc furnace production, which requires graphite electrodes. Secondly, about 100 million tons of electric arc furnace capacities are under construction or getting commissioned. Now, this translates into additional graphite electrode demand, which equals 25% of current global capacity ex of China. Thirdly, strong demand for the electric arc furnace transformers in India can be seen as a key leading indicator for graphite electrode demand in India. Finally, potential upcycling US steel manufacturing augurs well for companies' stake in its US-based peer GrafTech. Now, among the risks to watch is a global slowdown. That said, valuations are reasonable and investors can opt for staggered accumulation.
Anubhav, thank you so much for that. We're 10 points away from the 25,000 mark on the Nifty, all 4 indices in bright green. So with that, we'll wrap up on this edition of Chartbusters. Thank you so much for watching. The team of Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Rima and Hormiz. It's a Monday morning, which is batting for the Bulls, and it's, I think, the third consecutive day of gains that we are seeing on the Nifty. The week has started on a strong note. We are very close to that 25,000 mark as well, just 15 points away from that. The mid-caps are doing well in line with the benchmarks. Bank Nifty is the one which is powering through 0.7% higher on that index. We have been getting a lot of quarter two updates, very close to the earnings season as well. We start on 9th of October with the big IT name. Across the board, actually, we are seeing some good gains come by. If we talk about the small cap index, that's doing well. I spoke about banking index that continues to be on the front foot. IT is the other one. Of course, Rima will talk about that in greater detail. But looks like it's a good start. We'll have to see whether that continue in that direction or not, because Friday we did see market close at the day's high.
Yeah, it's the twin engines of banks and IT performing. And for banks in particular, while TCS will officially kick off the earnings season on Thursday, 9th of October, post-market hours, we've got so many quarterly updates, right? And I think the thing that stands out from the banking pack is that the loan growth is fairly healthy. For Kotak Mahindra Bank, 16%. For HDFC Bank, about 10%. So, loan growth is healthy, and I think that's providing some cheer to the banking stocks on the whole. And TCS, of course, has been a rank underperformer on a year-to-date basis. The Nifty IT index has underperformed the index by nearly 25%. So, is the worst now in the price? Will this quarter see an end to the earnings downgrades? I think that is the question on everyone's mind. Recovery is elusive as of now, but at least will the earnings downgrade come to an end? But let's talk about individual stocks. That's the big picture, Hormiz. Banks, IT doing well. On the flip side, metals, PSUs, pharmas are a bit subdued. But what about stocks?
Almost every company that has come out with business updates on Friday or over the weekend, right? And some of them are reacting to it as well. And Avenue Supermarts is one of them. It came out with the updates. Brokerage is not very optimistic, at least those that we read since the morning. And at the lowest point of the day now, 3% lower on the stock. And the stock has declined on substantial volumes as well. It's the fourth straight day of losses for Avenue Supermarts. And if you take a look at the volumes as well, it's on a fairly high volumes that the stock has declined. You had 3.5 lakh shares that have been traded compared to a 20-day average of just 80,000 shares. Now, also for the fact that the 100 DMA is broken below that level now, 4327 is the 100-day moving average, and it is trading below that level for is Avenue Supermarts. The 200-day moving average is further down. Now, the other one, of course, on the downside is Hemisphere Properties, the worst performer on the small cap index, as the biggest single day fall that the stock has had on record. And you take a look at the number of shares as well, right? 70 lakh shares have changed hands today. 20-day average here is only 7 lakh shares. And the important levels on the downside, the 50 DMA is broken below that now of 150, and the 100 DMA comes up next, which is at 144. Hasn't done much this year, hadn't done much last year as well. So the 2-year returns for the stock is almost zero if you take a look at that. Now, the other one being Onward Technologies, that's the third one on the list today. That's on the upside though, bucking the trend of the other two losers. Third best performer on the BSE small cap index today is the third straight day of gains as well for the stock. The volumes today are already at the highest level since June, and we have had almost 2 lakh shares traded on this stock. The 20-day average here is only 5,000 shares, so significantly high volumes, broken well above its 50-day moving average of 321, and as a result of which it's moving above all of its key moving averages. The major story of the day, of course, being the hospital names, a slew of reforms being announced for these hospital stocks, and Fortis, of course, being in the news for its open offer as well. You take a look at the volumes at which they are moving. 19 lakh shares on Fortis, 3.5 lakh shares on Narayana, almost 30 lakh for Max Healthcare as well, and significantly above it's a 20-day average of close to 4 lakh, and almost 4 to 5 times higher as compared to their 20-day average. Back to you guys.
All right. Thank you so much for that list, Hormiz. Some interesting names there. But we have to talk about the big banking updates that have come by, pushing the Bank Nifty higher as well, and a lot of fundamental analysis there as well. Gaurav is joining us with that now. Gaurav.
Well, let's talk about HDFC Bank, the biggest private sector bank. Now, it seems that HDFC Bank is actually proving what they had said earlier, that in FY26 they will be moving in line with the market. So the advances growth that has come at around 9.9%. Remember, the system level growth is at around 10.4%. So it seems that HDFC Bank is picking its pace with the system level growth. Remember, this also reflects around 4.4% growth on a sequential basis, which is actually healthy. On the flip side, deposit that increased by 12%, that is also higher than the system growth. And at the same time, when we look at the sequential growth, that was at around 1.4%, and that is the reason why CD ratio that actually increased almost to 98.8%. Now this was a bit of a concern because management earlier said that they want this to come at around 85 to 90%. So definitely we'll watch out on that. Let's talk about Kotak Mahindra Bank now, because here also we saw a good set of numbers. Advances that increased almost by 15.8%, and deposits that also increased almost by 14.6% on a year-on-year basis. But remember, yes, what happened in the last quarter for Kotak Mahindra Bank? They reported good set of numbers, but during the results they said that the growth was largely driven by corporate banking, which is a little low yielding segment, and at the same time they also reported NIMs which were lower than what the street was anticipating, and credit cost which was higher than what the street was anticipating. So definitely we'll be watching out on these numbers, but specifically on the pre-quarterly updates, good set of numbers from the bank. Lastly, let's also talk about NBFC, Bajaj Finance. Now this came with a very good set of numbers. 23.6% growth is what it has penciled in for second quarter. Remember, they had already given a guidance of 23 to 24%. So it seems that they're actually acting at the higher end of the guidance. When we look at customer base, that has also increased almost by 20%, and the new customer addition, they've added around 12.2 million customers in this quarter, which reflects around 25.6% growth on a year-on-year basis. So definitely good set of numbers from Bajaj Finance, and as a result we saw market is also actually giving that to Bajaj Finance stock price. The stock is up more than 2% as we speak.
Indeed, and of a lot of these banking updates doing well for themselves, but slightly off the highs of the day, though, is Bajaj Finance, but doing fairly well, above the mark of 1,000 rupees. Gaurav, thank you for that. Now, the big story of the day has to be the revision in the CGHS norms, and that has led to all of these hospital stocks moving in today's trading session, and be it Apollo Hospitals, be it Fortis, and the impact on the hospitals, and that is visible in the price, of course, as you're seeing in the price action. Ekta is joining in to break that down for us, the norms and the impact that it has on the hospitals. Ekta, take it away.
Well, yes, hospitals are in focus because CGHS, which is basically the central government health scheme, which is for central government employees in terms of cashless payment in impaneled hospitals, their rates have been revised for the first time significantly since 2014. Now, the government has revised rates for nearly 2,000 medical procedures under the CGHS scheme, and the rate comes into effect this month itself. Many hospitals, or some of the hospitals at least, were refusing to take cashless treatment because of the receivables which were piling up, as well as the hospitals saying that the package rates were outdated and did not account for medical inflation since 2014. Now, hospitals say that this will be a positive change. They need to assess the revenue impact, but they are expecting cash flows to improve, and receivables, which have been improving, would probably sustain and improve going forward. Now, in terms of the companies or the hospitals that would be impacted would depend on the payer mix. For example, Fortis, CGHS revenue is around 4.3% in terms of the payer mix. Apollo, their exposure is around 9% to government. Max, institutional exposure is quite large at around 21.8%. Global Health is at around 18%, with CGHS probably hovering at around 10%. And Narayana is around 18% from schemes as well. And Yatharth too has a large exposure to the government schemes. It could be over around 30% in terms of the total payer mix. So overall, yes, it is positive in terms of the CGHS revision which has taken place. It is expected to improve cash flows, and receivables, which have been improving, should probably be on an uptrend for these hospitals.
All right, Ekta, thank you so much for joining us and explaining to us what this move means for the pharma and the hospital space. Let's slip into a short break. Up next, we'll focus on the crypto market with Manisha Gupta on the other side. Stay tuned for that.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. And this Crypto Corner, we're talking about the Bitcoin price rise. Remember, we are trading at an all-time highs into this one. So 2025 is something to write home about, because not just that we've seen a string of all-time highs come in for Bitcoin, but we also have seen the overall market cap gain quite a bit as well. But let's start with Bitcoin first. And 1,25,000 is now done. With this, we've seen prices gain up by nearly 33% in this year, and it's a gain of 99% when you look at the last 1 year or 12 months therein. It also has to do with the spot ETF inflows. Remember, Bitcoin ETF was first launched in January 2024, and this is the second time in all of this time that you have seen such strong inflows come in for the spot ETFs there. So strong inflows coming in, institutional adoption has been great. The retail buying also has been surging, not just in Asia, but various parts of US and Europe as well. And the weakness in US dollar index overall in this year clearly has been a supportive factor. So when you look at 2025, it clearly has been buoyancy about precious metals, alternate asset classes, including cryptos as well. And then you have renewed concerns about potential prolonged US government shutdown. That in turn also seems to be supporting many of these alternate asset classes and non-fiat currencies as well. That is where crypto gets its support from also. If you look at the overall data, the on-chain data shows $1.6 billion of a surge in sense of buying. This mostly is coming in from the US exchanges, and there's a premium as well building up when you look at US vis-a-vis other global exchanges in sense of crypto. So you know where much of that buying really seems to be coming in from. And as I was telling you, the overall crypto capital market is now standing at $4.2 trillion. So clearly strong gains coming in for that. But it's not just about Bitcoin as well, because when you look at altcoins, the rally therein also has been breathtaking. So while we are looking at Bitcoin gaining by 98% in last year, take a look at what Ether has done, or Binance, Cardano, Solana. So it has been anything between 60% to 140% of gains in last 12 months in what we've done in sense of crypto. The support clearly comes in from optimism regarding potential tax reforms. We're looking at weak US dollar index in this year, down by nearly 9%. That has been supportive. And then it also has to do with fresh geopolitics, the buoyancy in diversification in sense of other asset classes, tariff uncertainty, questions on Fed independence are some of the factors which have been supportive. The markets also are looking at the data points really, because when you look at the last 10 years, in the month of October, Bitcoin has averaged a gain of 21 to 22%. This October, markets expect is going to be no different. And you could be looking at Uptember, as it is called, continue in case of crypto there. There's an interesting statement or a report coming in from Deutsche Bank, which says that by 2030, Bitcoin will perhaps join ranks with gold in many central banks' official reserve balance sheets as well. So these kind of very positive comments coming in from various banks and brokerages also has been very, very supportive. But that's all the time that we have on Crypto Corner. Go for a break, come back with more markets and stock-specific ideas.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. This week also marks an important milestone in terms of the primary market action. 7 IPOs and they're going to raise a total of 30,000 crore rupees. The large ones will be Tata Capital, that's 15,500 crore. And tomorrow you've got LG Electronics also opening. So today, let's talk about Tata Capital. I think as of now, day one, it's already seen about an 18% subscription. We had a chat with Rajiv Sabharwal, MD and the CEO of Tata Capital to discuss about the company's growth, the strategy going ahead. Listen in to what he had to say.
We've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year. When you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
It's 25,000 on the Nifty and continuing the gains that we had in the last couple of sessions of the week gone by. And the intraday high today is 25,016, which is near and about the 50% retracement of the fall that we saw from the highs of the 18th of September till the lows of the 30th of September, which was 24,587. Rachna Vaidya joins in for a quick chart check. Rachna, good morning. Thank you for joining in. At 25,017 and 25,113, how important are those levels for the index? And if we do go past it on the index, where do you see the Nifty going next? And your stock calls for the morning as well.
Yeah, good afternoon, and thanks for having me here. Yeah, as far as Nifty levels are concerned, I'll discuss the levels from the future as we trade into that. As far as Nifty futures October is concerned, we could see a resistance in Nifty futures at around 25,150 and not before that. So there's a good amount of chance that we could be rising another 100 to 150 points from here on. And that is a probable swing that can be played by today afternoon or maybe tomorrow as well. And as far as support is concerned, 25,000 on Nifty futures would be a strong support to be kept in view while trading the indices on the long side.
Got it. What about individual names, Rachna?
All right. As far as individual names are concerned, one of the stocks that you would keep in view is IOC. IOC futures are trading at around 153 as of now. And if one can go long into this with a stop loss of say 151.5, then we could be probably seeing levels of 155 and 156 and in another 2 days to 3 days of time frame. And another counter that I like to keep my eyes on would be TVS Motors, which has also given a strong good upswing at this point in time for the day today, which has a probability of continuing as well. So 3514 is the level of futures in TVS Motors as of now. If we can sustain our level of 3480 over here as a stop loss and go long, then we have a chance of seeing levels of 3550 and 3570 in this counter in another 2 days of time.
All right. Thank you, Rachna, for joining us and giving us a sense of which stocks and are in focus on the back of some technical moves. Let's take a short break. Up next, we'll discuss the market fundamentals with Devang Mehta of Spark Capital Private Wealth. Welcome back. You're still tuned into Trading Hour on CNBC TV18. We are above that 25,000 mark. So let's get in Manglam. He's bringing us the latest trends from the F&O space. What's happening here, Manglam?
Well, it's looking very good for the frontline indices. In fact, the Nifty has been driven by two major indices. We have the Nifty Bank, which is outperforming. It's up 0.75%. And alongside that, we have the Nifty IT index as well, ahead of the IT results. That's, an index which is doing extremely well, up around 1.5%. So when both of them power it ahead, we have the Nifty, which is holding above the 25,000 mark itself. And that's important because, on the one hand, you have heavyweights like HDFC Bank as well as Kotak Mahindra, all of them on the back of good updates powering the Nifty Bank ahead. There is belief that maybe there's some sort of valuation comfort coming in the IT pack as well. And in crossing the 25,000 mark, the Nifty has gone ahead and actually crossed important levels as well. Between 24,900 and 25,000, there were important moving averages. We had the 100 and the 20-day moving average. Both of them have been crossed on the way up in today's trading session. And the Nifty Bank too, with its over 400-point move today, has crossed past the 100-day moving average. Now what this has done is this has given bulls some support to go ahead and ride the 24,900 put. So we've seen some traction out there. So 24,850 now becomes the new base for the frontline index. However, 25,000 call writers are still fairly active in today's trading session. And what we need to see is whether the Nifty sustains above that 25,000 mark, closer to 25,050 or not, largely because the 25,000 call has a lot of open interest built up. In fact, if the Nifty sustains above 25,050, then all these call writers at 25,000 ahead of expiry tomorrow will have to cover their positions. And who's to say the Nifty can actually go up almost 100-150 points from here on itself, provided it sustains at these levels. We've seen writing at the 2550 call as well. But there are a couple of points which do point towards some bit of overheating a little around that 25,000 mark. Why do I say that? Because one, even as the market's higher, the India VIX hasn't cooled off. So the India VIX is higher. And secondly, the put call ratio ahead of expiry tomorrow has moved to 1.3. This compares with 1.16. So it's moved to the higher end of this range. So until this moderates, we can't see a big spike upwards, but we'll have to watch out for that. A lot of individual stocks are fairly well bid today, so a lot of long positions added on Fortis, Nykaa as well as Delivery. But keep an eye out on HFCL, Samman Cap and SAIL. All of them are flirting with a 95% market-wide position limit mark. If it does cross and close above that, then these stocks are likely to go into F&O ban.
Likely to go into F&O ban. Samman Capital out of the ban today, may enter the ban again. It's down another 6% today after that 5% fall that it saw on Friday. Perfect sell, the news trade playing out here on Samman Capital, 6.5% lower there on the stock. Devang Mehta from Spark Capital Private Wealth joins us now to take this conversation on the markets forward. Devang, good morning. Thank you for joining in. What do you make of these financials, the business updates that have come out? Loan growth in excess of 15% for most of the lenders who have come out, big or small. And is this the sign that loan growth in the system has finally started to pick up, bracing yourselves for a good second half?
Good morning. I think, yes, thanks for having me on the show first. And yes, it's good to see probably the festive demand coming back to the fore. And this was sort of predicted by a lot of people when government let loose a lot of things on GST. And secondly, I think also the income tax benefits which were given in the last budget have also come to the play. Yes, RBI cutting rates, enough liquidity into the system have also come to play. Finally, yes, financials, we have been sort of advocating the theme of credit growth. I know it's probably a lot of underperformance by banks over the last 3-4 years, which now seem to be probably having a little bit of pent-up demand for financial type of companies, which are banks, particularly private banks and NBFCs. Yes, the loan growth was quite encouraging, and I think this is just seems to probably be the start, because what happens is September, I think if the Navratri demand is probably something which people go by. I think that's just been of 7-8 days of demand last month, September. October, yes, has both Dussehra and Diwali. So probably the updates that would come in the January month of October, November, December quarter, there I think the positive commentaries, management positive updates, positive even numbers, I think that would start reflecting. My sense, it's too early to predict that whether it's time that the credit growth has come back with full force. Difficult to comment, but I think with the loan growth, with the deposit growth, with credit growth, all this coming back, Bajaj Finance, I think 24% AUM growth, HDFC and Kotak Bank in excess of double digit, I think Kotak particularly 15-16% are encouraging signs. I think as financials, all these companies can come back to the fore, the sentiment improving, the intermediaries will also come back. I think yes, positive so far. and probably markets have also gone through a lot of time correction for a year, and also a bit of 5% price correction since the September highs last year.
In that case, Devang, I wanted to understand what is the expectations from earnings this time around. The expectation was maybe we'll not see that strong earnings growth in this financial year itself. But Q2 has seen some updates coming back which have been positive. What's your take?
Markets will be positively surprised, Sonal. What will happen is everyone on the street was sort of saying that this quarter wouldn't be great, and I completely still agree with that. This will not be a great quarter. This will be a quarter where you will probably want to listen more to management commentaries and comments about how the industry is shaping up. The initial GST-led consumption demand, at least for the discretionary side of it. You also want to see execution capabilities and sort of order books for the capex-related companies, and also the banks as a space is again sort of gaining momentum. Typically, I think IT is where people have sort of receded their hopes, and that is where I think, yes, most of these companies are at a 52-week low. So bad results would also sort of not give them a knock. But yes, maybe are they value buys? We still have doubts. But to answer your question on the result season, I think still I maintain that the third quarter numbers, the October, November, December quarter, which has already started, I think the numbers which come in Jan, Feb, March, there you would probably start seeing some bit of upgrades, because what's important is we are somewhere near the beginning of the end of downgrades. So my sense, this quarter should be okay, but next quarter we'll start seeing sort of good results across all the spaces. That's I think the call that we are taking.
What about autos? Where, the festive season, everything that we hear from the ground seems to be that it's been a good festive season. The GST rates are really helping demand. But how much of that is already in the price? I mean, is it a buy right now, auto? And if yes, which one?
Yeah, Rima, I think very clearly the move which has happened, and I know it would sort of sound repetitive, is more structural, right? So what has happened is a couple of things which came down for the economy. One, very importantly, the GST-led demand resumption, or GST rationalization, if I can put it that way, that has sort of given ample headroom for people to spend, not only during the festive season, but I think whoever probably wants to sort of consume a little, sort of go up the curve, right, which is the theme that what was earlier luxury is now becoming more and more necessity. So I think that demand is coming back, and that is demand which is more people going up the pyramid. So my sense that this is not going to be just a festive phenomenon. Of course, this type of sales you will always observe in India during the festive season, be it Dhanteras, be it Diwali, or be it Dussehra. But ideally, I think my sense tells me that there was a lot of pent-up demand for auto. I think if the pricing is going to be okay, and if the season continues well, if I think most importantly, if the monsoon which fared well, there is rural consumption which is coming back, and most of these companies also sell their cars now, even SUVs and hatchbacks and sedans in the hinterland of India and in the semi-urban cities of India. So my sense, yes, this demand is here to stay. Structurally, I think auto has sort of changed gears. Yes, short term we don't know. Yes, there have been a lot of run-up in these prices, but companies like Maruti stand to benefit a lot.
Devang, there has been a rush of IPOs on the street. Have you looked at any of them? The recent ones, Tata Capital has opened today, WeWork opened on Friday, LG opens tomorrow, Canara Robeco opens on Thursday. Have you looked at any of them? Is there anything that you like among them?
I think, see, the general sense that I can give about it, I have not gone into detail of all of this, but the sense one gets is there is good quality paper which is coming to the market. Yes, of course, with good quality, there will always be certain qualities which will not be so great. But most of these companies are now coming to tap the market. There is enough and more demand for Indian paper. And you know that probably while we talk about the absence of foreign institutional investors, they've been probably buying some of these companies as even being anchors or buying some of this IPO. And also Indian domestic institutional investors have been sort of lapping up some of these good companies. My sense that one needs to be selective, particularly advising for HNI and retail. One needs to be selective, can't just jump on the bandwagon because there are so many IPOs coming. But yes, mostly what I say is 70-80% paper which is coming to the market might still be offer for sale, where the promoters might be liquidating or the PE agency might be liquidating. So one has to do a lot of due diligence. But ideally, yes, if I think if I'm going to say one word, the quality of the paper is good.
Okay, all right. Devang, any other theme that you're liking currently in the market?
I think, yes, we've generally been bullish on two spaces. One, credit growth and capex now, with also consumption taking sort of a positive vibe. My sense is that a combination of three themes, capex, and why capex still, I know a lot of people probably talk about moving from capex to consumption, but the first mile proxy, right? While you do a lot of consumption related stuff, while your credit growth rises, I think corporates are going to expand on domestic centric stories. So a lot of this engineering related businesses, a lot of this semiconductor allied, a lot of power ancillary businesses, pure play stamping, lamination, casting type of businesses, even auto ancillaries, all these companies will also come to benefit. I know, yes, there was a hibernation period while consumption and credit growth started to go up. My sense this quarter will also be good for companies which are into capital goods, ancillaries, those type of execution, and order books are also, we are seeing a lot of ramp up of order book and execution capabilities also coming back to the fore. So my sense, yes, a little bit of capex theme should not be forgotten. These are also companies which will do well while consumption and credit growth do well.
Devang, thank you for sparing time and joining us today. Looking forward to having you more often on the platform. Take a short break. On the other side, on our special segment Under the Lens, Sonal focuses on the stock is ISMO.
Welcome back. It's time now for our special segment. All right, we'll get to Sonal and Under the Lens in just a bit. For the markets per se, continues to hover around the 25,000 mark, higher for the third day in a row. It's a 100-point gain on the Nifty. Banks continue to outperform. The Nifty banking index is up close to about 0.7%. IT has been a big outperformer. Let's pull up some of these large cap IT names to see the kind of gains. TCS is going to report numbers on Thursday. The expectation is muted, just about a 0.2-0.3% top line growth. But because of the INR depreciation of about 2-2.5% in the quarter, the company's margins may look better. So the expectation is that there will be some margin improvement. And also remember, TCS had deferred the wage hike. Typically, it gives it in 1st of April, then they deferred it, and that kicks in now on 1st of September. So even the margin impact because of wage hike is going to be split across the 2 quarters. So the street will watch for what they have to say about those 12,000 employees that they had to lay off, and also on H-1B visa. But as promised, now let's go across now to Sonal for our special segment Under the Lens.
Thank you so much for that. Well, the stock on my radar is ISMO today because that stock has been on quite a ride lately. If you look at the last 1 week, the stock's been under pressure. It's hit lower circuits for 3 straight sessions, down nearly 18% this week. But this comes after a massive run-up because the stock was up 86% in August and 90% uptick in September itself. What does the company do? It offers high-tech automotive e-retailing solutions across North America, Europe and Asia. Their client list includes some big global names: Sony, Audi, Nissan, Ford, Honda, Hertz, Suzuki, Renault as well. The business is spread across 3 key segments: ISMO Studio, which is their interactive media arm. There's ISMO Auto, which is digital retail and CRM platform, and Frog Data, which is an AI and data intelligence platform in the company. On the shareholding side, promoters hold about 35% stake. The public holds majority of the chunk, 64%, and there's no institutional holding yet. Let's take a look at the numbers. Revenues for Q1 FY26 came in at 57 crore rupees. For the full year, that's been steadily rising. 132 crores in FY22, then around 154 crores. It reached levels of 225 crore rupees in FY25, and in Q1, it has come in at 57 crore rupees. EBITDA stood at 10 crores in Q1. That was 39 crore rupees in FY25. Now, do remember, margins are currently around 17 to 20% for the company. Profit after tax has improved, 16 crores in FY22, rising to 49 crore rupees in FY25. But remember, that is largely led by higher other income in FY25 at 35 crore rupees. Return on capital employed, that remains modest, 8% in FY25, which compares with 10% earlier and 7% at FY22 as well. Let's talk about the commentary coming in from the management. Post Q1, they said that growth is being driven by new clients in the US and Europe, and the company has also entered the German market. They're guiding for 25 to 30% revenue growth in FY26 and are aiming to expand margins to 35 to 40%. Now, that's a big ask they have now. Another key update is ISMO plans to sell a stake in its AI arm, Frog Data, by the end of this fiscal itself. That is what they said in the conference call. They expect positive EBITDA contribution from new segments starting Q3 and Q4 itself. The company has also forayed into the semiconductor sector through its wholly owned subsidiary, ISMO Microsystems. They'll offer system and packet solutions from a new manufacturing facility in Bangalore, and they're targeting revenues of around 200 crore rupees in the next 3 years itself. A few concerns though. Debtor days, they've gone up to 161 days in FY25 from 110 days earlier. If you talk about the cash flows as well, cash flows from operations have declined from 31 crores to 4 crores in FY25. The company says the debtor days increase is because clients like Hertz and Avis, they are taking longer to make payments, and it's also linked to new business incubation cycles. On taxation, the management noted that tax rates remain low due to tax shields in overseas subsidiaries. India remains as is, but they have declined to share more details, calling it confidential. At current levels, the stock still trades 69 times FY26 earnings. Now remember, ROE, ROCE is weak. Other income contributed to a chunk of profit in FY25. Operating cash flows dipped sharply in FY25. Growth CAGR has been 17% for the 5 years. Yet it trades at lofty multiples due to hot sector presence, which is basically AI and chips. But does it have the competitive edge in these segments? Do these justify the valuations? That remains the big question.
Remains the big question indeed. 86% in August, 90% in September. Well, ISMO indeed our candidate for Under the Lens. We'll take a short break and more on the markets on the other side. Stay tuned. Welcome back. Still finding some resistance at that 50% retracement level. So we have cooled off slightly from the highs of the day, ever so slightly. It's still 90 points higher on the index. The broader markets doing fairly okay for themselves as well as we wind down on this edition of Trading Hour. From Arima, Sonal and me, thank you for watching. Halftime report on the other side.
A slew of positive business updates leads to some optimism, but the market breadth remains negative. Financials and healthcare lead gains, while metals and consumer durables drag. Fortis Healthcare gets a thumbs up from the SEBI for a long-stymied open offer by parent IHH, while another boost for all government empaneled hospitals comes in from an upward revision in the central government health services rates after 14 long years. Tata Capital's 15,500 crore rupee IPO opens following a strong response from anchor investors. CEO Rajiv Sabharwal expects third and fourth quarters to be bumper quarters. The company sees margins improving as costs dip with digitization and AI deployment. Business updates by top banks and NBFCs point to a strong credit growth in the second quarter, with lenders like PNB indicating optimism in corporate credit growth going forward. Small finance banks also see recoveries in microcredit rise. Gold skates to a new high, above $3,900 per ounce, even as the US shutdown adds fuel to the rally. Bitcoin tops $1,25,000 for the first time, even as ETF inflows surge. Even silver scales to a new high in India and nears its record mark globally. It's all guns blazing. It is a green screen that you're watching here on Halftime Report. I'm Mangalam Malu, and with me, Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. Looking good for the markets. When we say a green screen, and I'm not referring just to Vinny's jacket, but, you know, all in all the frontline indices, the Nifty around that 25,000 mark. An important milestone has crossed the 100 and the 20-day moving average, led by both its engines, the Nifty IT index as well as the Nifty banks. Midcaps, what are they doing? The index is up around 1/3%, with more stocks advancing than the number of stocks that are declining. All this actually led by good slew of updates coming in from the second quarter as we move towards the festive and the result season. So it looks a lot more comfortable than the uncertainty that we had in the past couple of weeks. Despite that, we saw a 1% gain in the last week. So let's see what this bring and the next few weeks bring for us. Hi, Vinny. Good afternoon.
Hi, Mangalam. Good afternoon. So obviously, it'll be interesting to see this 25,000 is going to be key, right, if we move forward from here on. But today, obviously, like you said, green screen that's coming in, and a lot of leaders today coming in from the hospital side, a lot of movers because of their Q2 updates as well, whether the positive side or the negative side. We're seeing a lot of moves because of the Q2 updates. Earnings season is just around the corner. We're waiting out for details coming in here. But an important update I want to highlight coming in for the hospital sector, and one specific company there is Fortis Healthcare. Let's keep an eye out on that. Now, the SEBI has granted an approval to IHH Healthcare to proceed with that mandatory takeover offer of 26% stake in Fortis Healthcare and Malad Hospital. This is following a 7-year delay. That was the major part, right? The 7-year delay that came in. Now, because of that, obviously, the rate at which the open offer was going to be taking place was different from what the current price of Fortis Healthcare is. Today, also look at it. Fortis Healthcare is holding on to gains of 6%. And this case was going on for a while, so much of a delay that we're seeing coming in here. Now, to talk to us more on this, what does this mean? Could there be furthermore any situations that could come in, or furthermore, one could go to the Supreme Court and say that, no, we still want to hold this. How does this work? What is the further outlook going forward from here on is what we're going to be understanding today. And to discuss that, we have Hetal Dalal, President and CEO of Institutional Investor Advisor Services, as well as Sriram Subramanian, founder and MD at Engovern. Hetal, as well as Mr. Subramanian, good afternoon. Thank you so much for joining us on the show. Hetal, let me start with you. This is such a big update that's come in, but there was a significant delay, 7-year delay. The price at which they wanted to go for the open offer was 170. Now today at 1,000. How does this merit in terms of clarity of pricing? Is there possibility that they could apply for new pricing? How does this go about? Or is there further legal recourse which could take place, which could lead to a further delay?
So good afternoon, everyone, and thank you for having me on the show. It is indeed unfortunate that it's taken 7 years for IHH to have to complete the open offer. And it's certainly costing them a lot more than it did at the time that they actually emphasized the transaction. In fact, I would argue that they are now paying for the value that they themselves have created in cleaning up the entire act and trying to get Fortis up and running, given the condition that the company was in at the time of this particular transaction taking place. I don't know, honestly, even if they do get a sort of exception and say that they're going to go back to that price, if the open offer will be successful, because today shareholders will tender only when the price is right. Given that they currently own about 31% of the equity, going to above 50% will certainly be their goal. And therefore, I think while it is indeed unfortunate in terms of the price movement for IHH specifically, they've been very focused on getting that controlling interest in Fortis. And to that extent, it's also good for Fortis that there is this whole overhang which has now gone away. Once the open offer closes, IHH is very specifically in control with a more than 50% shareholding. And therefore, from the perspective of the company itself, I think this is a good sort of development.
But what a lost opportunity for IHH, right? Because, I mean, they wanted a lot more of the stake of the company. And because of, like you said, the value that they have themselves created, they're forced to pay a lot more for that or offer a lot more for that. And they're not sure of getting, tendered in at a higher price as well, even if there is an exception. But let's ask Sriram. Sriram, because of the kind of, interest that there is from the PEs, etc., in the hospital space right now in India, and after the kind of value creation that we've seen for whatever little stake that IHH had, do you think that they can go ahead and sell it to some of the PEs given the sort of interest, instead of taking more stake right now with an open offer and all of that, just exit the 30% that they have? Or do you think it'll be prudent for them to continue to hold on?
Good afternoon. I would think the hospital sector in India and the healthcare sector is still a long way to go in India. If you see the coverage in tier 2, tier 3 towns, even in tier 1 town, cities, etc., the coverage of corporate hospitals is still, the market share is 30-40% only. So I would think there's a long way. The India healthcare opportunity is very big. So I would think IHH, being a strategic investor, will continue to stick there. I don't think they will want to sell to any financial investor or so. And coming back, our choice of words is also very important. See, it is not that IHH, this is a mandatory open offer. So even 7 years ago, it was a mandatory open offer. So one doesn't even know, even at that time, whether shareholders would have tendered to the 170 rupees. Even to this day, it is a mandatory open offer. SEBI, because it is not the fault of the company that it had been dragged to court and the SEBI had put the approval on hold. So from that perspective, it will launch a mandatory open offer at 170 rupees. It's not, obviously no shareholder is going to tender now that the stock price has run up beyond 1,000. So I think IHH will just continue to hold its 31% shareholding, and it is in control of the business. There is no compulsion to sell off. The growth rates and the future for healthcare in India is positive. So it will be status quo from that perspective.
Right. So Hital, what happens now? It was a mandatory open offer. It just becomes a legal formality now. How does it change things for the business of the company? I mean, it's been doing well so far, no problems, and now added benefits coming in from the hospital, for the regulators, also for the hospital space. Do you think this becomes a non-issue now and it's business as usual?
It's been business as usual for a while. I think the only thing that really changes is that because the company was under this continuous open offer for 7 years, they had to come to shareholders for approval for every small sort of transaction they want to undertake. I think that the compliance and burden sort of goes away now if once the open offer gets completed, and therefore sort of reduces to that extent, some of the shareholder approvals that the company will need to seek. But that's more sort of operational issue and a compliance sort of cost issue. I think business has been good. The company is under IHH control. The question is, will they move to a 50% equity or not, which gives them dominant control? And that gets driven, as Sriram rightly says, by the current prices, whether they want to up their investments and actually pay for what they've been able to create. It's not a non-issue. I wouldn't say it's a non-issue per se. I think that open offer will help them increase equity, and that's always helpful. And I think to that extent, we'll have to wait and watch in terms of what the price is. See, today the price has not been announced by IHH. Now, ICDR pricing will of course apply, and therefore it will have close to market price unless they get an exception. But if they're really intent on increasing their equity, they will have to give a price which is going to be attractive to shareholders, and that's going to be interesting to see.
Absolutely. A price that is going to be attractive to shareholders will be key, right? Because then that will be a deciding factor as well. Mr. Subramanian, from an institutional investor point of view, if I'm looking at it, what does it mean for them? Because there will be large shareholders there. How should they be viewing this scenario? And in terms of any pressing or, information that they should furthermore focus on, given that there could be a revaluation in terms of prices? How should they look at it?
No, as Hetal said, only this open offer overhang is gone. So it's a positive for the company, and institutional investor, however they would have viewed it before October 1st, is how they will view it now. I mean, healthcare sector is booming. In fact, the free float of the company, because IHH owns only 31%, means that there is 69% free float. So from that perspective, it is fairly amenable for institutional investors to build up huge equity and sell off whenever they want to, etc. There is a lot more liquidity out there. So from that perspective, it's a very positive for the company.
All right, hold on to your thoughts, Hetal and Sriram. We'll just come back to you in a moment. Meanwhile, important updates at the bottom of your screen. This is with regards to the AGR case for Vodafone Idea, which was there in the Supreme Court. What we get from our colleague Ashmit is that the hearing has been adjourned and postponed to August 13th, or rather will happen on the August 13th right now. As,
August 13th?
October 13th, I apologize, October 13th, as the government has sought more time. It was deferred the earlier time as well, brought to October 6th, and now moves on to October 13th as the government has sought more time, and which is why we're seeing the stock come off once again from the highs of trade. Remember, this morning there was a news coming in from Bloomberg that the government was perhaps mulling a one-time settlement to improve ties with the UK. On the back of that, there was a spike from the lows on the counter. But then again, the fact that there has been a deferral in this case itself all the way up to the next week is something that, has the street a little less more aligned on any direction. And some of those longs are currently coming off. We'll get Ashmit for more details on this one. But for now, what we have is that there has been a deferral and the stock is off the highs. Let's get back to our conversation. Sriram, the other big positive that has happened is that the regulators, the government has actually gone ahead and revised rates for, the hospitals that the governments would be clients for after 14 years. How big a positive do you think this is for the space, and which ones would you believe would benefit? Because while government is decent enough business for some of the hospitals, the question is, there's also a lot of working capital that goes because there are low margins or maybe payment delays.
Yeah, obviously this is a big issue, even with the Ayushman Bharat kind of a scheme where hospitals have a lot of receivables from government. So the private hospital chains which are listed are largely defocusing on the government as this one, though it's a regulatory mandate, only they deal with cases that come to them. They don't go in search of those cases. So from that perspective, I think it's neutral for all the listed, though many stocks have run up, including Max, Fortis, etc. Fortis probably because of this open offer approval, but other, as you show on your screen, Max, Narayana, all stocks have run up 3-4% today, but Aster, DM, etc. But I think it's a neutral from a perspective of government, I would say revenues and focus, etc. Those are not revenue and margin drivers for the hospital chains.
Absolutely, interesting take there. So Hetal as well as Mr. Subramanian, thank you so much for joining us this afternoon, explaining us about Fortis, what it means in terms of pricing, what we're keeping an eye out on. So thank you so much for that. But with that, we're actually going to slip into a very short break, viewers. Remember, you can tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impacts on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Halftime Report on CNBC-TV18, where we ended. That's what we'll start with, right? The hospital space and the healthcare space, where the government has announced the long-awaited revision of the CGHS rates, now updating prices of nearly 2,000 medical procedures. This will be the first major overhaul in over a decade. We have BS Ajay Kumar, Executive Chairman at Healthcare Global Enterprises, joining in with us to talk to us about what this means for Healthcare Global company itself. What does it mean for the sector as well? Thank you so much, sir, for joining us this afternoon. Let's just start by talking about one in terms of the revenue exposure y'all have from these CGHS schemes or the PSU schemes that you talk about, and what would be the uptick in terms of revenue now that we could see if this actually once this goes through?
First of all, a small correction. I am only a chairman now. I'm not executive chairman.
Got it.
And the second thing is, yes, I think it is a step in the right direction. And definitely, particularly in a field like cancer, I think the cancer patients who are under CGHS will definitely benefit. But we are still looking at the details of this. What will be the impact of this? I'm sure it will be positive, but what kind of a positive impact we'll have, we'll only know when we look at the details. For example, oncology is very complicated. We have to look at chemotherapy rates, drugs. We have to look at radiation and what is the reimbursement for surgery, which has been the key point in the past. Surgical reimbursement has always been less. Are they going to make it up? Because oncology has changed dynamically. And by making these changes, what they are doing, I'm hoping CGHS patients will get the right treatment at the right time, and they will not have to pay cash out of pocket. And that is the whole idea. And I will take it even one step further. If this works out, I hope even other organizations like ESI, ECHS, everybody will follow the trend to see how to make sure somewhat of a uniformity will come in cancer care to all sections of the society. That is what we are looking at. Even state schemes should follow this, which will tremendously benefit the cancer patients in the country, and it will make us come towards more of an advanced country.
Sir, could you just help me with a number for Healthcare Global? What's the exposure from these CGHS schemes in terms of revenue?
I have to look into that. I'm not sure exact numbers. Okay. I can let you know on that, but it won't be. It depends on each cities and where we are CGHS, so it varies from city to city.
If you could give us just a broad number and not an exact number, because we have some of them. For Fortis, for instance, it's 4%. Apollo, it's about 9%.
Also, again, don't hold me to that. It may be in the region of 5 to 6%.
Got it. We won't hold you to that, but 5 to 6%. And what exactly is the difference in average revenue per occupied bed for CGHS versus the others?
Yeah, I don't know the numbers. I can really supply you that one. Say no.
No, but I mean, the reason why we ask is because while it may be 5 to 6% of your business, 5 to 6% of your business will have at least a revision of, 8 to 10% basis all the things that you're operating upon. So that's a decent uptick on the similar cost base, right? So that may be slightly margin accretive. So from an investor standpoint, that's what we're trying to understand, even though the goal is there should be affordable cancer care, timely cancer care, and good cure for everyone who is, God forbid, detected or contracted with this disease. So we understand the human aspect of it, but from a listed company standpoint, I'm sure this could ease some problems on the operational front.
We will have to ask our management to do some homework and come back on what will be the real impact, because the news is so new. So we need some time, but certainly it will be positive. And to what extent is, as we always say, the devil is in the details. We have to look at what are the verticals under oncology are going to be paid more, and based on that, we can let you know once we do our homework.
Okay. Sir, one more point. While there are some concerns that have also come in the past is, the receivables from the scheme also, right? There were certain concerns that there were delays. How much is your amount that is currently due from this CGHS scheme? Any indication on that front? And are there a lot of delays there that you see normally in terms for the company receiving the money?
I think it is not where, from my knowledge I have of the past, it is not a huge amount, but there is definitely a delay. Average delay may be close to 6 months, but that was in the past. I certainly don't know the recent part of it, whether they have improved, but I can let you know once we do our homework what will be the difference.
I'd request you to, once the exercise of understanding this impact is complete, you also upload that presentation on the exchanges so that will benefit the larger set of the audience. If not, you can join us once again here and give us those numbers.
I will certainly ask our CEO Manish to do some work on that, and maybe he can be on your TV to explain in detail.
Definitely, makes sense. But if you could also give us, an understanding of, barring CGHS, are there any other PSU schemes that you have exposure to? How much would
we have exposure in some sections to ESI?
Okay.
We do have exposure in some ECHS. And of course, the big exposure in because we are in the tier 2, tier 3 cities to the local schemes, state schemes under Ayushman Bharat scheme.
Right.
So that there is an exposure, but our overall exposure comes in the region of about 20-25%.
All right, 20-25%, of which 5 to 6% is CGHS. The rest would be all the other schemes. So now the question is, now that there has been a revision in CGHS, do you believe this makes a case for you to appeal to all the other authorities for a price revision as well?
Yeah, that is what I said in my opening remark. I hope they follow the trend. And because, honestly speaking, the cancer care in India, the reimbursement is terrible, to put it very mildly.
Right.
And because of that, patients suffer a lot. Oncology hospitals have to, do cross-subsidy. So many things we have to do because of these issues, where they pay very nominal amount, particularly the Ayushman schemes, the ESI schemes is the worst of all. I hope they follow this trend and understand why CGHS is doing, and CGHS could become a trend setter to help us to bridge this gap.
Absolutely. So, analysts are projecting, according to their analysis, is that 2.5% incremental revenue is what, maybe some companies could see coming in from here. Improvement in terms of EBITDA growth as well. One, do you think this is a fair estimate? And also, from when will we start seeing these synergies? Will it be second half of FY26? Or does these benefits for the industry or the hospital sector start coming in from the first half of FY27?
I think if they are going to do that from 13th of October, what they have announced, I think whether they are going to do for old patients who are on the scheme already is issue which has to be sorted out with them. Assuming it even applies to patients who are already on treatment, and then we start the new patients on this particular reimbursement scheme, we should start seeing some benefit definitely in the fourth quarter.
All right, some benefit definitely in the fourth quarter. We'd request you to, join us once again, or the concerned authorities to join us once again and give us a detailed outlook on how this would, benefit a player like you, and more importantly, all the others in the hospitality or the hospital space as well. We'll take a short break, come back. On the other side, we'll talk about a lot of stocks which are buzzing around. Vivek joins in with that list. Stay with us. Welcome back. Seems like the Nifty is stuck to the 25,000 mark, and it's an important level to track as well from an index standpoint, largely because one, psychologically important. Secondly, we have a lot of calls written at those levels as well. So will those call writers start to feel jittery if the Nifty sustains above that or not? Something that we'll be tracking, but no such problems for the IT index. In fact, the IT index has been zooming right from the word go and currently at the high point of trade and supporting the frontline index. The Nifty Bank as well has moved to the high point of trade, closer to that 56,100 mark, and in doing so has crossed important levels as well. But in the last few minutes or so, we've seen some traction come by in Paytm. So 197 communications, the intraday chart comes up for you. It's up 4% right now. And in fact, it's done well this October so far with an 8% up move. The other one that's doing well is Siemens. Siemens is now up around 2% as well. Remember, the stock had been a bit of an underperformer. Now that's the one that has come up and it's moved to the higher end of today's trading range. The other one that's also picking some pace is Dixon Tech, which has moved higher by about 1.5%, but most of the gains have come by in just the last 15 odd minutes. Shriram Finance is the other one from the front line end of things, which has now taken the top honors as the biggest gainer on the Nifty, up nearly 4.5%, and a big up move is what we've seen on that. What we'll do is take a short break. On the other side, we talk about all things commodities as Manisha Gupta joins in. With her is Amit Goyal of Pace 360. All of this, even as some of the commodity prices near record highs.
Welcome back, and joining us now is Amit Goyal. He's co-founder and chief global strategist at Pace 360. Amit, hi, good to have you. And the story about all-time highs in gold just about continues. I think in this year, until now, we've done almost 39 and 15, perhaps 58 times that gold has seen an all-time high. From where we stand, are you cautious buyer? I'm assuming nobody is selling at these levels even now.
Hi, Manisha. Thank you so much for having me on. So I'm a bit of a party pooper right now, Manisha, and I think it's the wildest party that we've seen in precious metals in a very long time. And we, being students of history and economics, I can safely tell you that in the last 40 years, there have been only two such episodes where gold and silver did extremely well, and dollar index was either soft or going down. And in both those instances, gold and silver corrected a lot after that. As I mentioned to you last time when I was on your channel, that this is a reflationary boom. That was about 2.5 weeks back, and I would want to say that it's not even looking like a reflationary boom now. It's looking like a reflationary bubble, and particularly accentuated in gold and silver. I have been trading precious metals now for about 25 years, and this kind of price action has very few precedents.
Really?
So it would be almost impossible for anybody to put a finger and say that, okay, this is going to be the precise top, because this is now a bubble of gigantic proportions. To say what the exact top is going to be and how many days it's going to be made. But I can safely tell you that whatever top is going to be made, there is going to be a very, very deep and correction, and there is going to be almost like a regime change over the next 1 year after that.
I get you, Amit. People have been calling it a pause, a sell for a very long time, but gold and silver clearly not listening to that. Also, I have been talking to some banks, Amit, and they tell me that there are liquidity concerns right now as well coming in, because there is one delay in delivery, there is also shortage in immediate buying, rather selling or availability of gold and silver, as it were, in various markets there. China has been buying very strongly as well. So clearly, as you said, it's not history or even economics that we are dealing with right now. This is quite a bit of a panic buying and a bubble territory that we're looking at. But even if we do that 4,000 and 4,200 on charts, and you're talking about a good amount of profit-taking correction into the markets, where do you see prices coming in then? Because this bull rally started from 2,100. We are almost at 4,000 right now. Where is that correction lasting until?
I think, Manisha, firstly, I do agree with you that normally in this kind of a rally, you would want to see them making some landmarks. And for gold, obviously, $4,000 is going to be a landmark. And for silver, crossing $50 for the first time ever is going to be a landmark. And I would want to believe that there is a high probability that both those landmarks are going to be achieved within the next few days or maybe a couple of weeks from now. And post that, I think it's going to be just like you're seeing brute force in the market right now, from buying practically from all quarters. There is going to be a brute force on the selling side as well, which is what history tells us. And in which case, you can expect a 30-35% correction in gold. I would want to mention that it happened in 2007-8 when gold went down by about 34-35% in 6 months, post that inflationary bubble in precious metals and commodities. And the other one was 2011, where it went down by 45%, and that took a much longer time. That took almost slightly more than 4 years. I don't think it's going to be 6 months. I don't think it's going to be 4 years. I think it's probably going to be about a year or so. Okay. And the amount of correction which I expect is about 35% in gold and about nothing less than 50% in silver.
I missed that. 35% in gold and how much in silver?
50% in silver from the top, Manisha, because that is where right now the biggest madness lies. It has even crossed gold in terms of the recent madness and frenzied.
What I want to know, Amit, is that after we've done this 35% and 50% of correction in silver, are those levels going to be good to buy, and for how long a period?
Manisha, I'm absolutely convinced that in case of gold, those levels are going to be a great buying opportunity. It's just that a regime change has to happen. And if I were to assume a $4,000 top on gold, and if I were to assume a 35% correction, so that would mean that we would go down to the to a territory of 2,700 on gold, which is like so far-fetched at this point. But I think it is plausible, and at that level, gold is going to be the best investment in the world again. And silver, I think 50% fall I am seeing from the top. And I'm not even sure whether silver is going to be a great long-term buy after that, because I'm seeing a very deep recession in the world led by US over the next 2 to 3 years. And in which case, the demand for silver for the first time in a decade is actually going to go down. And I know people are going to tell us that it's going to be, photovoltaic cells, electronics, semiconductors, electric vehicles. You need silver everywhere. But believe you, Manisha, we've seen periods of time when the demand for silver actually went down when there was a economic contraction. And this looks like a pretty sinister economic contraction ahead, in which case silver is not going to be a long-term buy, even at those levels. But yeah, of course, there are going to be some frenzied rallies up and down both ways. So we are going to be playing those rallies, but there isn't going to be a long-term buy between them. It's going to be gold. And I would still bet on a 30 to 35% correction from the top.
Got that.
Okay. Amit, as well as Manisha, thank you so much for joining in with us on this conversation on understanding gold as well as silver. I'm waiting for that correction if it does happen.
All of us are.
If it does happen, yes, gold and silver, we'll keep an eye out on that and that buying opportunity if that is there. But thank you so much for that conversation there. On that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll get more on the markets and focus on defense stocks as government has opened defense production for private sector. Stay tuned in for that. Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty is trading almost at the day's highest point, 25,000, about that mark, 0.5% of gain for the Nifty 50 today. But let's move on and sources tell CNBC-TV18 that Defence Ministry has opened up missile and shell production to private sector. Ria is here to give us more details on this one. Ria, what is the latest update we are picking up here? What will this mean for the defence companies?
Well, yes, Vinny, sources have indicated to us that the Defence Ministry has opened up the production of missiles and ammunition to the private sector. Now, an amendment has been made to the Revenue Procurement Manual, and this eliminates the previous requirement for private entities that are intending to manufacture bombs or ammunition to secure an NOC from Munitions India Limited. And this essentially clears a long-standing bureaucratic hurdle for private companies, which are now permitted to manufacture artillery shells in calibers of 105, 130 and 150 mm. They are also now permitted to manufacture the Pinaka multi-barrel rocket launcher systems, as well as 1,000-pound general purpose bombs, mortar bombs, as well as hand grenades, and this also includes medium and small caliber ammunition. Now, what will be the impact of this move? Firstly, this streamlines operations and it also speeds up approval processes, and in fact it will also reduce the dependence of Indian companies on PSUs as well as on foreign imports. And in fact, this also opens up export opportunities, especially in Europe, which is currently facing an ammunition shortage, and the current TNT production for Europe is currently dependent on a single manufacturing facility in Poland. Now, largely this removes a key entry barrier for private defense firms, which can now set up ammunition production units independently. This move is expected to be positive for private companies, the likes of PTC Industries, Premier Explosives, Solar Industries, as well as Astra Micro. And although this can take away some market share from firms like Bharat Dynamics as well as Bharat Electronics, which currently produce all of the missiles in India, but this impact is only expected to come in 2 to 3 years down the line.
If we take that point, higher production opportunities for some of the companies, maybe some bit of market share losses, but that's 2 to 3 years away from now. The street, celebrating it today. Just keep an eye out on the markets. 25,025 for the Nifty and gaining. More on the markets after this short break.
Welcome back to Halftime Report on CNBC-TV18. We're seeing that the markets have inched up a bit further. 25,030 is what the Nifty is trading at. Nifty IT managing to hold on to gains of more than 1.5%. Mid and small cap is also seeing a good performance. Nifty mid-cap 0.7% of uptake, while small cap is also managing to hold on to good gains in today's trading session. So far, no complaining in terms of move that is coming in for the markets. Nifty 50 at least has inched up to the day's highest point. But with that, we're actually out of time on this edition of Halftime Report. Don't go anywhere. Up next is Business Touch. Take all the market action forward.
Markets have surged to the highest point of the day after a slew of positive business updates lead to optimism, but the market breadth remains negative. Financials and healthcare are leading the gains, while metals and consumer durables are the big drags. Fortis Healthcare gets a thumbs up from SEBI for the long stymied open offer by parent company IHH, while another boost for all government empaneled hospitals comes from an upward revision in the central government health services rates after 14 long years. Tata Capital's 15,500 crore rupee IPO opens following a strong response from anchor investors. CEO Rajiv Sabharwal expects Q3 and Q4 to be bumper quarters and sees margins improving as costs dip with digitization and AI deployment. Business updates by top banks and NBFCs point to strong credit growth in the second quarter, with lenders like PNB also indicating optimism in corporate credit growth going forward. Small finance banks also see recoveries in microcredit rise. And gold prices are scaled to a new high above $3,900 an ounce as the US shutdown adds fuel to the rally. Bitcoin tops $125,000 for the first time ever as ETF inflows surge, even as silver scales to a new high in India, nearing its record mark globally. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia, and it is a very, very good start to the week for our markets. We've carried on from where we left off on Friday after the sharp rally that we saw in Wednesday's trade. Thursday was a holiday. We built on to those gains on Friday, and we are extending those gains in today's trading session as well. At the highest point of the day is the Nifty now. 25,050 is where the index currently stands, 150 points higher. So comfortably above the 50% retracement mark of 25,016. And now closing in on the 61.2% retracement mark, which is 25,113. So that is the next important level to watch on the upside for the index. Two major indices that the Nifty needs to thank for this move is the Nifty Bank, of course. The Nifty Bank has now retraced its entire fall from the highs of the 18th of September to the lows of the 29th of September, and it has now made a new high, new swing high, if I can call it that. It crossed the recent swing high of 55,835, now comfortably above the mark of 56,000, still over 1,000 points away from its record high levels, but doing fairly well for itself is the Nifty Bank, the fifth straight day of gains for the banking index. The other index that it needs to thank is the IT index, doing fairly well for itself as well. We start off with the IT earnings later this week, and the Nifty IT now at the highest point of the day as well, 1.75% higher for that stock, for that index, and most of the constituents of the index also doing fairly okay. But just before we move to Gaurav on the banking updates, there were a whole host of them. I'll just pull up the advanced decline and I'll give you an idea of how the market breadth is doing, because the broader markets have been fairly quiet over the last at the start of this week, and the line is only widening. Even though the Nifty Bank and the Nifty IT are at the highest point of the day, the broader market line, after converging in the early minutes of trade, the gap now has only widened. 1,650 stocks declining for 1,200 stocks that are advancing on the NSE. But banks have been in the spotlight since the Reserve Bank of India's policy announcements on Wednesday. They continue to be in the spotlight today as well. And almost every banking, financial, small finance bank, they came out with updates on Friday after market closing hours and over the weekend as well. As you can see in the stock price as well, doing fairly well are these banking names. Gaurav is here with the lowdown of how the quarter has gone by for a lot of these banking majors. Gaurav.
Well, let's talk about HDFC Bank, the biggest private sector bank of India, that reported numbers. In advances, they reported 9.9% growth. Now, remember, system level growth is at around 10.4%. So, definitely it seems that HDFC Bank is picking pace at the system level. As they indicated in FY26, they will be growing at a system level, and in FY27, they will be outpacing system. As of now, it seems that they are actually picking pace towards the system level. Other than that, in terms of deposits, the growth is at around 12.5%, which is again higher than the system, and at the same time on a quarter-on-quarter basis, the deposit growth was at around 1.4%, and that is the reason why we saw some spike in the LDR ratio. Now it stands at around 98.8%. Remember, they wanted to take it around 85 to 90%. So that is something which causes a concern for this quarter, but as of now, good set of numbers from HDFC Bank. For Kotak Mahindra Bank also, we saw very good set of numbers. Advances that increased almost by 15.8% and deposits increased almost by 14.6% on a year-on-year basis. Remember, this is actually the highest growth that we have seen so far for the bank of a size as Kotak Mahindra Bank. But at the same time, let's also not forget that in the last quarter also, bank had reported very good set of numbers, but during the results, they said that the growth was driven by corporate banking, which is a low-yielding segment, and at the same time, NIMs also declined and credit costs increased. So definitely, I'll be specifically watching out on how the numbers are going to be during the results, but as of now, good set of numbers. Bajaj Finance, that also came up with good set of number, 23.5% of growth on a year-on-year basis versus the guidance of 24%. So definitely, all in all, these companies came up with good set of numbers, and the market is also treating them well. All the stocks are up more than 1% in a trade today.
And doing very well is the banking stocks, the banking index, and having a rub off on the Nifty as well. Gaurav, thank you for that update. Shifting focus now to the other big story of the day, the revision of health scheme rates by the central government and its impact on hospitals, and that is visible in the price action as well. A lot of these hospital stocks are seeing. Ekta is joining in with the breakdown of that. Ekta, take it away.
Well, yes, hospitals are in focus because CGHS, which is basically the central government health scheme, which is for central government employees in terms of cashless payment in impaneled hospitals, their rates have been revised for the first time significantly since 2014. Now, the government has revised rates for nearly 2,000 medical procedures under the CGHS scheme, and the rate comes into effect this month itself. Many hospitals, or some of the hospitals at least, were refusing to take cashless treatment because of the receivables which were piling up, as well as the hospitals saying that the package rates were outdated and did not account for medical inflation since 2014. Now, hospitals say that this will be a positive change. They need to assess the revenue impact, but they are expecting cash flows to improve, and receivables, which have been improving, would probably sustain and improve going forward. Now, in terms of the companies or the hospitals that would be impacted would depend on the payer mix. For example, Fortis, CGHS revenue is around 4.3% in terms of the payer mix. Apollo, their exposure is around 9% to government. Max, institutional exposure is quite large at around 21.8%. Global Health is at around 18%, with CGHS probably hovering at around 10%. And Narayana is around 18% from schemes as well. And Yatharth too has a large exposure to the government schemes. It could be over around 30% in terms of the total payer mix. So overall, yes, it is positive in terms of the CGHS revision which has taken place. It is expected to improve cash flows, and receivables, which have been improving, should probably be on an uptrend for these hospitals.
Uptrend as well, and Fortis among the top movers among these hospital stocks today, 6% higher on that stock, at least on last count, and most of the others as well. Apollo, Global Health, Max Healthcare, the newest Nifty entrant, Yatharth, as Ekta was highlighting, all of them seeing gains of anywhere between 4 to 8% in today's trading session. So doing fairly well are these hospital stocks as well in the pink of health. Now, Vodafone Idea continues to remain under pressure though. The stock has been a bit volatile in today's session. It fell almost 5%, then recovered from the lows, then declined again. And that's after the Supreme Court, hearing its plea for relief on the AGR dues, has adjourned the case and has set the next date of hearing as the 13th of October, which is next Monday. So for now, Vodafone Idea currently 3.5% lower at 8.5 rupees. Take a short break. More news and updates on the other side. Welcome back. Now, while speaking at the Kautilya conference yesterday, External Affairs Minister S. Jaishankar spoke on the need for an understanding between India and the US where bottom lines and red lines are respected. Listening to what he had to say.
Whatever happens, at the end of the day, there has got to be a trade understanding with the United States. There has to be one because it is the world's largest market, but also because it is, much of the world has reached those understandings. But it has to be an understanding where our bottom lines, our red lines are respected. In any agreement, there are things you can negotiate and there are things you can't. And I think we are pretty clear about that. And we have to find that landing ground. And that's been the conversation really which has been going on since March.
Now, more than 10 deaths have been reported from Madhya Pradesh's Chhindwara amidst consumption of contaminated batch of cold-riff cough syrup. In response, several states including Madhya Pradesh, Maharashtra, Uttar Pradesh, Tamil Nadu, Uttarakhand, Rajasthan, Telangana and Kerala have issued advisories and banned the sale of the cold-riff cough syrup. The Union Health Ministry held a meeting chaired by Health Secretary Punya Salila Srivastava with all states and union territories. The meeting focused on ensuring strict compliance with drug quality standards and promoting the use of safe-use cough syrups. And at least 28 people are killed and a dozen missing after heavy rainfall triggered massive landslides across the Darjeeling district in West Bengal. Hundreds of tourists visiting for the festive season are now stranded after key routes caved in under the landslides. Rescue operations are now being carried out by the Army and the NDRF teams, and multiple helplines are activated in Siliguri, Darjeeling and Kolkata for those stranded. The IMD has issued a red alert for the sub-Himalayan areas of West Bengal and an orange alert for Darjeeling. West Bengal Chief Minister Mamata Banerjee has announced compensation for victims and will visit North Bengal today to review the situation. And as we sleep into a short break, we leave you with visuals of the Bhumi Pujan ceremony for the 240,000 square feet NSC Multi-Speciality Hospital, Block and Bone Marrow Transplant Cancer Hospital at the Tata Memorial Hospital in Navi Mumbai. The National Stock Exchange of India, as part of its CSR initiative through the NSC Foundation, has partnered with the Tata Memorial Centre to develop this cancer hospital block. Welcome back. Now, Union Minister of Commerce and Industry Piyush Goyal is on his two-day visit to Qatar to chair the India-Qatar Joint Commission meeting. Parikshit is joining in now with the key agenda for this. Parikshit.
The main purpose of Commerce Minister Piyush Goyal's visit to Qatar is to finalize the terms of reference for a bilateral trade agreement with Qatar. He will be co-chairing the Joint Commission on Trade and Commerce along with his counterpart, Sheikh Faisal bin Thani. There will be discussions on diversifying trade and increasing exports of items such as pharmaceuticals, mineral fuels, gems and jewelry, plastics, organic chemicals, edible oils, and copper articles to Qatar. Currently, the total trade stands at around $14 billion and it is skewed in favor of the Qatari government. India's exports stood at $1.7 billion in the last fiscal, and India's imports from Qatar were close to $11 or $12 billion. This is primarily because of LNG, and this is why the relationship is also very important, because 40% of India's LNG needs are met by Qatar. In fact, India is one of the largest markets for Qatar's gas exports around the world. So there will be a lot of focus on diversifying investments, diversifying trade, also increasing FDI. Earlier this year, during the visit of the Qatari Emir, Qatar had made a commitment of investing more than $10 billion in India. So we will be discussing how to speed up those investments in the years to come. Qatar is a very important market for the country. There are more than 850,000 people of Indian origin living and working here, 45,000 Indian students as well. 20,000 small and big Indian companies have a presence in Qatar. So this trade agreement, if it happens soon, will be very beneficial for India and Indian businesses as well.
Parikshit, thank you for that update. The biggest IPO of 2025, Tata Capital, has opened for subscription today, and as of now, the issue has been subscribed around about 25% as of the latest update. Earlier, we spoke to Rajiv Sabharwal, the Managing Director and CEO of Tata Capital, about the company's growth and the road ahead. Listen in.
We've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year. When you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
The biggest IPO of the year so far, Tata Capital, 15,500 crore. And that's not it. The 11,500 crore LG Electronics IPO opens for subscription tomorrow. So there is a lot of hustle and bustle in the primary markets. By the way, the Nifty still 150 points higher as was the case when we started the show. 25,050 is where the stock is. But the real action though is in the broader markets, specific stocks. Even though the market breadth has been a little awry in favor of the declines, the Midcap index is up 0.5%. But take a look at some of the stocks. KIOCL is one such name. 17.5% higher. We spoke about this on Bazaar this morning as to how the stock does not have any free float in the market, considering the fact that the government owns 99% of the company. KIOCL 17.5% higher at 621. ITDC is yet another one with very little float in the market, 16% higher on that stock as well. And what has also sprung up to the highest point of the day is Repro India, and 15% higher on that stock as well. So plenty of activity in the small cap space, and most of this activity has happened after noon and after 12 o'clock. So we'll keep an eye out on all of these names in the small cap space. But with that, we call time on this edition of Business Lunch. From me and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. And what a stellar move on the markets. The week has started on a strong foot. We have a 170 or 180 point gain on the Nifty currently. The mid-caps are powering through as well, and it is mostly led by the IT names and the banking names as well. So a lot of updates coming by, earnings that continue to be the focus point starting this week itself. And there's so much to talk about today.
So much to talk about, so many cues to track, especially now on domestic markets, the kind of updates that have come in over the weekend. We have a lot lined up on the show. An important development in the hospitality space is something too that we will be tracking. Nifty surpasses about 25,050 level, led by banks and financials, largely after a slew of positive business updates. Market breadth, however, remains negative. Metals and consumer durables drag.
Hospital companies get a booster shot from the centre amid an upward revision in the central government health services rates after 14 long years. Porter's Max Health surge in trade.
Nykaa rises after growth momentum accelerates in Q2, driven by the fashion and beauty segments, both of which see revenue growth of over 20%.
Poonawalla FinCorp shares surged 8% intraday after the company released its Q2 business update. The company's assets under management rose by 67.7% on a YY basis to 47,625 crore rupees.
Jubilant Foodworks slips from the day's high even after posting a good Q2 business update with consolidated revenue up 19.7%, while Avenue Supermart slips over 2% too after the company's second quarter business update disappoints the street.
All right, and a 180-point gain on the Nifty. We are comfortably above that 25,050 mark. When we talk about mid-caps, it's a 0.5% of a gain at the day's high again. Bank Nifty is fueling the rally that we are seeing right now. That index is up almost 1%. The IT names also powering through today. The small caps actually in today's trading session are underperforming the benchmarks in some way. But yes, there's nothing to complain about so much. It's a 0.1% gain on the small caps. But let's talk about our mid-cap movers. Sudarshan is here with us to take us through the mid-caps that are moving around in trade. Sudarshan.
So we'll start with the sector hospital names which are moving higher after the government has decided to increase the CGHS price, and that has come after a long gap of 15 years. And on the back of that, we're seeing a big move in hospital names like Fortis Hospital, Narayana Healthcare, as well as Yatharth Hospital. You can see all three stocks are up somewhere in the range of 3 to 7%. Apart from this, all these stocks are reacting to quarterly updates. First on the list is Nykaa, which has reported consolidated revenue in mid-20s that company is expecting in Q2. On the back of that, stock is up sharply. Delivery is up as well. Also on Friday, company had announced that just for the festive season, its logistic has seen an increase of almost 19%. On the back of that, we are seeing a big move. Angel One today morning has come out with a quarterly update. Both on a monthly and on quarterly basis, company has reported increase in client acquisition. On a quarterly basis, it's up almost 12%. On a monthly basis, also it's up almost 1%. One stock that is under pressure after the quarterly update is the Avenue Supermarts. It has reported revenue growth of 15.4%, and all the brokers believe that this revenue growth is lower than their estimates, and estimates were somewhere in the range of 18 to 19%. Apart from these names, some of the stocks are moving higher. First one on the list is BSE. There have been some news related to the options data. On the back of that, it's up. Another stock which has seen a huge move, that is the Paytm. Last week, if you remember, the stock was under pressure, but today it's up almost 5%. Aditya Birla Lifestyle, after block deal of almost 6%, equity stock is up almost 8%. And one more stock that is higher with a healthy volumes is KIOCL. Some of the stocks which are under pressure, first one is Hemisphere Properties, down almost 18%, and Sammaan Capital, after the acquisition, after the announcement of IHC is going to acquire majority stake, since then the stock is down almost 11 to 12%. And last one in the list is Vodafone Idea, because today also Supreme Court has decided to defer the case to October 13, but it cannot be taken completely negative because both Vodafone Idea's council and government's council have decided to defer, and they have also just given one line that we want to celebrate Diwali this year. That's the reason they had requested for deferment.
Thank you so much, Sudarshan, for just taking us through all of the moves as far as the broader end of the markets are concerned. It's a good time to welcome Ruchit Jain from Motilal Oswal Financial Services for a quick technical check on the market. Good afternoon, Ruchit. Thank you so much for joining us. We want both of your views. Number one, on the index, and what are your individual trading picks for today?
Yeah, very good afternoon, Vivek. Very good afternoon, Sonal. On the index front, I think last 1.5 months, we have seen a broad consolidation and within the 1,000-point range of 24,400 to 500 on the lower side and 25,500 on the higher side. So I think we are still in that time-wise corrective phase. Good thing is that we have already seen some correction in last couple of weeks, and we are witnessing a bounce back from that lower end of the range. So I think price-wise downside seems to be limited on the index front from here on. We can see good leadership coming in from some of the banking names, and even the IT names are witnessing a bounce back from the oversold territories. So I think these heavyweights would keep the momentum intact in the index, and we could see levels around 25,250 for now. So broadly, I think on a broader time basis, we are still trading within a broad range on the index front. But on a very short-term time frame chart, markets have formed a good support base around the 24,600 mark and are witnessing bounce back towards the higher end of the range. Now, Vivek, as far as stock-specific ideas are there, we are looking for such ideas where risk-reward ratio is now favorable post the recent correction. So a couple of names from the mid-size segment. One is Tata Technologies, where overall this stock has been an underperformer, but last 1.5 months, the stock has seen some consolidation. It has not fallen compared to what many other stocks within the IT space has seen in last 2 or 3 weeks. So overall, on the weekly charts, there's a good support base getting formed. So we are advising to go long on Tata Tech for a pullback move from here on, with stop loss below 685 for potential targets of 760. And NBFC space is really doing quite well, and Canfin Homes within that space has very good risk-reward ratio. The stock has seen a breakout coupled with very high volumes in last couple of trading sessions. So we are of the opinion that we should see a good trended phase in Canfin Homes from here on. So keeping a stop below 760, short-term traders can buy for potential targets around 850.
All right, Ruchit, thank you so much for joining us. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and sector and stock-specific action on the other side. Stay tuned.
Welcome back to Midcap Radar. The central government announced a long-awaited revision of CGHS rates, updating the prices for nearly 2,000 medical procedures. This will be the first major overhaul in over a decade. To discuss on this, we are now joined by Kunal Damesha, Pharma and Healthcare Research Analyst at Macquarie Capital. Thank you so much, Kunal, for joining us. Well, first up, we want your take on this particular development. It's been a very long time that the industry has been asking for it. How does this impact the financials of hospitals? And if you could break it down tier-wise for us.
Sure. So basically, see, CGHS rates do get some form of inflation adjustment every year, but then it's like a pay commission that there is a major revision that happens after few years, right? And this major revision has happened, as you suggested, after over a decade. And if I look at the some of the high ticket procedures in key therapies such as cardiology, orthopedic, neurology, oncology, I see the rates have been hiked by anywhere between 5 to 30% over the 2024 rates. So it is definitely a major revision. And when I look at some of the hospital companies, not all companies report the CGHS revenue separately, but most of them report something called government channel revenues. And government channel revenues, based on the company reports, is one of the highest for Fortis at around 20% plus, followed by around 19% for Max Healthcare, similar number for Narayana Healthcare, and roughly around 10% for Medanta and 10% for Apollo Hospitals. Now, within this government channel revenue, there are multiple, multiple channels again. One of that is CGHS, another one is ECHS, and then there are PSUs and some of the state government schemes, etc., kind of feature into that. Now, only Fortis provide a lot of clarity onto CGHS, and they derived roughly 4.5% of their revenue from CGHS in FY25. Which basically means roughly 25% of the government channel revenue is coming from the CGHS.
Kunal, you said only Fortis has provided some clarity. So what kind of numbers have you factored in terms of an increase that we'll see on the bottom line because of this increase that would come by? And with CGHS, CGHS itself, which would the biggest beneficiary be apart from Fortis?
Sure. So I think, almost all the companies will have some exposure to CGHS. Specifically, the exposure would be higher for hospitals, which have a significant presence in Delhi NCR region, because that's where maximum of the central government employees are situated, right? So that is one. In terms of, there is a second order impact as well, because the other government channel also, some of them refer CGHS as a reference rate. So basically, let's say the ECHS, which is for the servicemen, right? That kind of refers to CGHS rate. So that is another channel which again will kind of get the rebase in terms of tariff rates. Now, in terms of the impact, I have not analyze the exact impact or exact increase in the entire 2,000 procedures where the rates have been revised. But as I said, the key procedure, my view is that the average rate hikes is around high teens percentage point. And if I assume that half of these government channel revenue for these hospital gets rebased by that high teens percentage point, then we are looking at somewhere around and this is a pricing revision, so it should ideally should fall directly onto the EBITDA. And hence, we can see EBITDA upgrades of anywhere between mid-single digit to low double digit is what, my base case scenario would be.
Okay, Kunal, I want to ask your views on two individual companies. First up, especially as far as Max Healthcare is concerned, there were a couple of news reports indicating that cashless payment facilities by various insurers were under a cloud, and in fact, the company had said that they would look to stop it. That was the first one. And secondly, over the weekend, as far as Fortis is concerned, SEBI has given the nod for the open offer from IHH. How significant are both of these developments?
So I would start with the later one on Fortis.
Sure.
The clearance of the open offer from IHH definitely removes a long-standing overhang on the stock. this has been under judicial matter for quite some time, and this kind of clears the air for the company. However, at this point, it is not exactly clear that whether the IHH will follow up with a new open offer or would it be the same, because the earlier open offer at that point in time, which was blocked, which was somewhere around 170 rupees per share or something. So we need to see more clarity to emerge from IHH on that aspect, but definitely a removal of regulatory overhang on the company. And for Max Healthcare, yes, various media reports are suggesting that the four health insurance companies have kind of suspended their cashless facilities. Some at the pan-India level, some at the Delhi NCR hospitals of the Max Healthcare. So to that extent, I think there could be some impact. Max Healthcare derives 40% of its revenue from the insurance channel. And these four companies, the four insurance companies which have kind of suspended the cashless facilities, they accounted for almost 30% of the health insurance premium in the retail channel. So, there could be some impact is what my expectation is. Very difficult to quantify, given we don't know the exact market share state-wise for these insurance companies, and also the procedure mix, etc. But I've been highlighting this, in my analysis, that the ARPOB growth of the industry, hospital industry, has been at around 11%, starting from FY19 to 24.
Okay.
And this is obviously above the historical range.
Got it.
Primarily, it is driven by tariff hikes, and this is what
All
is
right.
causing the
Okay. Okay, Kunal, thank you so much for joining us. Out of time now, but that was quite helpful. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets, and Hormuz will come back, focus on power struggle and boardroom battle at Tata Sons. Stay tuned for that. Welcome back. Well, 7 years after the ugly spat between Cyrus Mistry and Ratan Tata over the Tata Sons, another boardroom battle is brewing at what is one of India's oldest and largest conglomerate. Hormuz is here to tell us more.
Well, it is indeed another power struggle that is brewing at one of India's largest and oldest conglomerates, and that is Tata Sons. And now reports are emerging of new infighting 7 years after that bitter battle between the late Ratan Tata and the late Cyrus Mistry. Now, what is exactly the bone of contention here? The bone of contention is the power struggle within the Tata Trust leadership. Now, Noel Tata is currently the chairman of Tata Sons, and he took over after Ratan Tata's passing. And he is now opposed to Melly Mistry's attempts to get a board seat, and he is also opposed to Melly Mistry having a leadership role at the Tata Trusts. Now, who is Melly Mistry? Now, he is a director of the Meher Palonji Group. He is also a strong supporter of the late Ratan Tata and an estranged first cousin of the late Cyrus Mistry. Now, during this bitter public battle between Ratan Tata and Cyrus Mistry, Melly Mistry was in favor of Ratan Tata during this battle. Now, what is exactly Tata Trusts? Now, Tata Trusts is an entity which has a majority shareholding in Tata Sons. They have close to 2/3 of the stake here, and then Tata Sons invests in multiple companies down there. Now, look at the trustees here at the Tata Trust. Noel Tata, of course, being the chairman. The other trustees include Venu Srinivasan, Melly Mistry, Tarayas Khambata, Pramit Jhaveri, and Jahangir H.C. Jahangir. Now, this is the trustees at the Tata Trust. Now, if you take a look at the board of Tata Sons, we'll find N. Chandrasekharan as the chairman. We'll find directors such as Noel Tata, Venu Srinivasan, Saurabh Agarwal, who is the CFO, at directors in Ajay Piramal, Harish Manwani, Anita George, who is an independent director, and Ralph Speth as the independent director as well. Now, the recent changes that were made to Tata Sons as a result of that bitter boardroom battle, there was an amendment made to the Articles of Association during the 2022 AGM, and that prevents the same person from chairing Tata Trusts and Tata Sons at the same time. As a result of which, Noel Tata is the chairman of the Tata Trusts, while N. Chandrasekharan is the chairman of Tata Sons. Now, the amendment was approved by shareholders, and therefore the two entities are now legally separated. Now, very recently, the 11th of September, which is last month, the longish board meeting of Tata Sons ended with the removal of Vijay Singh from the board. The trustees had a very close call. They voted 4-3 in favor of Singh's removal. Now, while Noel Tata, Vijay Singh himself, and Venu Srinivasan continued in favor of Singh to continue on the board, the other 4 members were opposed to that. But who is Vijay Singh? Now, Vijay Singh is the vice chairman of the Tata Trust. He's aged 77. He's the former defense secretary, so he's a seasoned bureaucrat, and he was one of the late Ratan Tata's closest confidants. Now, the issues that were raised in that board meeting is the fact that Vijay Singh is now above the cutoff age, which is 75 years old. The other issues which were raised by Pramit Jhaveri included the fact that the reappointment of Anita George as an independent director had to be done in consultation with all the trustees. Now, that was not done. The other issue that was raised is that the Article 121A, it needs all investments, acquisitions or disinvestment proposals above 100 crore to have prior approvals from the trustees. That is not being followed as well. Now, some more developments that were during that board meeting is the fact that Noel Tata and Venu Srinivasan went on to say that the removal of Vijay Singh will set a very damaging precedent, and later on Tarayas Khambata nominated Melly Mistry to the board of Tata Sons, which was rejected by Noel Tata. Now, the key challenges that Tata Sons faces, of course, we are hearing a lot about the IPO pressure from the Reserve Bank of India. There are also questions being raised over the transparency, governance and future control. And culmination of all of this, now sources are telling CNBC-TV18 that the Tata trustees are going to meet senior government officials for a meeting. They are going to meet the officials on matters related to the functioning of the trust, and Noel Tata and N. Chandrasekharan are both likely to be part of the meeting. So, another power struggle brewing at Tata Sons. We'll wait and watch where this goes next.
Thank you so much, Hormaz, for joining us with all of those details as far as Tata Sons is concerned. But with that, we are completely out of time on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. In terms of the markets, they've inched up again to the day's highest point. As of now, 25,078 is what the Nifty is trading at. So a good day coming in there. 7/10 to 0.8% of gains is what we're seeing coming in for the Nifty 50. Broader end of the market, that's also managing to hold on to decent gains in today's trading session. When you look at it, the Nifty Midcap, that's managing to hold on to gains of 0.6%, while small cap is just mild gains of 0.1% as of now. So when you look at that advanced decline ratio, that's still in the favor of declines versus advances that we're seeing coming in, because we have main performance that is coming in today is from the Nifty Bank that is managing to hold on to good gains, while small cap is not doing as well as the benchmark indices. So that is what we'll be keeping an eye out on. In terms of overall the movers, today Nifty IT in terms of a sector is managing to hold on to very good gains, and among the top sectoral gainer is the Nifty IT. Keep an eye out all the hospital names as well. We have a lot of news flow coming in there, so keep an eye out on that. But on that note, let's get started with the show. And this is the show where we solve all your stock-related queries. And to do just that, we have Parthiv Shah, Director at Tracom Stockbrokers, as well as Ashish Gyal, Chartered Market Technician, author at Wave Strategy Advisors, to answer all those stock-related queries. Parthiv as well as Ashish, good afternoon and thank you so much for joining us on the show. Let's get started with those queries. The first query for today, we have Vivek Mehta, who's writing to us from Mumbai. He's holding 15 shares of Kalyan Jewellers. This is at a price of 723 rupees per share, as well as 5 shares of NHPC. This is at a price of 111 rupees per share. Wants to know the future prospects of his investments. Parthiv, what's your view? Kalyan Jewellers as well as NHPC, he's making a loss on both these stocks right now. What should they be doing?
Good afternoon, Vinny, Ashish, and our viewers. See, I think we are not very upbeat on Kalyan Jewels at these levels. No doubt, the company gave the update, business operational update, in terms of showing growth of almost 30%. But I think the stock had run up way too high. Unfortunately, the gentleman has purchased at very elevated valuations, post which the stock has almost corrected by 30%. And even here, on a trail multiple of 65, we are not very upbeat on this counter because our sense is that other peers like, say, Titan, whose 85% of the revenue comes from the jewelry segment, are making huge inroads and garnering more market share. No doubt, I think the business sentiment going ahead, even the management of Titan has mentioned they are a little cautiously optimistic, but we are upbeat on the fact that the consumer sentiment is slightly changing for the good, and we are also heading for the seasonally strong season for these players, especially the H2, where we'll have a lot of weddings and things like that, which a lot of shopping and there's a lot of pent-up demand. So I think it's better to convert or switch into Titan vis-a-vis holding Kalyan Jewels.
And NHPC, do you have any view?
Yes. So basically, again, I think we are not like advocating any power generating companies which are generating power through only one source of renewable energy, which is like hydro. Because sometimes if the monsoons are not to the favor, I think the operational efficiency of these hydro projects tend to really be very lean. So this is not the counter which suggests. We rather prefer NTPC, has a fantastic thermal asset. It's also making huge inroads in renewable, and it's a well-diversified power player in terms of utility space versus NHPC.
Okay. Keep an eye out on those names over there. Prefers Titan over Kalyan, that's a view there, and NTPC over NHPC. Ashish, your view, Kalyan Jewellers as well as NHPC. Do you think the viewer can make up for that some bit of a loss that they're making in both these stocks and then look to switch?
Hi, afternoon to you and all the viewers. If you look at Kalyan Jewellers, his buy price is pretty elevated at 711 and the stock is around 484 right now. But there is no sign of positive reversal. If you look at the chart, the stock is managing to bounce back from that 450 levels. And possibly I would suggest that exit from the stock if it reaches around 530. So maintain 450 as the stop loss, 530 can be the exit level. And I agree with Parthiv on Titan being a better bet than staying long on Kalyan Jewellers. As far as NHPC is concerned, the stock has continued to consolidate for quite some time. I think it's forming a triangle pattern and very strong consolidation. We can clearly see since 2024 February onwards. And on the upside, the stock needs to break that 89 mark, which has been a major hurdle. Once it breaks 89 mark, we can have a triangle target on the upside, which is going to be around 110 levels. So the overall undertone for NHPC is sideways. Break above 89 can take it towards 110 levels. For now, maintain a stop loss for the stock at around 82.
Okay, keep an eye out on those levels over there. Let's move on then, talk about REC. That's the next query we have coming in on. Nikhil Gupta, who's writing to us from Noida, he's holding 150 shares of REC. The price is 605 rupees per share. He's asking if he should continue to hold or sell at the current levels. Buy price 605, currently 377. Your view on this one, Parthiv? 605 is the buy price for REC. What should they be doing?
I think, again, the concern here is that the gentleman has bought at very, very elevated valuations. Because even currently, if I look into the valuations, they are at a trail multiple of 1.26 price to book multiple. And the levels at which he's invested, REC was quoting at almost 2.5. And a lot of government PSUs, especially in the NPSC space, and that too catering to the power vertical, I think they don't tend to get very rich valuations. No doubt, I think in terms of the business performance, REC has been firing on all cylinders. Management has guided for a 12% disbursement growth this year, FY26. And in Q1, they disbursed sanctioned almost 1 lakh crore worth of loans, which was like 3 lakh crores for the entire FY25. So business momentum is good. They're focusing on the renewable project portfolio. Distribution is again 45% of the sanctions. Overall, things are looking good. But again, my concern is that, the levels at which the gentleman has bought, I think it will take at least 2 to 3 years for the book to grow to the size to justify those valuations. So it will be a long haul. And I would not even suggest cost averaging at these levels.
Okay, you wouldn't even suggest cost averaging at these levels right now. Okay, Ashish, your view for REC, what should the viewer do? Like, when Parthiv said these are those very high levels. I think it's one of the highest levels that the stock has seen, 605. So what should they do?
Yes, absolutely, because that is the entry level is pretty high that we can clearly see on the charts. And right now, the stock has a very important support of 350, where it's showing some kind of a possibility of a bounce back. But better to be out from the stock. It has been underperformer for quite some time, and it has broken all the major supports of 400 level also. So my suggestion would be any pullback towards the level of 390. Use that as an opportunity to be out from here. And on the downside, 366 is the important stop loss.
Okay, keep an eye out on the stop loss levels as well. That's important to keep an eye out on. Let's move on to the next query then. We have Jagan Mohan, who's writing to us from Chennai. He's holding 35 shares of Tata Steel. This is at a price of 155 rupees. Wants to know the long-term view for the stock. Parthiv?
One thing is very clear. The Tata Steel management realizes that it is going to be the Indian operations going ahead, which will generate the best EBITDA by ton and best growth for them, because a lot of these operations have a lot of linkages in terms of backward integration of cooking coal and also iron ore. And even the cost structures for the European division are not at all getting friendly. And I think they're bleeding in some of the geographies there. And they're trying to cut the losses, but I think it's going to be a very long haul there. So they are expanding big time in the Indian subcontinent, and more importantly, the Kalinganagar plant, which will be adding another 5 million tons per annum. I think that is going to be the flagship plant for the company, which will generate one of the finest EBITDA by ton. So if the gentleman has a long-term view, I believe that the Tata Steel management is making all the right moves. And once India becomes the dominant share of the overall consolidated capacity of Tata Steel, I think probably the markets will not worry about the European operations bleeding. So overall, I think Tata Steel looks very good for the long term. No doubt, Q2 could be a little subdued because of lower realizations to the tune of 2,000 per ton. But over a 3 to 5 horizon, I think Tata Steel looks good.
Okay, that's a view coming in there from Parthiv on Tata Steel. Ashish, your view for Tata Steel, what should they do? They bought it at 155.
See, the entry level is decent enough, and the stock is nearing its 52-week high. If you look at the chart, the 52-week high has been around 177, and the stock is still quoting at 170. So that shows an outperformance. Overall undertone for Tata Steel is bullish. We can clearly see the metal sector and the metal stocks has been doing well. So one can look forward to hold on over here, or maybe fresh entry is also recommended for the targets on the upside at around 220. And on the downside, one can maintain a stop loss of around 159 from a long-term perspective.
Okay, keeping an eye out on those levels over there for Tata Steel. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more of the stock-related queries after the break. Welcome back to Your Stocks on CNBC-TV18. We still have with us Partha Shah of Trackham Stock Brokers as well as Ashish Kail of Wave Strategy Advisors to answer all the stock-related queries. Let's move on to the next query then, gentlemen. We have Umesh Sharma, who's writing to us from Jaipur. He's holding 21 shares of RVNL. This is at a price of 629 rupees per share. So clearly, they're making a loss on this one. Now, he wants to know whether to hold or sell at the current levels. Partha, what's your view coming in for RVNL? You know, just last few weeks back when you saw, we had seen some run-up coming on for these railway stocks as well. But from their buy price, it's a clear reduction in terms of the price or the fall that they've seen. What should they do?
Even here, unfortunately, the gentleman has purchased at almost the peak valuations and the peak, rather I would say the peak frenzy of the railway stocks. Because RVNL at around 629. In fact, today RVNL is quoting at a 60 trade multiple in terms of valuation, which is lot richer than a mighty conglomerate like L&T as well. And the price at which the gentleman has entered makes the valuation multiple even more absurd. I think there's nothing wrong with the business momentum in terms of the government's intention to spend massively in the railway, and RVNL being one of the dominant players in terms of garnering a lot of railway-related projects, both in terms of EPC and also in terms of consultancy. But the concern is valuations. I think at such absurd valuations, I think it is very difficult to recoup the original capital. I would any day prefer to park my capital into a company like Larsen & Toubro, which is at current stage, quoting at lot reasonable valuations vis-a-vis such peers. And more importantly, I think at having a 5.8 lakh crore sort of an order book gives a fantastic visibility, and the way management has mitigated the operational efficiency in the company. I think I believe that going ahead, L&T can perform a lot better with better return ratios. So I would switch to L&T than having position RVN.
Okay, and Ashish, your view for RVNL, what should the viewer do? Hold, sell, average? What's the option now?
See, I would not recommend to average. If you look at RVNL, NHPC, and the other stocks that we talked about, Kalyan Jewellers, all of those on the charts looks very similar because all of these stocks have shown very steep decline to the extent of 40-50% from their all-time highs. So that clearly shows that there is an underperformance that we are seeing over here. As of now, RVNL has a very important stop loss, which is around 314. If that breaks, then there is more downside to be seen over here, and I'm not expecting much of an upside opportunity as of now. So better to be out from RVNL and switch something into an auto ancillary space, something like a C8 or stocks from the auto space, something like a Tata Motors, which can be a better bet. RVNL does not look to be performing in the near term as well.
Okay, so no for RVNL as of now. Don't look at averaging as well. Let's move on to the next query. We have Abhay Shankar who's writing to us from Gwalior. He's holding 1,967 shares of Gulf Oil India. This is at a price of 1,280. Asking whether he should hold or sell. Parthiv?
I think the automotive lubricant space, I think the going has been good in terms of gross margin expansion for these players. No doubt the volume growth hasn't picked up the way it should, and we are expecting, I think, post the festive season, I think that should also happen. More importantly, I think Gulf Oil's forte is more into the diesel engine oils, where they have almost 39% share, and in terms of the personal mobility, they are at around 20%. So I think they are reasonably well positioned, and what we like about this company is the valuations. I think at a 16 trail multiple and on a forward basis is quoted at around 12-13 times. I think it's not very expensive. Even on an EV/EBITDA multiple, I think it's at 9.41. And they have consistently, I think, garnered more market share from its stronger peer like Castrol. So Gulf Oil Lubricant, I think, looks good for the long term.
Okay. And Ashish, your view on the technicals for Gulf Oil?
See, Gulf Oil has been consolidating with 1300 as the immediate hurdle on the upside, and the support for the stock has been 1120. It's forming a rectangular pattern, which is a consolidation. So overall undertone, I think, should give a positive breakout. Continue to hold down here. We can expect a target of around 1420, 1440, which is the previous swing high. And on the downside, maintain a stop loss of around 1138 levels.
Okay, keeping an eye out on those levels over there. But that was the last query for today, gentlemen. So Ashish as well as Parthiv, thank you so much for joining us on the show and helping our viewers answer and get those answers to the stock-related queries. And viewers, before we wind down, let's take a quick look at what the market is doing right now. 25,060 is what the Nifty is at, 0.6% of days gains. So some bit of a, downtick that we're seeing from the day's highest point for the Nifty 50. Nifty Bank, though, managing to hold on 0.9% of gain. So no worries on that front. Nifty Bank as well as Nifty IT, that's leading the charts. But with that, we're going to wind down this edition of Your Stocks on CNBC TV18. Remember, you can always email us your queries as well, and we'll address them with our experts. Last set of trade is still left. Don't go anywhere. You have closing bell up next.
Yon Market Headlines. to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Nikkei is currently trading with gains of 4.5% at record high levels.
The support here, 24,587. It's the recent low, and that will be the same for the Nifty Bank as well.
India has fallen short just because of lackluster earnings coupled with higher valuations.
It has to be an understanding where our bottom lines, our red lines are respected.
So 24,916, absolutely flat. Nifty Bank is up about 0.4%.
What degree of an impact the lack of a India-US trade deal is very difficult to assess, of course.
If you look at our housing business, affordable housing is the fastest growing segment there.
Now this year, FY26 would be better than FY25.
I think third consecutive day of gains that we are seeing on the Nifty.
Their rates have been revised for the first time significantly since 2014.
Now moves on to October 13th as the government has sought more time, and which is why we are seeing the stock come off once again from the highs of trade.
170 or 180 point gain on the Nifty currently.
Well, that is the day so far. Market is up 170 points. 25,065 is where we are at. This is Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Surabhi and Reema here in the studios. Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon. Good is only getting better, right? At the day's high, 160 points up now on the Nifty and 25,000 comfortably scaled past.
It's looking increasingly good, and obviously financials have been helping right from the word go. But today, for a change, IT is well behaved also. You have the twin turbo engines firing, financials and IT. So no complaints for the bulls, at least right now, Nigel.
Well, that's right. And the Nifty Bank, you know, it was on a losing streak. Guess what? We have 5 sessions on the trot that the Nifty Bank actually is up. And that's clearly leading the way. So the RBI governor clearly, you know, fueled sentiment out there. What he had to say excited the market, and that continues even today. And now ahead of the festive season, the hope is that, you know, consumption picks up. And all in all, earnings for the second half of the year looks much better than what we're going to see in the first half of the year. A green-looking screen, a good start to the week.
You know, absolutely. And let's hope we're able to build on it and we don't give up the advantage early on. BSE started, I mean, we spotted this early on. The bulk of the move happened by about 11 o'clock. Since then, I mean, there was a brief sell-off which happened at about 11:30 or so. But it's moved higher, and now it's almost up about 6%. So 22.12, and this is the start of the week. So we'll see if there's more here. I mean, from the top, the stock had lost almost about 1,000 rupees, a little more actually. So you know, something to keep an eye out on. We'll ask our guests as well what they make of this move. How should you position yourself in the last hour? That's the question. Mitesh is with us with exactly that answer. Mitesh, what's your sense? Will this last, and what to do about it?
Prashant. So, you know, earlier I said the Nifty could face resistance around 25,000, but the Bank Nifty, you know, if it starts getting past 55,800, 900, in turn could propel the Nifty also. So I think that's happening. My sense is that the Nifty, you know, as long as it closes about 25,000, good chance that it would try to attempt levels of 25,250 and even in a good case scenario 25,400. So these are the two targets which I'm working with. And on the Bank Nifty, I think, you know, closing above 55,900 should suggest further targets of around 56,500 or even 57,000 to about 57,100. And on the stock side, I have BSE in fact one of the recommendations. Buy with a stop at 2184 for targets of 2275. And the other one is United Spirits, which I would recommend buying the stop at 1339 for targets of around 1380.
Mitesh, we're seeing this bounce in IT, perhaps from oversold levels, but is there more strength in the Nifty IT or any play on individual tech stocks?
You know, most of these stocks had fallen a lot. They had also, you know, come to their historical support areas, which were made about a couple of years back. So TC, I think, a good support around this 2900, 2850 zone. It's reversed from there. The first target is around 30 to about 30.50, and once it crosses that, I would even look at higher levels. Similarly, Infosys needs to close above 1480. That should suggest levels of 1520, and in a good case scenario, even 1550.
Okay. All right, Mitesh, got that. Thanks very much for the calls. We'll come back to you for some more ideas in a bit. But right now, let's put the spotlight on financials, because the slew of banking updates that have come in, I mean, it's more good than bad for sure, which is why you're seeing the excitement on the Bank Nifty and overall on the NBFC lot as well. Let's in fact go to Gaurav to get a lowdown on some of the most important updates that have come in today. Gaurav.
Well, yes, many banks came up with their business update, but let's talk about some of them who actually outshined. First, let's talk about HDFC Bank, because loan book growth, now it stands at 9.9%. Remember, the system is growing at around 10.4%. So definitely it seems that HDFC is picking pace in line with the system. When it comes to deposit, that growth was at around 12.5%, which is again higher than the system. In this quarter, the quarterly growth for deposits was at around 1.4%, and that is the reason why the LDR ratio that went up to 98.8%. Remember, the management said that they want this ratio to be around 85 to 90%. Other than that, let's talk about Kotak Mahindra Bank. There also we saw good set of numbers, around 15.8% growth in terms of advances and around 14.5% growth in terms of deposit. So very strong set of number for a bank of a size of Kotak Mahindra Bank. But remember, let's not forget, last quarter, bank came up with good set of numbers, but the growth was driven by corporate banking, and at the same time they also delivered NIM decline, which was not anticipated by market. So definitely let's watch out on these numbers when the numbers came specifically in terms of results. Lastly, let's also talk about Bajaj Finance. Here also we saw a strong set of numbers, 23.5% of growth versus guidance of 23 to 24%. And additionally, the new customer base which was added, that increased almost by 25.6%. So again, very strong set of numbers, and this stock is specifically in focus because of the GST reforms that we have seen, and given that a large portfolio is now catering retail. So definitely good set of numbers for quarter 2. So let's watch out how ROA comes for Bajaj Finance in the results.
Okay, all right, Gaurav, thanks a lot for summing that up neatly. Well, let's welcome Gurmeet Chadha onto the show. Hi, Gurmeet. Good afternoon. Good to see you win. What's your take with regard to these financial / banking updates that we have got? What are you all most bullish? What do you all have, and what do you all build on post this update?
Hi, Nigel. Always good to connect. Extremely constructive on financials, Nigel. I think the RBI policy was more a credit policy than a monetary policy, and two changes. One, in terms of removing the upper cap on 10,000 crore in terms of corporate limit and allowing acquisition finance, to me are big game changers over a period of time. And we've seen a lot of large acquisitions either being done through bond issuances or through structured deals where you are also using other tools, including private equity. I think this would be really helpful for the banks, and I'm not surprised with the way banks have reacted. So we've added more to ICICI Bank. It hasn't done much for almost a year. We have SDFC in the portfolio. We've recently added RBL also. They have announced a fundraise of 3,500 odd crores, but they haven't announced the names in terms of maybe on likes of Yes Bank and others. Maybe a large institutional investor can come there as well, like what has happened with Yes, Shriram, now Samman Capital, reasonably valued. And we are building on to already what we have in terms of NBFC space, which is Jio Financial, Bajaj and Chola. So we are pretty overweight as far as financials are concerned.
Gurmeet, Aditya Birla Lifestyle, do you...
Looks good, and it's turned around since Vishakha has come, especially in last 18 odd months. Even their asset management arm now seems to be doing very well. Including the AMC business. We like the AMC business more over capital. Reason being that this is more annuity driven and less prone to transaction volume like exchanges and depositories are. And the mark-to-market impact on markets going down 5-10% is a lot lesser. And mutual fund portfolios are only going to pick up. So we like AMC over the capital business, but capital also looking good. Even Edelweiss, I think, as I said, you're spoiled for choices right now as far as some of these financial goes.
Okay. All right, Gurmeet, stay on. We want to discuss some of the hospital stocks with you as well, which have had a really, really healthy session, one can say. And the reason is that after many, many years, the government, central government, through its flagship CGHS scheme, they finally decided to revise the rates that are paid to hospitals under the CGHS system. In fact, we'll get in Ekta in a bit on this. She's going to be joining in shortly. So that's one active side of the market. The other, of course, we discussed banks. A lot of the NBFC, large NBFC stocks are also having a really great afternoon. Case in point would be Shriram Finance. Bajaj Finance is also up about 2%. Speaking of NBFCs, Gurmeet, hi, good afternoon. There's a new kid on the block. Well, hardly a new kid. Comes with the pedigrees of the Tata name. Tata Capital, I wonder if you have any thoughts to share with viewers, whether you were enthused by the issue or not. I mean, at one point in time in the so-called grey market, I think shares were trading northwards of 10,000, northwards of 1,000, but it's being offered at around 326. Your views on NBFCs?
So as I said, to be pretty constructive, I think Tata Capital has priced it very well. I think unlisted, there was almost a mania going on. It did not make any sense at 1,000 rupees. Was trading at about 8-9 book value. Probably the peak at which Bajaj Finance used to trade. I think now it's more like 3.25, which is more reasonable. They've been growing well. And because the cost of funds have been lower, and obviously it comes from Tata, so even the risk management framework, the asset classification, if you see, the credit cost has never really been an issue, including 2019 when it happened. So one may look at it, I will not be surprised. It gives you very healthy listing gains as well. So although the grey market premium has slightly come off, but I think it's a good issue in terms of if you are not having enough NBFCs in the portfolio, want to add one which is of good pedigree, I think this could be one.
The other IPO which is open for subscription is WeWork, and today is day 2, and the subscription so far is just about 0.12. The employee portion has been fully reserved, but the others, at least up until now, hasn't seen too much by way of subscription, 0.12. Of all the co-working spaces which have been listed, and recently there were 2. One of them was SmartWorks and the other one is IndiCube. SmartWorks has done very well. SmartWorks listed in July and the stock is up 40% from that level. IndiCube also listed around the same time, again a co-working flexible sort of managed services operator, but that hasn't done too much compared to its issue price. Let's see what WeWork does so far, at least. The first 1.5 day, it's been on the quieter side. But let's put the focus on the other big story as we spoke about pharma, the revision of health scheme rates by the central government and the impact on hospitals. Ekta is now joining in. Ekta.
Well, thanks for that. Yes, the news is that government has announced a major overhaul of CGHS rates, which is the first since 2014, revising tariffs for nearly 2,000 medical procedures. CGHS, or the Central Government Health Scheme, provides cashless health care to central government employees, pensioners and their families across 80 cities, covering around 4.2 million beneficiaries. The new rates, effective October 13th, aim to fix long-standing hospital concerns that outdated packages didn't account for medical inflation. Analysts estimate the average hikes could be around 25 to 30% across key procedures, with cardiology, neurology, orthopedics and oncology seeing increases of even up to 30%. Now, hospitals such as Max Healthcare, Narayana, Yatharth and Fortis are expected to benefit most given their high exposure to government schemes, with Yatharth probably deriving over 30% of its revenues from such programs, and others such as Apollo at 9% from government channels, Max at around 21.8% from institutions, which includes governments, and Global Health and Narayana at around 18% from these government schemes. Analysts say this move could lift hospital EBITDA by mid to low double digits, improve cash flows, though receivables will still need close monitoring. A revision to the ex-servicemen health scheme, which is the ECHS, now may also follow, which could further aid hospital cash flows. And companies such as Fortis, for example, which have around 4.3% exposure to CGHS and 7% exposure to ECHS, hence will then rebase 11% of their revenue from government schemes. So that's the next step to watch out for. As of now, this is definitely positive for cash flows. Will probably start showing in a couple of quarters, but receivables will be something to monitor, though they have improved.
No, it's useful, Ekta. Fortis is the other one, right? It's also in news because of the IHH bid finally getting the SEBI approval for the open offer. Price, of course, will have to be much, much higher.
Well, yes, Fortis Healthcare has been in focus. This is after the promoter IHH Healthcare has received SEBI approval to finally go ahead with that long pending open offer for Fortis and Fortis Malar hospitals. Now, IHH had acquired around 31.1% stake in Fortis for around 4,000 crores back in 2018 and had announced a 26% open offer worth around 3,350 odd crores at 170 rupees per share. But the plan was stalled due to Supreme Court litigation. Now, with SEBI's the process can move forward after a delay of around 7 odd years. Fortis shares, however, have run up nearly 5x, 5 times more than that original offer price of around 170 odd rupees. So analysts say that while this news is positive, it raises questions on what the price of the open offer would be. Will it be revised higher? If so, what formula will be used? And or will the open offer now just be a formality for IHH? Sources close to the company have indicated to me that there should be some clarity on the price and details soon.
Thanks very much, Ekta, for that. Gurmeet, you have exposure here in the space, hospitals?
Prashant, we have Narayana in our portfolio. We did have Max too, but I think looking at valuations, we did trim some. Narayana last quarter was a little soft with the Cayman business not reporting great numbers, slightly lower. The Indian business do well. I also like their strategy of focusing in a mix of tier 2, tier 3. So they're expanding in Kolkata, Raipur, Bangalore, not really as much in, let's say, NCR or Mumbai. So the focus is pretty clear. If you see their average revenue per occupied bed, which is one metrics, that's almost improved to almost 49,000 rupees per bed. They have plans of adding around 2,000 beds. And I think the model is also changing, Prashant, like hotels. It's a combination of refurbishments and brownfield and greenfield expansion, which makes it a little more asset light than what earlier these businesses used to be. So pretty constructive, but let me admit valuations are pretty expensive, including this one on an EV by EBITDA as well as on a price earning. On a price earning is almost 45 times. So you got to be a little careful in terms of taking fresh positions.
Okay, that's hospitals. Finally, Gurmeet, we're in the festive period, so let's end off today's conversation with a festive pick. Now, the stock I was going to ask you about is actually Nykaa, because Nykaa at least sounded pretty optimistic in that Q2 update. Though, I mean, in the past they've failed to fire, and we see all these hoardings and ads of Nykaa fashions as well everywhere now. So tell us your thoughts on Nykaa, and if not Nykaa, anything else in the consumer space? So I've got a couple of updates over the weekend.
So 2-3 names we've added. If you see the RBI data, the maximum loan now is the travel loan. And I think the Gen Z clearly is spending a bulk of the discretionary income towards travel and hospitality. So we increased weight to Indigo. There was some slight correction also post the Gangwal, another tranche which came in the market. Festive season, they're adding, I think, 400 flights more. Fares typically also pick up, long wedding season ahead, and then you have Christmas. So that's something we've added. We are looking at ixigo. I think I like it's a bit of a tech play, and a lot of good things happening there as well. We're meeting the founder team as well there and see if we can, build more conviction around it. And we're adding some hotel names, including Lemon Tree, including Indian Hotels. So we are playing largely as I said, the travel and hospitality. And one new name which we've added is DOMS, which is into children's stationery, as almost 50% has come now into zero GST. And now they're getting into pens and related categories like school bag. Very good business, 2,000 odd crore top line, 250 crore kind of a profit. So we like the business. It's a very good brand recall, and they're gaining market share.
So ixigo you're looking to add. You haven't added it yet.
No, we're not. We're looking to add, yeah.
You're looking to add. And Taj, GVK is also one of the hotel stocks which you own, along with Lemon Tree and Indian.
Yeah, so that's a special situation more, Rima, because eventually I think Indian hotels will exit and I think more institutional investors will come in. And it trades at 18, 19 times, which is half of or less than half of where other hotels are, despite, metrics being good. So there's a bit of an overhang on Indian hotels stake. What will happen to that? That's more of, for us, it's a more tactical bet.
Got that. Thank you very much, Gurmeet, for joining in. As always, get into a break. On the other side, Rajesh Kothari, Managing Director, Alf Accurate Advisors, will be joining in. Stay tuned.
Welcome back. Gains intact, 160 up on the Nifty, and Midcaps are buzzing as well. Good time to bring in Hormuz to figure out what he's looking at. Plenty, on the radar or beneath the radar. Hormuz, take it away. What's on your list?
Most of these names have seen a bit of a spike after noon, and it's seen both in the price action and on volumes as well. It is starting off with Repro India, and the biggest single day gain that the stock has seen since May. It's cooled off slightly. At one point was up around 14-15%, and the last 3 sessions the stock has risen 20%, and one of those names which had seen a price volume spike after 12 noon today. We've had 2 lakh shares that have already been traded. The 20-day average here is only 8,000 shares, and the stock had broken above its 100-day moving average at 514, has cooled off slightly from that. It still remains that important level to watch, and has been an underperformer this year, down around 7 to 8% so far, and was down almost 40% in 2024. That's Repro India. And a couple of PSUs with very little free float are buzzing around today. ITDC has found its name back on the list of gainers. They're 16% higher on the stock, and another one that has risen around 20% in the last 3 sessions. Another one whose price volume saw a spike after noon. And take a look at the volumes here. 45 lakh shares have been traded. The 20-day average here is only 4 lakh shares. And as a result of this move, the stock trades above all of its key moving averages. And today's move has also resulted in the stock turning positive on a year-to-date basis after having gained close to 40% in 2024. Hospitals as a sector has done well today. And a smaller name here, KMC Specialty, was up around 13-14% at one point, still holding on to gains of around 10%. The biggest single-day gain since 2020, volumes being the highest since February of this year. We've had over 5.5 lakh shares that have changed hands. The 20-day average here is only 27,000 shares, and the stock comfortably is now above its 200-day moving average, which was around 68.5. The promoter holding here stands at 75%, but still down around 3% on a year-to-date basis. And the last one on the list today is Mindtech India. Third straight day of gains for the stock here as well, up around 17% in the last 3 sessions. The volumes are the highest since April. We have had close to 7.5 lakh shares that have changed hands today. The 20-day average here is only 34,000 shares. So 34,000 shares being the average, we've had close to 7.5 lakh shares traded, although the stock still down 11% on a year-to-date basis, but the stock was up 60% last year and 70% in 2023. So has been a good mover and doing well today on very strong volumes.
All right. Thanks very much for that, Hormuz. So those are the unusual big movers on the back of volumes which we are seeing. Rajesh Kothari is with us, Managing Director, Alpha Accurate Advisors. Rajesh, great to have you back on the program. Thanks very much. We'll talk about what you have in your portfolio, but let me start by asking you what I don't think you have. Do you have a view, or do you happen to own NetWeb, Rajesh? I think we've discussed this when you were in our office for one of those editors roundtable.
No, that was not this company, so we do not own this name, so no comments here.
I see. Have you studied it though? Have you looked at it?
Yeah, we study almost, many companies. So I think what we do is that it's always better to invest in companies which are probably easy to understand, and probably the growth prospects and the visibility, that's something very important. So in this kind of a business, is very important to check the global businesses and the global valuations and the global growth opportunity. So you need to look at it from that matrices and then decide, it's always better a little bit not to get carried away, right? So.
But if it is the global criteria, then it is very difficult not to buy, because if you look at valuations, of course, everything is more expensive than peer sets abroad. But if it is about AI spends and data centers and hardware and racks and servers, I mean, that's essentially what they do. So it's very hard. You're absolutely right, and sometimes it works out beautifully, because you see something happening globally and then you kind of sort of try to spot what can one do. It's just that it's already done, it is done well. But it was interesting. I asked you that because somebody was likening NetWeb to something what we saw in the EMS space, in the data center, in the Dixons of the world in the early stage. It looked very, stock doubled and then doubled and then doubled. I don't know. The only similarity between both spaces, of course, is that margins are very low. I mean, that industry has 3-4% margin. This industry margin is also not very high in that sense. What have you done, Rajesh, though, across your portfolio since we last spoke? I mean, if you can give us a brief sense.
So basically, as you are aware, the auto is one sector which we have been overweight for quite some time. And, of course, post-GST is one of the large beneficiary, the entire GST cut. And what is happening is because of that, as I was always saying, the content per vehicle, that opportunity to increase the content per vehicle is further going up because of this cut. And therefore, that means that the revenue growth potential for many such companies is much bigger. Also, many of our portfolio companies have entered into the new technology tie-ups with the global companies. And that also opens up one more new segment to cater to, which is a good thing. So that is one sector on which we remain positive. The second sector, which, within banking and finance, the housing is one space which we continue to like. And I think, the growth here is going to be much better compared to the overall banking segment. Third is the specialty chemical, which we have been positive last 15, 18 months. And we keep adding to this basket. There are many interesting companies which are becoming reasonably attractive. And also the growth is going to be much stronger over next probably 12 to 24 months. And fourth, of course, is the select pharmaceuticals, because here in the healthcare space, within pharma, we have multiple segments. One is hospitals, which we continue to like. Second is, the domestic pharma business. Third is the CDMO. And fourth is the special opportunities like, the GLP injectable kind of a business. So there are a lot of bottom-up stock picking, which is good from the pharmaceutical perspective. So I think these are the four sectors. If you look at our AAA budding beast, which is since you're talking about more in mid and small cap space, that's basically the kind of sectors what we currently own. Last but not least, of course, EMS is the large, sector weight in our entire portfolio. Be it the large company or even the mid-sized companies, we own across the companies within the EMS basket. So these are the 4 or 5, sectors and the key, what I would say, the leaders who have a strong growth. So our portfolio is a strong growth positioning, and we expect it to continue to deliver 20 to 25% earnings growth for FY26.
Hi, Rajesh. Yes, absolutely. I can see that pharma is actually your largest holding in terms of sectors at almost 16% of this particular portfolio, followed by engineering and consumer. Now, speaking of engineering, you have a couple of large MNCs that you've held on for a while, right? The likes of Hitachi, and then on the Indian side, the CG Power, which has been one of your key holdings as well. There's an argument in the market whether the time has come to maybe take some money off these industrial and consumer stocks, maybe move some of it to, consumption. Just tell us where you stand there. And what about power? Because the one near consensus theme in the market is power T&D. So some of the companies that you own actually play in that space. But on industrials, and I also don't see, at least in the top 20, I don't see, too much of defense. So is this something you're thinking about, or are you staying away because of valuations or execution risks?
Well, let me come to the first point in terms of the, the capital goods. So here we play the power proxy. So power T&D proxy, the biggest expenditure, the biggest beneficiary is going to be the HVDC. That's a big opportunity. That's a huge opportunity. And I'm sure you would have read last week, one of the company which you mentioned, which is one of our top holding, the parent company has entered into the, the AI, kind of a tie-up, for the global company. So the opportunity for this listed space of those, the global multinational, the opportunity is huge. So one can always get tempted whether one should do profit or not. The important is what kind of PEG you are comfortable to buy at. And till the time the earnings growth is going to be, 25, 30, 40% compounded over the next 2, 3, 4 years, on PEG basis, you need to keep evaluating, and then maybe you can decide to trim or take some profit book. But we continue to remain bullish on these themes. So that is as far as, the capital goods theme goes. As far as, your EMS space question, again, this is a space which is an interesting space. The opportunity is going to be huge. And while, of course, the stock price have run up, but please keep in mind that every 3 months, new PLI schemes are getting launched. And I think we will continue to do that. So from segment 1 mobile, which happened, 3 years back, to the AC component, which happened after that, to the camera modules, which is happening now, to the hardware side, to the semiconductor side, it is a huge value chain, and we are importing a lot even today. So you will continue to see more categories to be introduced for this PLI. And the companies which are holding, they are the biggest beneficiaries, and are also from the capabilities perspective, they are the right companies who will capitalize on this opportunity. And therefore, on EMS space, I think it is just not 1 or 2 quarters kind of a play. It is a much more next 2, 3, 4, 5 years play. So that's another space which we continue to like. Of course, you may find it a little bit expensive, but again, when you look at from the PEG perspective, all of a sudden you will find that they are much cheaper. I mean, look at any big companies. They all are trading at say 18 to 25 times with earnings growth of 6-7%. So actually, PEG is far, far expensive. So I would like to break that myth that the large caps are cheap or mid caps are expensive. No, when you look at on PEG basis, in fact, the mid cap will continue to look a little bit more attractive compared to the large.
You have, I can see Sirma on your top 20. Do you own the others as well? Amber, Dixon, or only one holding in this space?
So well, we own Dixon in our multi-cap AAA IOP portfolio. We own here, a couple of names. As you can see, our large holding is also a semiconductor play. And then, of course, we have a kind of companies, what you mentioned, and then we have another 2 companies which are not part of top 20, but they are next to top 20.
Next to top 20. Got that. Good conversation, Rajesh. Thank you very much for joining in and giving us some perspective on a lot of these themes that we have discussed. You have a good rest of the day. Well, the market's on a very steady wicket, so let's figure out what's happening in the F&O arena. Nigel, what's the latest here?
Well, the Nifty Bank, that's the one that's clearly broken out. Now it's trading above the 20, 50, 100 and 200 DMA. So the Nifty Bank is the one that's really leading the charge in the last few trading sessions, and that bodes well for the Nifty as well. The Nifty PCR, however, it's moving towards the higher end of the band. It's at around 1.35, but that could be a factor that tomorrow we have the weekly expiry that's played out. And now you're having those put writers that are coming into play. So just take a look at the massive addition we have seen. 25,000 put, that's the most active option today. Extremely aggressive writing is what we are seeing, and the premium in a single trading session has come down from around 120 rupees to around 27 rupees. So aggressive writing is what we're seeing at that level. As this is the case, at around 25,050 put as well. Out there as well, the premium has come down by close to around a fourth. At the start of today, it was around 160 rupees. The last time I checked, it was around 40 rupees. Now, some out of the money call buying, that's making you money. If you took a bit of a punt in Friday's trading session towards the close, and you bought this 25,100 call for around 12 rupees, well, your money has more than tripled. So that's the one that's, in fact, the call buyers as well are making money at these levels. And just looking at the screen, for the last few trading sessions, we have been seeing that the FI shorts have been intact. My gut is that today we could see some bit of that short covering that plays out, going by the way the screen is moving in today's trade. Let's focus on a few stocks. Nykaa out of nowhere, that one's seeing big buying out there. Stock up by more than 5%. You have open interest as well surging up. So fresh buying is what we're seeing on that name. As is the case with IDFC First Bank as well. Good amount of fresh buying is what we're seeing on that stock. Well, tech was a sector to go ahead and short. And that's precisely what's being played out. However, today a stock like HCL Tech has come in for a big short covering bounce. The stock has popped up. Open interest is lower as well out there. While on the flip side, metals was the stock that was seeing good amount of fresh buying. Now, in today's trade, there are some mild shorts that are getting accumulated on Tata Steel, so keep an eye out on that stock. And finally, RBL Bank, the stock that's already in the ban. I'll tell you what, every time you see the shorts creeping into the stock, they're getting a little bit nervous. So there is some shedding that we're seeing out there. However, I think the stock continues in the F&O band for a couple of more trading sessions as well. A mild short covering bounce is what we're seeing on that one. But Monday afternoon, the screen is green. The data points are looking quite good. Let's see whether or not the bulls can drive home the advantage. Back to you guys.
Very helpful, Nigel. Thanks very much for that. We'll take a quick commercial break here. We'll come back with what to buy or sell today for reverse trades when we come back tomorrow. Coming up.
Holding on to all their gains, in last 20 minutes to go, Mitesh is back with us with a few BTST calls. Mitesh.
So on the BTST side, I have two calls, and both of them, sorry, both of them are on the buy side. I have the first buy call is on BSC with the United Spirits with a buy at 1339 for targets of 1380, and sorry, I think I covered United Spirits already earlier. Sorry, apologies for that. The first buy call is BTST Siemens with the stop at 3250 for targets of around 3390. And Sun Pharma is a BTST as well. Keep a stop at 1644, look for targets of 1670.
Okay, Siemens, Sun Pharma, and earlier at 2:30, you were telling us about BSC and United Spirits. Well, let's move on now. Now, Tata Capital's IPO opened for subscription today. Earlier today, we had a chat with Rajiv Sabharwal, the MD and CEO of Tata Capital, to discuss the company's strategy. We asked him about his NIMs, his ROA, which is lower than peers, and what the company plans to do about it, to which he said that you need to sort of balance risk with reward. His margins should be looked in context with his credit cost, which is also lower than peers. Listen in.
We've been growing at 25% plus over the last few years. We believe India provides that opportunity of growing at that space. And it also happens because we are present in all segments. Retail and SME, which form about 88% of our book, itself grows at about 17 to 18% in the Indian credit market. And besides this, we are also present in the corporate space. So being present helps us. In terms of margins, I think our margins should be looked at with perspective to our credit costs. Our credit costs have been the least in the industry. If I take away the merger of Tata Motor Finance, Tata Capital has always had credit costs of below 1%. As far as the future is concerned, I think we've always looked at how we can add new products and grow them, which provide better margins. There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year. When you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Okay, all right. Well, let's welcome our next fundamental guest. We have Nirav Asher, who joins us from Latin Manharlal Group, who joins in. Hi, Nirav. Good to have you on the show. Thanks a lot for joining in. Well, NetWeb, that's one stock that's grabbed everyone's attention in the last 1 month or so. Massive move is what we're seeing. Post this big move, what's your take on the company?
Well, good afternoon and thank you for the invite. I think NetWeb has been a very, very impressive performer in the last 1 month. We've seen a massive surge in the price. And this is on account of the fact that the company has come out with its annual report and its presentation, wherein they have highlighted the areas in which they are working, very, very exciting growth prospects, because the company is into high-end computing services, it's into supercomputing, it's into cloud-related services, where there is an immense growth potential. Apart from this, the company is also catering to high-end data center servers. So the prospects are very, very strong, and they have tie-ups with companies like NVIDIA. So I think the growth prospects look quite exciting.
Right. Nirav, hi, good to have you here. So things like NetWeb, you own, just as a disclosure, you own it, right, in the portfolio?
Yes.
And you owned it for a while?
Yeah. Yes.
Okay, and you will continue to own it?
We will continue to hold it because we feel that this is just the beginning.
Okay. No, I completely, I just wanted to make that, because, for viewers, I mean, sometimes these things, people watch it and they say, well, okay, let's see how this, and when stocks move up so rapidly, for many, it's just impossible to hold back but you're saying it's, even fundamentally, it's just as a starting, it's early days. even though the stock price has moved the way it has?
Yes, because the kind of areas which they cater to, like cloud is there, supercomputers is there, data center servers. All these things are yet at an inception point as far as the economy is concerned. So there is immense potential for data centers, etc., going forward, artificial intelligence, high-end computing services, etc. So this is just the beginning. That's what we believe.
Got that. Fair enough. You know, we'll have. I think the IIFL is the only broker who's got coverage, and their estimates show that on FY27 basis, it's trading at, I think, 45, 50 times. But there are many in that space, you know, generally overall, which are trading at 40, 50 times a year forward earnings. So yeah, but stock's done very, very well over the last 1 year or so. Well, let's talk about another story, and we'll come back to Nirav in just a bit. Now, 7 years after the ugly spat between Cyrus Mistry and Ratan Tata over Tata Sons, another boardroom battle is brewing at what is one of India's oldest and largest conglomerates. That is, of course, the Tata Group. Hormuz is here just to break this down for us. Hormuz, over to you.
You know, indeed, and there is a fresh battle that is brewing at one of India's oldest and largest conglomerates, and there are reports of infighting that have emerged almost 9 years after the Ratan Tata versus Cyrus Mistry battle, and so much so that sources are now telling CNBC-TV18 that this has landed at the doorsteps of the government. Now, what is the bone of contention here? The bone of contention is that the power struggle over the leadership within the Tata Trusts. Noel Tata is currently the chairman of the Tata Trusts after Ratan Tata's passing, and he's also opposed to Melly Mistry's attempts to get a board position. Now, he's also opposed to him getting a leadership role at the Tata Trust. Now, who is Melly Mistry? He is a director of the Mayor Polonji Group. He's a strong supporter of the late Ratan Tata and an estranged first cousin of the late Cyrus Mistry as well. Now, during that hugely public spat between the two, Melly Mistry was in favor of Ratan Tata during that period. Now, what are some of the recent developments that have happened at Tata Sons? As a result of this public spat, there was an amendment made to the Articles of Association during the 2022 AGM, which prevents the same person from chairing Tata Trusts and Tata Sons. And as a result of which, Noel Tata is now the chairman of the Tata Trusts, while N. Chandrasekaran is the chairman of the Tata Sons. Now, what has happened here is that the amendment was approved by shareholders, and as a result of which, the two entities were legally separated. Now, as early as last month, on the 11th of September, the 3-hour-long board meeting ended with the removal of Vijay Singh from the board of Tata Sons. Now, the trustees, usually who vote in consensus with decision-making, it was a 4-3 vote in favor of Singh's removal, where despite the fact that Noel Tata, Singh himself and Venu Srinivasan continued to vote in favor of Singh to continue on the board. Now, who is Vijay Singh? Now, 77-year-old former defense secretary, so a seasoned bureaucrat. He was one of the late Ratan Tata's closest confidants as well. And some of the issues raised in that meeting was the fact that he's above the cutoff age of 75, now that he's 77. And some of the issues raised by Pramit Jhaveri, one of the trustees, is the fact that the reappointment of Anita George as an independent director with consulting all trustees was not done. He also raised the fact that Article 121A, which requires all investments, acquisitions or disinvestment proposals above 100 crore to have prior approval from the trustees, and that was not being followed. Now, some of the issues raised here. What Noel Tata and Venu Srinivasan said during the meeting is that Singh's removal will set a very damaging precedent. And what further exaggerated matters was the fact that Darius Khambata, one of the trustees as well, he nominated Melly Mistry to the Tata Sons board, something that Noel Tata went on to reject. Now, what are the challenges that Tata Sons is facing? Other than all of this, there's also a lot of pressure to go public from the Reserve Bank of India. There is a lot of back and forth over this. There are also questions over transparency, governance, future control as well. So, a lot brewing at Tata Sons. The sources are telling us that the meeting has now landed at the doorsteps of the government. Only time will tell where this boardroom battle is headed.
Thank you very much for that. Well explained. Get into a break. On the other side, more market talk. Stay tuned.
Welcome back. Well, let's focus on the hospital stocks because they are clearly the sector of the day. We're still in conversation with Nirav Asher. Nirav, what is your take on the hospital stocks? All of them have popped up in trade. This good news has been digested, or do you think there is some value in a couple of these stocks?
Well, I think there's been a revision in the CGHS rates, and that has given a boost to the hospital stocks. I think there's been a lot of interest in the hospital stocks by the private equity players, and private equity investments have been on the rise as far as the hospital sector is concerned. The hospital sector has reported impressive rise in the occupancy ratios with improvements in average revenue per occupied bed in the recent past. And I think, but if one were to take into account the valuations, they are looking very expensive at this point of time. Most of the hospital stocks are trading at valuations close to 100 times price to earning multiples. So I think, barring a few stocks like Aster DM Healthcare, which is looking quite reasonable from a valuation perspective, the rest of the stocks are looking quite expensive.
Nirav, have you all studied LG Electronics? That's the large IPO which comes tomorrow. On a trailing basis, the PE is 35 times. So the forward multiple will be even less. And this compares it favorably with, say, a Havells, which is 45 times forward, a Voltas 40 times, a Blue Star 46 times. So just prima facie, we've not gone into deep analysis, but it does look attractive valuation-wise.
Well, that's true because LG Electronics is a very known name. They have a very strong brand presence and a strong distribution network across the country. So I think a valuation of 35 times definitely warrants investment from a listing gain point of view also.
What we can do is that it is just coming to you. We have Sanjay Mukim also join us in the morning from JP Morgan. A bunch of stuff we spoke with him about. So let's just quickly play out some of those sound bites, and we're back with Nirav in just a bit.
Let's say an India-US deal could alleviate some of the pressures on the Indian equity market, and you may see a bounce on the announcement of one. But it may not necessarily be redemption for the underperformance that we have seen so far for MSCI India. See, India, everybody agrees, has a lot of potential in the long term or the medium term, right? There's all the known tailwinds of continued urbanization, the manufacturing drive that the government's pushing, urbanization, that's likely, the demographics that everybody agrees to. So those factors sustain, and India therefore remains a place of inquiry for everybody for the long term. I think the challenge, at least in the near term, is the fact, like I was saying earlier, that other markets have delivered much sharper bounces. There's greater clarity on many others, let's say tech-related sectors, of course. And a lot of investors were not necessarily positioned to participate in those rallies early on. And therefore, you see continued rotation out of India, which had been owned by them for a while, into these newer momentum areas. EPS expectations for the S&P in the near term are actually being upgraded. Right now, you can debate why it is happening. It's only tech-driven, or that you would cut them too much after the Liberation Day tariffs, etc. But nevertheless, for equity investors, you're seeing upgrades in the S&P EPS number. How sustainable they are, we can all debate. But in India, we have not seen that earnings momentum as well. So you need to start to, let's say, catch up on those trends, deliver some bottom-up momentum before you can claim some interest from foreign investors. There doesn't seem to be a leverage problem in the corporate sector, but possibly a leverage problem in the government sector. Looking at more consumer-oriented stocks in the near term makes a lot of sense. Now, the challenge, of course, investors face is many of the stocks have already gone up. So the question is, where is it not priced? Where are further surprises likely? And we would argue that where there is elasticity to the price cuts that have come through is where we would continue to look at. So maybe some of the auto-related names make sense. The discretionary, obviously, you'll have greater elasticity to price cuts that staples. So those are the sectors where, I would agree with the consumer over capex in the near term, but more discretionary than staples.
Okay, that was a view from JP Morgan that we got earlier on. Well, one more leg of the market that's working fairly well is the so-called new age internet stocks. We've discussed Nykaa, of course, that's one of them. The other is Delivery. Then there is Ixigo, Lease Avenues Tech. Some of these are doing fairly okay. And then, of course, there's Eternal, the big one, which is nicely coasting along with a 2% gain. Nirav, any picks out of this lot? And it's a wide basket now. I've been throwing an urban company recently listed as well. But you tell us, would you back anyone? And if yes, why?
I think Nykaa has reported a strong set of numbers. The quarterly updates was quite strong and is on the comeback trail. So I think Nykaa and Honasa are looking good from a medium to long term perspective.
Nykaa and Honasa. Okay. All right. Got that. Okay. So that's on this side. On the NBFCs, I mean, there are lots of names, and today is a great day anyway for NBFCs, from Shriram to Bajaj. I'm just seeing Chola Investments. Let's pull up the Chola Investment stock. 5.5%, big surge coming in on Chola this afternoon. Again, you know, what's the narrative? Are you better off right now allocating, say, fresh capital to tier 1 banks, or would you look at NBFCs? And if it is NBFCs, then which one would you go for? And maybe a thought on Chola specifically, if you can give us one.
I think we would stick to Bajaj Finance. So I think recent update has been quite strong, 24% growth in the AUM. So I think we'll stick to Bajaj Finance.
Got that. Nirav, any IT stock, mid-cap or large cap, which is attractive at... any mid-cap or large-cap IT stock which looks attractive at this juncture, or it's still too early to buy, even as a value pick?
I think Coforge is looking quite good because we are expecting a 6% at least quarter-on-quarter growth, and that's the best at this point of time.
Okay. All right, Nirav, we'll wind it up on that note. Thank you very much for joining us today. So since we've got just about a minute or so left for the day to end, let's take stock of what's been a really great session, actually, a flying Monday for the bulls. 25,070 plus on the Nifty, a gain of nearly 200 points. So it has been looking pretty good. And, you know, it's not a day where 3 or 4 large cap stocks alone have led the market higher. The good thing is that it's been very diverse across many important sectors, and it's spread to mid-caps as well. To start with, of course, there is the whole hospitals play in the market, with Max Healthcare leading the charts, 6.5% higher. Then, of course, financials have had a phenomenal session today. Look at Shriram Finance, 4%. You have more names, Axis Bank, Kotak Mahindra Bank, Bajaj Finance, which we've been discussing the business updates over there, looking fairly good. Let me see the final rates on HDFC Bank. Again, with 10% growth, it's met the mark and made most of the people happy on the street. So 1% up on that stock as well. And then the other good news is ahead of earnings season. Maybe it's just positioning before the IT earnings roll in. But for what it's worth, look at that, 3% on TCS. So very, very decent moves coming in on the IT names as well. Infosys 2% higher, HCL Tech, the entire lot. Good buying on auto as well, by the way. Bajaj Auto, Maruti, these stocks have seen a fair amount of strength as well. So pretty well-rounded day for large caps.
Well, on the way down, though, Trent and Avenue Supermarts were under pressure. Trent just came out with the Q2 update. The top line, the standalone revenue has gone up by 17%. This is less than the 19% growth in Q1. So the street appears to be a bit disappointed. The stock ends down, top loser on the Nifty, and that's down close to about 2.5%. And other than that, you even had Avenue Supermarts, which went home with a fall of nearly 3%.
Absolutely. That's the bell as it goes off, and we are now 180 points. The adjusted close shouldn't be very different. It's not as if there's been a large amount of movement one way or the other. So 25,075 is where we are at on the index by close. So pretty good close. Market breadth, though, negative by a little bit. 1,700 stocks lower and about 1,400 stocks are higher at this stage. I think we're going to wrap up on this edition of Closing Bell. From all of us here, it's goodbye. Thanks for joining us. But markets forward will pick up and wrap up things for you and look ahead as well. Stay tuned.
Dalal Street gains for the third straight day. Nifty reclaims that 25,000 mark. In fact, financials and IT both bat for the bulls. Broader markets outperform blue chips. However, market-bred favors declines despite a positive close.
Business updates by top banks and NBFCs point to strong credit growth in the second quarter, with the lenders like PNB also indicating optimism in corporate credit growth going forward. Small finance banks also see recoveries in microcredit rise.
The hospital space was in focus. Fortis Healthcare gets a thumbs up from the SEBI for the long-stymied open offer by parent IHH, while another boost for all government empaneled hospitals comes in from an upward revision in the central government health services rates after 14 long years.
Hello and welcome to Markets Forward, your go-to show where we aim to tell you all about trade as it happened today and more importantly, prep you up for the session that lies ahead. I'm Surabhi Upadhyay. With me is Mangalam Malu. And Mangalam, it was not a manic Monday at all. Actually, the bulls had a rather good start to the week, showing some traction pretty much across the board today.
It was a good day of trade. You know, you had two of the star batters of the Nifty batting for it. You had the Nifty Bank, which did well, almost 1% higher. The IT index doing a lot better as well. And we did see a lot of these gains being backed by strong fundamentals or the second quarter update. So all of that does well for us. Not only are we looking at the earnings season from here on, also the second half of this year, where a lot of consumption pickup is expected. So let's tell you what we have in store for you today. We start with the top movers and shakers of the day with Hormas Vatakia. Thereafter, business updates by top banks and NBFCs and a couple of these consumer names like Nykaa, which also saw strong gains as growth momentum continued. Fortis Healthcare is another one which rallied as its IHH has received the SEBI's approval to proceed with its open offer and increase its stake in the company. And finally, we delve into the key market events to watch out for tomorrow's trading session. So let's go up top to the first segment. Hormas Vatakia on the big wall for all the movers and shakers of the day. Hormas.
Well, hospitals were the theme of the day, and for good reason today. In the pink of health were all of these hospital names, be it Apollo, Max Healthcare, the newest entrant to the Nifty 50, also doing fairly well for itself today, gains of around 6%. Fortis, of course, there were multiple triggers surrounding Fortis, not just the CGHS price revision, but also the open offer approval that it received. So positive for Fortis as well. And some of the other hospital names like Yatharth and Narayana Health also did fairly well for themselves in today's session. Some of the other movers today included the likes of there plenty of reactions to the business updates as well, right? Almost every other banking stock, financial name came out with business updates. Nykaa was the standout, 6.5% higher, and Trent at one point was down 2.5% once the business update was released, ending with the final tick ending 1% lower. Now, some of the other movers today, the newsmakers of the day, other than the business updates, Aditya Birla Lifestyle after the block deal, Delivery, the upgrade from Kotak, Premier Explosives, the defense names were in focus today, and Vodafone Idea, the back and forth regards to the AGR hearing continues, another date, and the stock ending 4% lower. Plenty of stocks in the small cap space did really well on very strong volumes as well. You look at KIOCL, another 20% circuit, Orient Technologies, another 20% circuit, ITDC, Repro, Ixigo, all of them saw gains of anywhere between 9 to 10%, and on very strong volumes as well. Lastly, some profit booking, and the auto ancillary names that were flying about last month, seeing some profit booking led by Lumax, led by RACL Geartech, Shankara Building, another lower circuit for the stock, and Aegis Logistics was up and about on Friday's session. Some bit of pullback seen in today's trade.
Okay, all right, Hormas, thanks very much. That's a neat summary and wrap, really helps. So let's discuss some of these names, of course, and overall market trends with our guest today. We have Nirav Ashar joining in, and I think we of course also have Jay Thakkar with us from ICICI Securities. Jay, great to have you in. Let's first talk technicals and the market structure, because Friday's move coupled with today's move, it's 2 good days, and I think the Nifty is now above the 20 DMA once again. So is this a buy the dip sort of a market? And again, I mean, between Nifty, Bank Nifty, what looked better to you today?
Hi, good afternoon to you, Surabhi, and Mangalam. Well, see, as far as Nifty is concerned, yet again, Surabhi, I would say that Nifty has reversed or managed to reverse from the lower end of the range. I mean, if we see Nifty's in this financial year, particularly since April, Surabhi, it has been taking support in this band of say 24,300, 400 on the lower side. This time around, it has reversed almost from 550, 600 levels. And on the upside, also what we have witnessed is that it manages to test the levels of 25,200. In fact, even managed to surpass those levels. A couple of times it has done so in last 6 months, in this last 2 quarters, but then it could not sustain at the high level. So broadly, if you see then 25,200 and 24,500, broadly this 700 point range has been there for Nifty for the past 2 quarters is what we have seen. And it has again reversed from the lower end of the range. Most of the time we see different sectors, being into the flavor. So this time around, we have seen that automobile was one of the sectors which performed quite well. Recently we have seen the OMCs performing quite well. The banking, since the RBI's monetary policy last week, we have seen that sector coming back. The banking and financial services, both of them. And metals, I mean, they have been shining strong, so either it's gold, silver, Surbi, or maybe, the overall ferrous, non-ferrous space in the equities as well. I mean, that's too performing. So these are the few sectors which are performing right now. And I think looking at that, it again indicates that Nifty is heading towards 25,200 to 400 range now on an immediate basis. A few of the good names are also doing good, like L&T or Siemens. So 25,200, 400 looks on cards. And on the lower side, Surbi 24,800. Now that's an immediate support. I mean, that has always been since past 6 months. That's the level. I mean, below that you see the weakness, and about 24,800 you see the strength.
Take that point.
24,800 is the.
Take that point, Jay. Thank you for telling us about the range on the Nifty. What will be very interesting is to see what the FIIs do after this up move that we've seen for the second consecutive session. Because on Friday, despite the up move we saw in the last hour of trade, a big move. The FIs went ahead and added a few more shorts, 13,000 short contracts. So now, do we see some short covering? The 25,000 call has a lot of these option writers written, that call. So they hope that maybe the Nifty would find some sort of resistance here. If it doesn't, then those call writers tomorrow, given the weekly options expiry, will have to unwind their positions. But a lot of the business updates that came in from top banks and NBFCs point to strong credit growth in the second quarter. Will that result in better GDP numbers as well? Gaurav Jabalkar joins in with the details of these updates. Gaurav.
Well, let's talk about HDFC Bank. Now, the growth for loan book has been at around 9.9%. Remember, the system level growth was at around 10.4% till 19th of September. So definitely, bank is showing some kind of revival and also in line with the system growth. When it comes to deposit, that growth was at around 12.4% on a year-on-year basis. And in this quarter specifically, we saw LDR actually increasing to 98.8%. But at the same time, analysts do believe that by the end of Q4, we will see LDR settling down. So definitely some green shoots here. Kotak Mahindra Bank came up with very great set of numbers, 15.8% growth on a year-on-year basis in terms of loan book and around 14.6% growth in terms of deposits. Remember, the last quarter also, Kotak Mahindra Bank gave a very strong update in terms of the quarterly updates, but later on we saw that corporate banking was something which drove the growth, and at the same time NIMs also declined. So definitely during the results we will be watching out on what actually drove this growth of around 15.8%, but as of now, good set of numbers in terms of quarterly updates. Bajaj Finance, here also we saw 23.6% growth on a year-on-year basis. Specifically, the new customer addition, there we saw a growth of around 25% on a year-on-year basis. So that was strong. Remember, this stock is already in focus because of the company having big retail book, and the GST reforms are likely to support the retail book and retail growth. Lastly, let's also talk about Bank of Maharashtra. In the morning, we got these updates. Deposits increase almost by 12%, while advances that increase almost by 17%. What makes the bank stand out is that the corporate book that increased almost by 16.6%, and at the same time retail book that increased almost by 37% on a year-on-year basis. As a result, if you look at all these stocks, they held up well in trade. All were up more than 1%. So definitely, let's watch out how the results came for these banks. But from the quarterly perspective, good set of numbers in terms of the updates from the bank so far.
All right, good numbers from the bank so far. In the consumer space, though, it has been a tale of two cities. Some of them have done extremely well, some not so much. We had, Nykaa, DMart and Trent, all of them coming out of their second quarter business updates. Nykaa soared about 6.5%, so good numbers coming in out there as well. What it basically, means is that their overall revenue for Nykaa is likely to grow faster. DMart is the other one, which is also reporting their numbers. So Nykaa said they saw a GMV growth of near 30s versus mid-20s what they did in the last few quarters. Importantly, this business was led by the fashion business. Over the last few quarters, beauty was driving everything for Nykaa, and the street was believing that maybe, fashion will be a drag. Turns out that the fashion business has turned around, and this is something that the management had told us about earlier as well. The second half of this year, fairly strong for fashion, where the net revenue growth will come to low 20s as against low to mid-teens. So that, with the beauty business staying stable, does overall good for Nykaa, and that stock up around 6.5%. DMart, on the other hand, despite the up move that we saw after the analyst meet outcome, which was fairly bullish, the numbers don't have much to show for. The revenue growth has been 15.4%. The 3-year CAGR has been around 15.8%, so no great shakes out there. They've added about 7-8 stores during this quarter as well, which means that the first half of this year, they've added 17 stores. And over the last 1 year, the store addition has been 14.5%, which implies the same store sales growth of just 1%. The bigger worry that the street has is that with the GST cuts coming in, will price sales go down in the second half or not? Because what was available at 10 earlier will now be available at 8. And if there is not enough volume offtake to actually, replenish that, then maybe there could be lower sales versus last year. The other thing that we're looking at, Trent, that stock too ended at the low point of trade as the company reported their second quarter update. The key highlight of this number was 17% growth in the revenue, and the first half of this year has been 19%. The first quarter has been 20%. So across quarter on quarter, year on year, the growth rate has slowed down. In fact, the management of Trent in an analyst meet said that 25% growth is something that's sustainable. And for 2 quarters in a row, that hasn't happened. Their last 5-year CAGR on the revenue has been 35%. So that's also the current quarter numbers have been half of what the historical growth rate for Trent has been. Same store sales growth in Zudio, and sales in the second half again will be something we'll be watching out for Trent. And more importantly, now the Zudio story seems to be digested in the price for Trent. So growth out there is now sustainable, predictable. What the newer formats of the company would do with regards to, say, the Star Bazaar grocery format, or their ethnic wear business, Utsaah, or even their streetwear, premium streetwear business called Burnt Toast, how do they scale those businesses will bring the next leg of an up move for Trent, which is nearly half from its previous 52-week high, which actually, incidentally, was on 8th October 2024 at around that 8,200 mark.
Wow, I mean, very close to exactly 1 year back. Stock is halved, but then growth rates have halved as well, from 50% to less than 25% now. So that explains it. I guess street wanting more innovation and again hungry for growth. Thank you for that, Mangalam. Actually, let's look at some more important corporate developments which were shaping stock price action today. Fortis Healthcare was in sharp focus, and that stock was up 6% because the company has finally received SEBI's approval to go ahead with the open offer and increase stake in Fortis Healthcare as well as Fortis Malar. Now, this is IHH finally receiving that approval to launch the open offer. Ekta is here to explain the implications to us. Ekta, this has been in the works for so many years now.
Well, yes, Fortis Healthcare has been in focus. This is after the promoter IHH Healthcare has received SEBI approval to finally go ahead with that long pending open offer for Fortis and Fortis Malar hospitals. Now, IHH had acquired around 31.1% stake in Fortis for around 4,000 crores back in 2018 and had announced a 26% open offer worth around 3,350 odd crores at 170 rupees per share. But the plan was stalled due to Supreme Court litigation. Now, with SEBI's the process can move forward after a delay of around 7 odd years. Fortis shares, however, have run up nearly 5x, 5 times more than that original offer price of around 170 odd rupees. So analysts say that while this news is positive, it raises questions on what the price of the open offer would be. Will it be revised higher? If so, what formula will be used? And or will the open offer now just be a formality for IHH? Sources close to the company have indicated to me that there should be some clarity on the price and details soon.
Okay. All right, Ekta, thank you very much for that. We also have Mayuresh Joshi joining in for some quick perspective. Mayuresh, I'll do a quick rapid fire with you. First of all, on Fortis, now it's anyone's guess at what price this open offer comes, because the landscape 7 years ago was very different. But would you buy the stock in anticipation of a very handsome open offer price?
So, Survi, as a disclaimer, I think we remain positive and optimistic on the stock, and we continue holding this stock.
Okay. We were just discussing a whole bunch of consumer updates before you joined us, Mayuresh. So, and some of these stocks, for instance, we were debating Trent, where the numbers are not as glamorous as what they used to be. So stay away, or buy the dip now and just be patient?
So wait and watch. I think what we are holding in our portfolios are stocks like a V-Mart Retail and a Vishal Megamart.
Okay, and what about Avenue Supermart, D-Mart?
No, we'll wait again. I think because it's a mix of apparel, groceries, and FMCG.
I think this is the rapidest fire that we've had with you, Mayuresh, out here. So let's keep it a lot more open then. What do you like currently from everything that has been reported?
Also, I think a few banks have delivered a great set of numbers as far as the banking universe is concerned. And therefore, I think the bank Nifty moved quite significantly. I think it was a surprise to us as well, because we thought it might be a very traditionally soft quarter. So again, I think PSU banks, Bank of Baroda as an example, HDFC Bank has given a good update as well. So I think banks have probably stolen the limelight in terms of updates given in Q2 so far.
Okay, we're going to squeeze in a question on hospitals as well, Mayuresh, and you know why, because they've had such a good move today. But before that, let's go back to Ekta so she can explain the news to us, because after many, many years, I mean almost a decade, CGHS, the central government agency, is looking at revising rates for a lot of the treatment charges that they pay to these hospitals. So the hospitals stand to benefit, the ones who have large CGHS exposure. Ekta, fill us in.
Well, thanks for that. Yes, the news is that government has announced a major overhaul of CGHS rates, which is the first since 2014, revising tariffs for nearly 2,000 medical procedures. CGHS, or the Central Government Health Scheme, provides cashless health care to central government employees, pensioners and their families across 80 cities, covering around 4.2 million beneficiaries. The new rates, effective October 13th, aim to fix long-standing hospital concerns that outdated packages didn't account for medical inflation. Analysts estimate the average hikes could be around 25 to 30% across key procedures, with cardiology, neurology, orthopedics and oncology seeing increases of even up to 30%. Now, hospitals such as Max Healthcare, Narayana, Yatharth and Fortis are expected to benefit most given their high exposure to government schemes, with Yatharth probably deriving over 30% of its revenues from such programs, and others such as Apollo at 9% from government channels, Max at around 21.8% from institutions, which includes governments, and Global Health and Narayana at around 18% from these government schemes. Analysts say this move could lift hospital EBITDA by mid to low double digits, improve cash flows, though receivables will still need close monitoring. A revision to the ex-servicemen health scheme, which is the ECHS, now may also follow, which could further aid hospital cash flows. And companies such as Fortis, for example, which have around 4.3% exposure to CGHS and 7% exposure to ECHS, hence will then rebase 11% of their revenue from government schemes. So that's the next step to watch out for. As of now, this is definitely positive for cash flows. Will probably start showing in a couple of quarters, but receivables will be something to monitor, though they have improved.
Yeah, I got that point, and that chart explains why Max was jumping the most today, 7% higher, because they have the largest exposure to these central government schemes. Very quickly, gentlemen, on the technicals, on the fundamentals, hospital stocks, any picks here, Mayuresh?
Remain positive, Surabhi, again. I think so. We own a whole host of hospital stocks. Max, Fortis, Apollo Hospitals, schemes. I think we remain positive on this space.
Okay, so you don't need to worry. You don't need to spend too much mind thinking which one to pick and choose now. You own pretty much the whole sector. Jay, what about the charts? I mean, Max had a great run today, but otherwise it was always Apollo, over the last many quarters that was leading the charge. You tell us, what's the best technical pick in hospitals?
Well, I would still go with Apollo Hospitals, Surabhi. It's just not based on the historical data, but also looking at the derivatives data. I mean, this stock has witnessed good long additions, and yes, historically, as you said, that whenever Nifty has shown a positive returns, in fact, more than 5% or so, Apollo has always been one of the performing stocks when Nifty is moving beyond 5% kind of a thing. So, and from the derivatives angle, we have seen long build-up. Max, a move today was mainly on account of short covering. It has recently entered into Nifty 50. So and prior to entering into Nifty 50, we had seen this stock falling on account of short build-up. So there was huge short build-up out there. And because of those huge short positions, we have seen some, short covering happening today on account of this positive news. So if I have to pick and choose, then it would be, Apollo Hospitals first.
All right, Apollo Hospitals first and thereafter Max Healthcare, which today perhaps could have been exaggerated on the way of short covering. Thank you, Jay and Mayuresh, for quick thoughts on a whole host of sectors and stocks. With that, we'll take a short break, come back, get you all the corporate voices along with the key market events to watch out for on the other side of the short break. Stay with us. Watching us here on Markets Forward, let's get you all the top corporate voices that we had on our channel today. The big IPO that opened, Tata Capital's Managing Director Rajiv Sabharwal joined us. He said that the company has been growing over 25% annually, excluding the Tata Motors Finance merger. Sabharwal also said that Tata Capital has been among the top 3 players in affordable housing, and he's focusing on building a resilient asset book to withstand soft market conditions. The company expects a bumper third and fourth quarter performance, with freshly raised capital to be fully deployed within one and a half years. He noted the strong support from the Tata Sons and added that Tata Capital may look to raise fresh funds in about 3 years from now. They're looking to increase their stake in unsecured lending from its current 12%.
Okay, Pace Digitech made a decent market debut, listing at a 3% premium over its issue price. Speaking to CNBC-TV18, the company says that strong growth in FY24 was driven by a government order win. It added that it is focused on executing existing projects, while FY26 is expected to be a stronger year. The firm reported an order inflow of 7,000 crore rupees executable over the next 18 months. The company also said that it would build a strong balance sheet with FY26 seeing recognition from the energy space as well.
Healthcare Global Chairman B.S. Ajay Kumar joined us here on CNBC-TV18 on a day when hospitals were in focus. He said that delay in payments under the CGHS scheme is not very significant. Notice that it's only a small proportion of their overall exposure, but a positive for those who have a higher exposure. The company has about 25% exposure to schemes like ESI, CHS and various local and state government programs. So this CGHS revision does pave the way for other revisions as well. For reimbursement in India, particularly for cancer, care remains poor, calling the ESI scheme the weakest among them. He said that CGHS could set an important trend to help bridge this gap.
Okay, all right. So that's some of the corporate commentary. But before we sign out, it's time to tell you about some of the key market events to watch out for tomorrow. Gaurav is here with those details. Gaurav.
Well, yes. First, let's talk about global event. Now, World Bank is going to release economic forecast report. Let's see if we get anything material from the point of view of Eagle's Eye. Other than that, on the trade-related activities, we have a lot to cover. First is that India and Qatar, they are set to discuss free trade agreement. In fact, Union Minister Mr. Piyush Goyal is already in Qatar to discuss that. Other than that, India and European Union, they are also going to have 14th round of FTA negotiation. At the same time, let's also not forget that India is also going to hold formal trade monitoring mechanism meeting with Brazil. So let's see if anything material comes out of these meetings, because specifically on the trade related activities, this is going to be a key thing to watch out for. Let's also not forget that Shringar House of Mangalsutra, the newly listed company, will come up with their Q1 FY26 numbers. Remember, the company actually during its IPO gave decent gains to investors, and today also the stock was up more than 6%. And lastly, let's also not forget that LG Electronics will come up with their IPO tomorrow. 11,500 crores is the size of IPO. They are going to offload around 15% stake. So it is really crucial to see how market treats it, because remember there is another IPO which is in the market already of Tata Capital, the 15,000 crores IPO. So let's see if market allows the appetite to take care of both these IPOs. So on the back of that, we will be watching out on all these events from here on tomorrow.
All right, Gaurav, thanks a lot for that. A lot of IPOs, a lot of trade talks, so much happening. Add to that, the spice of a weekly options expiry tomorrow on Tuesday itself will make it an exciting session. What we'll do is take your leave on that note, but you stay tuned to CNBC TV18. All the news and updates continue on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty rise for the third straight session. Nifty reclaims 25,000. Gold prices hit yet another record high as the rally continues. Nearly a decade after the spat between Cyrus Mistry and Ratan Tata, another power struggle is brewing at the Tata Group, infighting at majority shareholder Tata Trust over appointment of directors and sharing of information. Sources say top executives at Tata Group set to meet senior government officials. The 15,500 crore rupee Tata Capital IPO opens after strong response from anchor investors. About 35% of the book subscribed on the first day. Madhya Pradesh police arrests a government doctor for prescribing a cough syrup linked to the deaths of 14 children. A special investigation team has been formed to probe the syrup manufacturer based in Tamil Nadu. The body of a 2-year-old has been exhumed for autopsy. Government revises the rates for nearly 2,000 medical procedures for the first time since 2014. Analysts say rates hiked by over 25% for key medical procedures under the central government health scheme. Shares of private hospital chains rally in trade. External Affairs Minister S. Jaishankar says any trade deal between India and the US must respect New Delhi's red lines. Also says efforts are underway to reach an understanding, but both countries have failed to arrive at a landing ground so far. Commerce Minister Piyush Goyal is in Qatar to finalize the terms of a free trade agreement as India seeks expansion of exports. The bilateral trade between both nations was at $14 billion in FY25, with India's energy imports accounting for $12 billion. Supreme Court sends a notice to the government over the arrest of climate activist Sonam Wangchuk, asked the centre to consider sharing the grounds for his preventive detention with his wife. Wangchuk was arrested under the stringent National Security Act following violent protests in Ladakh. And Israel continues to bomb Gaza despite warnings from the US authorities. Delegations from Hamas and Israel gather in Egypt along with mediators to start negotiations to end the war and free the hostages. All right, let's start with the day's market action. The Wall Street gained for the third straight day. Nifty reclaimed the 25,000 mark, largely led by financials and IT stocks. However, the market breadth favoured the declines despite a green close. From equities to commodities, gold prices have surged past the $3,900 an ounce mark for the first time in the international markets. This as investors flock to the safe haven metal amid the US government shutdown and broader economic uncertainty. Meanwhile, safe haven demand also pushed Bitcoin over the $125,000 mark. However, prices eased marginally soon after. Fears of a pile-up in global debt also supported prices. Growth in India's services sector eased in September, according to HSBC S&P Global Purchasing Managers Index. Services PMI fell to 60.9 from a 15-year high of 62.9 in August. Similarly, the composite PMI reading declined to 61 against 63 in August. Tata Capital's 15,500 crore rupee initial public offering saw 36% subscription on day one. Qualified institutional buyers subscribed to 52% of the portion allocated to them, while retail investors booked 32% of their portion. Speaking to CNBC-TV18, Tata Capital CEO Rajiv Sabharwal addressed margin concerns as the firm has reported the smallest profit margins compared to its peers. Sabharwal said margins for the company's low credit costs should be considered while looking at margins.
There'll be some products where through the raw material, the impact will be seen over the next 3 months or so. So I think we are really expecting Q3 and Q4 to be really bumper quarters for this year. When you talk about the credit quality and such issues, we've been pretty quick on responding whenever there were challenges. In fact, when we saw challenges in certain segments, we became tighter and more conservative. And that was reflected in terms of our growth in those areas also. As I mentioned just some time back, we feel the worst of credit cost is behind us.
Right, nearly a decade after the spat between Cyrus Mistry and Ratan Tata, another power struggle is brewing at the Tata Group. Divisions have emerged at Tata Trusts, which owns 66% stake in Tata Sons, over the appointment of directors and sharing of information. Noel Tata is the chairman of Tata Trust, which currently has 6 members. Former Union Defence Secretary Vijay Singh was removed as a trustee in September. Infighting at majority shareholder Tata Trust over appointment of directors and sharing of information. Sources say that top executives at the Tata Group are set to meet senior government officials. Currently, Noel Tata and Venu Srinivasan are the only members to be part of both Tata Trust's trustee group and the board of Tata Sons. Hormaz Fatakia is here with more on the tensions between Tata Trust executives.
There is a fresh battle that is brewing at one of India's oldest and largest conglomerates, and there are reports of infighting that have emerged almost 9 years after the Ratan Tata versus Cyrus Mistry battle, and so much so that sources are now telling CNBC-TV18 that this has landed at the doorsteps of the government. Now, what is the bone of contention here? The bone of contention is that the power struggle over the leadership within the Tata Trusts. Noel Tata is currently the chairman of the Tata Trusts after Ratan Tata's passing, and he's also opposed to Melly Mistri's attempts to get a board position. Now, he's also opposed to him getting a leadership role at the Tata Trust. Now, who is Melly Mistry? He is a director of the Mayor Polonji Group. He's a strong supporter of the late Ratan Tata and an estranged first cousin of the late Cyrus Mistry as well. Now, during that hugely public spat between the two, Melly Mistry was in favor of Ratan Tata during that period. Now, what are some of the recent developments that have happened at Tata Sons? As a result of this public spat, there was an amendment made to the Articles of Association during the 2022 AGM, which prevents the same person from chairing Tata Trusts and Tata Sons. And as a result of which, Noel Tata is now the chairman of the Tata Trusts, while N. Chandrasekaran is the chairman of the Tata Sons. Now, what has happened here is that the amendment was approved by shareholders, and as a result of which, the two entities were legally separated. Now, as early as last month, on the 11th of September, the 3-hour-long board meeting ended with the removal of Vijay Singh from the board of Tata Sons. Now, the trustees usually who vote in consensus with decision making, it was a 4-3 vote in favor of Singh's removal, where despite the fact that Noel Tata, Singh himself and Venu Srinivasan continued to vote in favor of Singh to continue on the board. Now, who is Vijay Singh? Now, 77-year-old former defense secretary, so a seasoned bureaucrat. He was one of the late Ratan Tata's closest confidants as well. And some of the issues raised in that meeting was the fact that he's above the cutoff age of 75, now that he's 77. And some of the issues raised by Pramit Jhaveri, one of the trustees, is the fact that the reappointment of Anita George as an independent director with consulting all trustees was not done. He also raised the fact that Article 121A, which requires all investments, acquisitions or disinvestment proposals above 100 crore to have prior approval from the trustees, and that was not being followed. So some of the issues raised here. What Noel Tata and Venu Srinivasan said during the meeting is that Singh's removal will set a very damaging precedent. And what further exaggerated matters was the fact that Darayas Khambata, one of the trustees as well, he nominated Melly Mistry to the Tata Sons board, something that Noel Tata went on to reject. Now, what are the challenges that Tata Sons is facing? Other than all of this, there's also a lot of pressure to go public from the Reserve Bank of India. There is a lot of back and forth over this. There are also questions over transparency, governance, future control as well. So, a lot brewing at Tata Sons. The sources are telling us that the meeting has now landed at the doorsteps of the government. Only time will tell where this boardroom battle is headed.
Right. Thank you, Hormaz, for that comprehensive explanation. Moving on, the initial public offering of WeWork India saw 13% subscription so far on the second day of bidding. As of 4 p.m., the portion reserved for retail investors was subscribed 35%, while the QIB portion was booked 9%. Shares of Fortis Healthcare gained over 6% in trade. This after IHH Healthcare received approval from SEBI to proceed with the open offer for Fortis Healthcare to increase their stake in the hospital chain by another 26%. This approval has come 7 years after the Malaysian-based company acquired over 31% in the hospital giant. The big national story that we are tracking: at least 14 children have died in Madhya Pradesh after consuming a contaminated cough syrup. The affected children were initially being treated for common cold, but subsequently developed acute kidney failure. In response, Madhya Pradesh police have arrested a government doctor for prescribing the cough syrup called Coldriff. A special investigation team has also been formed to probe the syrup manufacturer based in Tamil Nadu. Authorities have also exhumed the body of a 2-year-old girl for post-mortem to determine whether the cough syrup was responsible for her kidney failure. When Network 18 inquired why the post-mortems were not conducted earlier, the SDM dodged the questions. We get you this special report from Madhya Pradesh's Chhindwara.
Initial report of the post-mortem is now making it very clear that cause of death of 2-year-old girl from Parasia, she died because of kidney failure. But the most important question, what led to kidney failure, this is yet to be established, and that is possible only after final report of the postmortem and after getting the Vesra report. So we are waiting for the final report of the postmortem, which will establish what finally led to this kidney failure, whether it was cough syrup. So this is yet to be established. The total number of casualty because of this cough syrup in Chhindwara district stands at 14, and more than 6 kids are still there in different hospitals in Nagpur. इसमें जब हम प्रिस्क्रिप्शन को देखते हैं तो इसमें फिर एक सरकारी अस्पताल का प्रिस्क्रिप्शन, वही कोल्ड ड्रिफ्ट, और एक माँ के सामने अब सिर्फ एक चारा रह गया है कि वो बैठकर अपने बेटे की तस्वीर देखती रहे। किसको जिम्मेदार मानते हैं आप?
वो शायर अब कोई मानीजिए, इतना पढ़े लिखे नहीं है कि डॉक्टर बन जाते, नहीं तो पढ़े लिखे रहते तो। अब वो डॉक्टर ने जो लिखा है वही समझे उसको।
जो रिपोर्ट आई तो किडनी वाली मैडम ने से मैंने पूछा भी था, उन्होंने बताई थी कि इसकी रिपोर्ट में इंटरनल इंजरी हुई है इसकी किडनी में। तो मैंने कहा मैम ये इसको कब से प्रॉब्लम, तो उन्हें स्पष्ट बोलती थी कि इसकी जब से तबीयत खराब हुई है तब से उसको ये प्रॉब्लम हुई है।
वजह उसकी सीरप ही रही।
अब उन्हें ऐसा स्पष्ट मैडम ने ये नहीं बताई कि आपने जो दवाई पिलाए उससे हुई।
So the most important question, why this postmortem report is coming so late? In fact, our network, we have been raising this question even after 14 deaths of kids in Chhindwara district during the past 1 month. Why no postmortem has been conducted by the administration, by the district administration? सर, मैं आपसे सिर्फ ये जानना चाह रहा हूँ कि जो पोस्टमार्टम क्यों नहीं कराया गया?
क्योंकि उसमें पेरेंट की कंसेंट लगती है।
मैं पेरेंट्स से मिला हूँ, पेरेंट्स कह रहे हैं कि वो तो उनको प्रशासन ने पूछा भी नहीं। आपको जो सस्पिशन जो लगातार एक के बाद एक मौतें हो रही थी और एक जिम्मेदार एसडीएम होने के नाते आप पूरे मामले को आप देख रहे थे, तो आपके मन में आया, प्रशासन के मन में आया कि इनका पोस्टमार्टम करा लिया जाए?
पोस्टमार्टम में क्या निकल के आता है? क्योंकि पोस्टमार्टम में किडनी का आता है, जो बायोप्सी कराई थी 3 किडनी की, उसमें किडनी का डैमेज आया ही हुआ है। पोस्टमार्टम में अलग से क्या निकल के आएगा? टॉक्सिन्स के लिए अलग से सैंपल भेजे ही हुए हैं।
आप मतलब अच्छी से याद करके बताइए।
नहीं सर,
पोस्टमार्टम के लिए किसी ने पूछा ही नहीं।
नहीं,
क्योंकि अभी हमें प्रशासन के एक एसडीएम है, वो कह रहे थे कि परिवार वालों ने मना कर दिया।
नहीं सर, अपने पास कोई नहीं आया सर।
नहीं, उन लोगों ने नहीं पूछा।
Then finally one body of a girl, this girl Yogita, it was exhumed and then it was sent for the postmortem, and we have got this report of the postmortem at this point of time. Why this postmortem was important? Because there are 2 types of postmortem. If it was not a police case earlier, then okay, it cannot be done because of no medical case, legal case is there. But the administration could have conducted the postmortem on the basis of pathological report. They are getting, repeated deaths, and if it is a cause of what is the cause of these repeated deaths? So to find out the cause of these repeated deaths, suspicious deaths, the administration could have taken the call itself, and they have in fact done this postmortem earlier. Had it been done earlier, obviously the casualty could not have gone to this extent of 14 kids die after 1, 2, 3, 4 deaths. If this postmortem was done, then casualty could have been less.
Moving on, at least 7 people have died after a fire broke out in the intensive care unit, the ICU of a hospital in Jaipur. Hospital officials said 4 to 5 other patients remain in critical condition. Preliminary reports suggest a short circuit triggered a fire in the trauma ICU where 11 patients were present. The government has revised the rates for nearly 2,000 medical procedures for the first time since 2014. Analysts say rates hiked by over 25% for key medical procedures under the central government health scheme. Now, shares of private hospitals chains rallied in trade as a result. The Supreme Court has deferred the hearing of Vodafone Idea's plea seeking a waiver of interest and penalties on ADR dues to the 13th of October. This after the central government sought more time. The telecom company said that it doesn't object to Centre's request, but added that they would want to celebrate Diwali this year. The Supreme Court had deferred the hearing of this case twice last month. The stock ended 3% lower on these developments. The Supreme Court has issued notices to the central government and the Ladakh Union Territory on a plea challenging Sonam Wangchuk's detention. The top court was hearing a plea filed by his wife, which also sought his immediate release. The Supreme Court has asked the government to consider sharing the grounds of Wangchuk's preventive detention. The court will hear the matter again on the 14th of October. All right, time for a short break. Coming up next, External Affairs Minister S. Jaishankar says any trade deal between India and the US must respect New Delhi's red lines. More on that when we return. Welcome back. External Affairs Minister S. Jaishankar has said that India and the US have yet to arrive at a landing ground when it comes to the trade agreement. Speaking at Kautilya Economic Conclave, the minister added that talks have been ongoing since March to reach an understanding. He also added that the US must respect India's red lines.
Whatever happens, at the end of the day, there has got to be a trade understanding with the United States. There has to be one because it is the world's largest market, but also because it is, much of the world has reached those understandings. But it has to be an understanding where our bottom lines, our red lines are respected. In any agreement, there are things you can negotiate and there are things you can't. And I think we are pretty clear about that, and we have to find that landing ground, and that's been the conversation really which has been going on since March.
Commerce Minister Piyush Goyal is in Qatar to finalize the terms of a free trade agreement as India seeks expansion of exports. The bilateral trade between both nations was at $14 billion in FY25, with India's energy imports accounting for $12 billion. 28 people have died as heavy rains triggered floods and landslides in Darjeeling. Rescue operations are underway after nearly 100 landslides were reported. Red and yellow alerts remain in place for the hills as more heavy rains are expected. Authorities have warned that the risk of fresh landslides remains high. In international news, Israeli forces continue to bombard Palestinians in Gaza, killing 7 people, including 3 aid seekers since dawn. Delegations from Hamas and Israel have convened peace talks in Egypt. US President Donald Trump has urged mediators to move fast to end the war in the enclave. Ukraine said that 5 people were killed as Russia launched 500 drone attacks across cities overnight. Few drone strikes hit the Ukrainian city of Lviv that borders Poland, forcing Warsaw to scramble jets. The attacks hit energy infrastructure, causing power outages across Ukraine. Meanwhile, Russia said that it had downed 251 Ukrainian drones overnight. French Prime Minister Sébastien Lecornu has resigned less than a month in office. This has also come a day after he named his government. French President Macron has accepted his resignation. Lecornu's choice of ministers had been criticized across the political space, particularly his decision to bring back former Prime Minister Bruno Le Maire to serve as the Defense Ministry. He has now become the 5th French Prime Minister to step down in the past 2 years. Nearly 200 hikers are trapped on the Tibetan slopes of Mount Everest after a blizzard. Chinese authorities have said that 350 people have been guided to safety by rescuers. Hundreds of local villagers and rescue teams have been deployed to help remove snow blocking access to the area. The heavy snowfall began on Friday and intensified over the weekend. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
India is a very unique consumer market, and the insurance case makes it very, very interesting. Why? On one hand, the insurance density, penetration as well as coverage in India is considerably low. But the same leaves a great deal of interest around how insurance industry scripts the catch-up towards the goal of insurance for all by 2047. Now, to understand any market, the most crucial aspect is to understand the consumer. For insurance space, it's the policy holder. Policy Bazaar, through its second edition of the flagship survey, How India Buys Insurance, attempts to do exactly that. Now, to speak about this particular survey and break down the nuts and the bolts of it, we are joined by, first of all, Anand Roy, the MD and CEO at Star Health Insurance. After that, Venkatachalam Iyer, Managing Director and CEO at Tata AIA Life Insurance, as well as Saravir Singh, the Joint Group CEO at PB Fintech. Saravir, I want to understand something from you. According to you, even today, do you think claims, settlement or denial of claims is still the single largest factor that, prompts a policy holder to go ahead and buy an insurance policy or not? What are the findings of your survey, of your report that threw up in terms of what is the single largest factor which sort of tell a policy holder that he needs a policy and goes ahead and buys it?
Sure. So yes, we surveyed over 3,500 consumers across 30 plus cities in India, across income classification, town strata, etc. And one of the things that we have consistently found, this is the second edition, is that there is still concern or skepticism about the real moment of truth, which is a claim. So insurance is a very simple product. You pay a premium and you pay that in the hope that if there is some problem or if something happens, you will get your claim. And what we find is that now the discussion has got a bit more nuanced. It's not just about whether my claim is settled or not. It's also how my claim is settled. Was the process cashless? Was the process smooth? Did I get 100% of my claim or not? And people are also concerned about the time it takes. For instance, in health insurance, there is concern around discharge, like how long will it take to leave the hospital. Now, that is the story on the health insurance front. In term insurance, interestingly, what we find is that more people hear about successful claim stories. See, the claims are very less frequent in term insurance, as one would expect. So those stories are not that well known. But when somebody hears that somebody has actually got 1 crore rupees or 2 crore rupees from an insurance company, right, that is a very powerful motivator. So in our report, we find that last year, 15% of people bought term insurance based on having heard a claim story. This year, that number has gone up to 30%. So I think, for us in the industry, I think it's very clear. We need more claim stories. We need to convince or show customers that yes, they actually gain by buying insurance.
Okay. Venki, I want to come to you. As Saravir was also pointing out, if indeed the story around successful and transparent claims is so strong right now and it's improving every year, do you think it can actually work in the favor of insurance sales and coverage as well, where policyholders do get encouraged in the best way that they could through actually these successful claim stories?
Firstly, let me compliment Policy Bazaar on this news survey. Not just on the survey, but I think the demonstration of great purpose in bringing protection to almost every part of India today. And we've been very closely partnering with Policy Bazaar for several years now. Now, to your question, you're absolutely right. I think each time we have a story about successful claim settlement, we've seen consumers really feeling great about it. And I'm not really surprised at this 15% going to 30% plus. What we have realized is there is more. We need to really capture this a lot more. Today, there is a Policy Bazaar at the forefront. As an industry also, we should make awareness about this even more pronounced. What we have seen is the choice of an insurance company based on its efficiency in terms of claim settlement comes after the decision on buying the product. Absolutely. Okay, the choke point lies in coming to the decision of buying the product first. So, that's part of the report also as to why there is so much more to be done when it comes to creating awareness about protection and term insurance. Once that happens, You go to Policy Bazaar screen today, you have the claim settlement ratios also very clearly listed out for choice. From a claim settlement standpoint, let me also assure our listeners, our viewers today, that most insurance companies today have a claim settlement ratio north of 95-96%. So most claims are definitely settled in term insurance. These are also very clearly regulated by IRDAI in terms of turnaround times and so on. So unless there's a disclosure issue, unless there is some kind of a fraud issue, really, most claims get settled.
Having a health insurance, of course, is one thing, but the bigger thing here is to have a health insurance which is enough for you and your family. Now, I want to come to Anand for this question, and these are three questions, but all related to each other. As you come across multiple cases, Anand, of individuals, is the trend encouraging in terms of are people getting enough insurance for themselves and their family? If not, do they acknowledge the fact that there is some bit of vacuum? Do they know that there is vacuum? And is there an effort in life to sort of cover that gap that they see in terms of enough insurance and insurance?
See, first, let's understand that health insurance, speaking from the perspective of health insurance, it is absolutely a necessity. And I think it is incumbent upon all of us here to promote the cause of health insurance, because after roti, kapda and makan, I think health insurance has become something which is absolutely a necessity, and it's for all segments of the society. I think when people are trying to buy health insurance, they have to evaluate maybe three items which they should consider. Which city are they living in? And we are very happy to tell that we are seeing people now buying higher limits of health insurance itself in the bigger cities, especially where earlier 5 lakhs or 10 lakhs was a norm. We are seeing now coverages going up to 50 lakhs and 1 crore even. And, the cost of treatments in the larger cities are obviously higher. And so people are recognizing that and buying those kind of products. But most importantly, as you mentioned, the penetration of insurance in India is still very low. And people who have health insurance also need to evaluate what is their coverage. And almost all companies today offer various add-on products where they can bring their coverage up to the current market standards, whether it is in consumables or in robotic surgeries and so on and so forth. So not only while buying a new product, the consumer should evaluate which is the best of benefit for them, but also existing consumers of health insurance should continuously evaluate their coverage according to their lifestyle and their current stage in life, and move the coverage higher and higher, which insurance companies do allow as well.
Saraveer, I want to come to you, and this is on an age-old problem that we are speaking about, that is awareness. Do you think even today that remains to be a single largest deterrent which comes in the way of people taking the step towards buying a health insurance policy, towards buying a term insurance policy?
So I think, yes, there are, I would say the glass is half full, as in most things in life. So on one hand, in health insurance, we find that awareness now is quite high. So over 80% of people say that they are aware about health insurance. Now, that's the good news. The not so good news is that only 20% people actually buy. So the gap between awareness and action is still very, very high in the case of health insurance. In the case of term insurance, unfortunately, even the awareness is very low. Less than half the people actually understand what term insurance means. And then of those 45-50% people who are aware, only 10% people are buying. So I think in term insurance, our job is very well cut out, that we need to promote awareness also about the product, about the fact that you can pay X and you can get up to 500 times the premium that you are paying. I think the one thing that the industry needs to move, see, we focus a lot on products. We talk a lot about features, this thing, that thing. But consumers don't think like that. Consumers, as a consumer, I like to think in terms of stories. If you explain to me what happens, who has benefited from this thing versus, someone who has not benefited, those are the stories that I think we as an industry must tell more often. That what are the benefits of having the insurance, who benefited, so that I can also identify with that person. I think the second thing, which again the industry has been on this path, but we need to do more of, is simplification. I think products should not be made more complex. I think products need to be made more simple, and they should be very straightforward, that you will pay this, these are the conditions, and you will get this. And I think the third thing which we all always have to do is to make the process of claims, etc., again simple, and in my opinion, sometimes we can make it just transparent. many times if you can explain to people what happened and why it happened, I think that helps a lot, and it just builds trust. See, insurance is a business of trust. We need to build trust in the product, in the process, and the more we can do about that through stories, I think the better off we'll be.
Anand, I want to come to you with a very interesting finding from Policy Bazaar survey also in terms of how India buys insurance 2.0. I was reading it in the report that just about 28% of the respondents ranked health insurance above equities, mutual funds and government bonds. What would you say, how dire is the situation when you read something like this? And how can it be changed in terms of awareness and people understanding what health insurance policy does and how important it can get?
Yes, I think as Sarabvir mentioned, the awareness factor has been quite high as far as health insurance is concerned, especially after COVID. People do understand the need for health insurance, and the unfortunate situation is that typical, tendency is that nothing is going to happen to me. Things may happen to my neighbor or my friend, but nothing's going to happen to me. And then the reason why you buy insurance is to save yourself from some kind of unfortunate incident in the future. And health insurance has to be purchased when people are otherwise healthy and not when an incident happens. So I think that kind of mentality does exist, but over time, and I think over communication by all insurance companies, all stakeholders, I think this is changing. And I would say that we are seeing that health insurance has already become the largest segment in the general insurance industry. It is also the fastest growing. Partners like Policy Bazaar have also contributed significantly to make this happen.
Coming to you, Venki, and a large space, term life insurance, to be honest, very, not so well understood even today by policyholders. And I think that's the reason why we still point out many problems here. What are the big problems here when it comes to term life insurance? A completely different ballgame. And how is the industry thinking about addressing those problems?
Yeah, I think the point about awareness has been very clearly put forth. One other thing on awareness I see is, in our industry, there's a large value of claim that is still unpaid. People who have policies maybe have not spoken to the nominees honestly about the policies. So these claims are also, lying without getting paid. The other thing is we all over time, during the early years of life, invest for anything that has a benefit for the person also. We think about family, legacy, etc. usually later on in life. And term life is all about leaving something for your family. I think data on health records or income documentation to make the process more seamless would be according to me some choke points. So I think we have a long way to go, and the effort is well and truly on.
Sarabvir, to end the first part of the discussion on the survey, on the report which Policy Bazaar has released, according to you, single largest problem in terms of findings of the survey that comes in the way of adoption of health insurance and life insurance. And let's end this discussion on a positive note. What is the single largest encouraging thing that the survey throws up in terms of, which gives you a lot of optimism for the next 10 years in terms of insurance in India and for the goal of insurance for all by 2047?
Yeah, so I think, Yash, the first part is that there is awareness in health insurance. We need action, right? So the awareness to action gap is high. We need to do that in health. In term insurance, we need to improve both. The single biggest reason I feel the barrier, if you think about it from the survey, is that people underestimate the cost of not having insurance. So I think that lack of awareness is the single biggest, awareness of your financial outcome is the single biggest challenge. The positive side, like you said, is the fact that people who have got claims, as those stories spread, people are able to appreciate the value of insurance. What we have seen is once you've got a claim, you really value the insurance. And I think as we go forward, that gives me a lot of hope. The industry is very focused on paying claims. And as those, people, positive examples spread through and we can tell more stories, then I think we will be in good shape.
Well, I guess that's the perfect, conclusion when it comes to the first segment of this discussion on the Policy Bazaar Insurance Show. On the other side of this very short break, we discuss something which bothered me about, what happened to a policyholder very recently I came across, and, what are the do's and don'ts in terms of ensuring that this unfortunate incident does not happen to you? We discuss all of that on the other side of this very short break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to the Policy Bazaar Insurance Show. Now, as promised in the first segment, we discuss this very unfortunate incident. Just last month, I came across an insurance accident. A 67-year-old lady was missold 61 life insurance policies. This was sold through 6 life insurance companies within a period of 5 years. Now, this had some ULIP policies, some long-term policies, all of which practically had nothing to do with what the individual required. This was all done by the lady's relationship manager, who first gained her trust, and then, despite the insured's denial to have any insurance policy with any kind of lock-in, sold her exactly that. The relationship manager went to the extent of forging signatures to sell more insurance policies, and when the cover was finally blown, she had already left her financial planning firm and fled the country. Now, fortunately, all life insurance companies, acknowledging this as a case of mis-selling, returned the premium which was paid by this individual. But there's a lot to learn and understand here for policyholders who let their financial planner take decisions for their investments. Not saying that there's anything wrong to have a financial planner through whom you plan your finances, but all I'm saying is that it is very important for you to acknowledge your role, understand what should you cross-check, what should you understand, and what should you let the financial planner decide. Venki, as I said, I mean, when you hear such stories, it does create a lot of deficit in your mind. Though here it wasn't the insurance companies, but at the end of it, a part of the ecosystem which sort of left you in distress. According to you, in a situation like this where you have a financial planner, you yourself are not being able to plan your investments, your insurance, your personal finance needs, what should an individual be careful of not taking those things lightly when somebody is taking the decision on your behalf?
Let me, yes, firstly acknowledge insurance products are slightly complex, right? And the responsibility lies with A, the insurance companies, of course, and B, the advisors as well. In some distribution, in some parts of our distribution, we are very clear to not be selling investment-linked policies to people who are age 60 years and above. And for such senior citizens, the onboarding process becomes one where on a video we have the policy features being validated, spoken about, recertified, okay, reconfirmed before being issued as a case. It's important. So, and then comes the responsibility on part of the customer as well. Now, insurance policies come with a 30-day free look period, during when the terms and conditions of the policy can be re-looked at, and then the decision can be made against continuing with the policy or not. But I think it's not, while it, like you rightly said, it's good to be trusting your financial advisors, but it's always, each time you sign a check, look at the fine print, see what the documentation is saying. On our part, I think the need to simplify all of this is definitely there. One idea that we at Tata AI are going to be doing is, like in airlines, where you have a list of items that are not supposed to be carried. We are talking about features that the policy is not going to be covering, more importantly than the long list that it covers, because people do not go through that long list.
Saravi, to you, like we say, do not share your OTP with any unknown individual, right? What is that one complete no that you should be careful of as policyholders when trusting someone with your decision to buy a policy or a financial product?
So, yes, I'll just make it 2-3 points. I think the first thing, as Venki also explained, is that whoever may be suggesting the policy to you, do your own research. It is not very hard in today's day and age. There are platforms like Policy Bazaar, there are other platforms where you can go and just research. You don't need to, buy, but you need to research. Second thing I would say is that if something is too good to be true, then it's most probably false. Third thing I would say, buy from an advisor who is licensed. There are regulated intermediaries directly from insurance companies you can buy. So, I think both you should be the advisor should be trustworthy. Then good news is that the regulator has thought a lot about customer protection. So, when you get the policy, you can check the policy. Now, there is a CIS, which is a customer information sheet, where you can see the salient features of the policy. So, you can again check against what you understood versus what is written over there. And finally, there is a free look period. The free look period has now been extended to 30 days. So, within 30 days, you can cancel the policy, no questions asked, you can get your money back. If one thing I would just advise consumers, if something is too good to be true, don't believe it. All financial products have a risk return spectrum. Long-term products will take time before they deliver returns to you. So, just be wary of that, of buying something which sounds too good.
Anand, final question to you. what are certain red flags that individual companies should place within the system when something like this is happening? How do you reach out to the individual directly and at least inform them, get a consent from them and a reconfirmation whether they are giving consent to the financial advisor to take any particular decision which is termed as a red flag for the insurer? How should that practice evolve amongst insurance companies and within insurance companies?
Yeah, absolutely, Yash. I think, mis-selling and some amount of suppression is a constant issue in this industry, and I think that has to be solved through technology. Just like when one is visiting a doctor, one intends to disclose every health parameter which one has. Similarly, when buying a health insurance plan, it would be ideal if the consumer can disclose all kind of health related issues he or she or the family members have. And do not leave it to the distributor or the advisor to fill in the proposal forms. Please do fill up the proposal forms personally and sign them yourselves. And on the policyholders' protection, the regulator has done multiple things in the last couple of years, and I think that just goes to strengthen the ecosystem, where consumers should check once they receive the policies and the customer information sheet that whether everything has been properly understood. And also, in health insurance, there is this concept of pre-existing ailments. So if the pre-existing ailments disclosed by the consumer has been captured in the policy or not, these are some of the small checks that has to be done while buying this product, so that at the time of claim there is a good experience and there is no to and fro. I think this is something which is very critical and is a very important thing for everyone to understand. Yeah.
It's been a good episode today. We've spoken about what is India thinking when it comes to insurance, in terms of buying, in terms of not buying, in terms of what should be done to get an individual to the doorstep of the insurance company and make him buy the right product. Also, we've spoken about what should you do if somebody is taking the decision on your behalf when it comes to your financial investments. What are the do's, what are the don'ts, and how to protect yourself in such situations. But with that, it's curtains down on this episode. We will return with another interesting topic, another interesting set of guests from the industry to break that down for you, our policyholders. Till then, stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Presented by Policy Bazaar.
Hello and welcome to News Center. I'm Archana Solanki. The big national headline. At least 14 children have died in Madhya Pradesh after consuming a contaminated cough syrup. The affected children were initially being treated for common cold but subsequently developed acute kidney failure. In response, Madhya Pradesh police have arrested a government doctor for prescribing the cough syrup called Cold Riff. A special investigation team has also been formed to probe the syrup manufacturer based in Tamil Nadu. Authorities have also exhumed the body of a 2-year-old girl for post-mortem examination to determine whether the cough syrup was responsible for her kidney failure. When Network 18 inquired why the postmortems were not conducted earlier, the STM dodged the questions. We get you the special report from Madhya Pradesh's Chhindwara.
Initial report of the postmortem is now making it very clear that cause of death of 2-year-old girl from Parasia, she died because of kidney failure. But the most important question, what led to kidney failure, this is yet to be established, and that is possible only after final report of the postmortem and after getting the visitor report. So we are waiting for the final report of the postmortem, which will establish what finally led to this kidney failure, whether it was cough syrup. So this is yet to be established. The total number of casualty because of this cough syrup in Chhindwara district stands at 14, and more than 6 kids are still there in different hospitals in Nagpur. इसमें जब हम प्रिस्क्रिप्शन को देखते हैं तो इसमें फिर एक सरकारी अस्पताल का प्रिस्क्रिप्शन, वही कोल्ड रिफ, और एक माँ के सामने अब सिर्फ एक चारा रह गया है कि वो बैठकर अपने बेटे की तस्वीर देखती रहे। किसको जिम्मेदार मानते हैं आप?
तो वो सायरब को ही मानीजिए। इतना पढ़े लिखे नहीं है कि डॉक्टर बन जाते, नहीं तो पढ़े लिखे रहते तो। अब वो डॉक्टर ने जो लिखा है वही समझिए उसको।
जो रिपोर्ट आई तो किडनी वाली मैडम ने से मैंने पूछा भी था, उन्होंने बताई थी कि इसकी रिपोर्ट में इंटरनल इंजरी हुई है इसकी किडनी में। तो मैंने कहा मैम ये इसको कब से प्रॉब्लम, तो उन्हें स्पष्ट बोलती थी कि इसकी जब से तबीयत खराब हुई है तब से उसको ये प्रॉब्लम हुई है।
वजह उसकी सिरप ही रही।
अब उन्हें ऐसा स्पष्ट मैडम ने ये नहीं बताई कि आपने जो दवाई पिलाए उससे हुई।
So the most important question, why this postmortem report is coming so late? In fact, our network, we have been raising this question even after 14 deaths of kids in Chhindwara district during the past 1 month. Why no postmortem has been conducted by the administration, by the district administration? कि जो postmortem क्यों नहीं कराया गया?
क्योंकि उसमें पेरेंट की कंसेंट लगती है।
मैं पेरेंट्स से मिला हूँ, पेरेंट्स कह रहे हैं कि वो उनको प्रशासन ने पूछा भी नहीं।
कहाँ पे दिखाया है?
मैं यहाँ पे नहीं, नागपुर में नहीं। मौत होने के बाद जो जिला प्रशासन है उसने पूछा भी नहीं।
मौत कहाँ पर हुई थी?
मौत नागपुर में हुई है, लेकिन आपको जो सस्पिशन जो लगातार एक के बाद एक मौतें हो रही थी और एक जिम्मेदार एसडीएम होने के नाते आप पूरे मामले को आप देख रहे थे, तो आपके मन में आया, प्रशासन के मन में आया कि इनका पोस्टमार्टम करा लिया जाए।
You are trying to put words into my mouth which I will not utter.
देखिए पहले आप कह रहे थे कि पहले आपने ये कहा कि आप इसलिए नहीं कराए क्योंकि कंसेंट नहीं मिली। जब मैंने कहा कि मैं एक ऐसा केस है हमारे पास जिसमें कंसेंट देने को वो तैयार थे, इसका क्या जवाब?
पोस्टमार्टम में क्या निकल के आता है? What is postmortem? आप बताइए ना।
आप बताइए, मैं मुझे कुछ नहीं आता, आप बताइए।
आप इस तरह से, मतलब एक तो मैं काम करने के लिए जा रहा हूँ, आप मुझे जबरदस्ती घेर रहे हैं, ये कोई तरीका होता है? आप मेरे बीच गाड़ी में खड़े हुए हैं।
नहीं, बीच गाड़ी में बिल्कुल नहीं खड़ा हूँ मैं। आपसे
क्लियर करिए, मुझे फील्ड पर जाना है, समझे?
तो बस पोस्टमार्टम के लिए हमको आपको ये बात जाननी, बस
क्या
कि पोस्टमार्टम क्यों नहीं कराया गया?
क्योंकि पोस्टमार्टम में किडनी का आता है, जो बायोप्सी कराई थी 3 किडनी की, उसमें किडनी का डैमेज आया ही हुआ है। पोस्टमार्टम में अलग से क्या निकल के आएगा? टॉक्सिन्स के लिए अलग से सैंपल भेजे ही हुए हैं।
देखिए 2 तरह के पोस्टमार्टम होते हैं।
प्लीज साइड होइए प्लीज, है ना, मुझे लेट हो रहा है।
आप मतलब अच्छी से याद करके बताइए।
नहीं सर,
पोस्टमार्टम के लिए किसी ने पूछा ही नहीं।
नहीं,
क्योंकि अभी हमें प्रशासन के एक एसडीएम है, वो कह रहे थे कि परिवार वालों ने मना कर दिया।
नहीं सर, अपने पास कोई नहीं आया सर।
नहीं, उन लोगों ने नहीं पूछा।
Then finally one body of a girl, this girl Yogita, it was exhumed and then it was sent for the postmortem, and we have got this report of the postmortem at this point of time. Why this postmortem was important? Because there are 2 types of postmortem. If it was not a police case earlier, then okay, it cannot be done because of no medical legal case is there. But the administration could have conducted the post-mortem on the basis of pathological report. They are getting, repeated deaths, and if it is a cause of what is the cause of these repeated deaths? So to find out the cause of these repeated deaths, suspicious deaths, the administration could have taken the call itself, and they have in fact done this post-mortem earlier. Had it been done earlier, obviously the casualty could not have gone to this extent of 14 kids die after 1, 2, 3, 4 deaths. If this post-mortem was done, then casualty could have been less.
Right, eye-opening report from Madhya Pradesh. Moving on, 31 out of 36 districts of Maharashtra continue to grapple with torrential rains and floods. CNBC-TV18 Santya Gora travelled to the flood-affected areas and reported on the loss of lives and livelihood. Crops over 50 lakh hectares are damaged. Crops like cotton, soyabean, oranges, pomegranate, maize, bajra, pulses and onion have been damaged. Here's a ground report.
Rajendra Akolkar of Ahilyanagar, Maharashtra owns 4 hectares of land. He sowed soyabean, bajra, pulses and onions, hoping to earn at least 2 lakh rupees from soyabean alone. But nature had different plans.
वो सब खराब हो गए उसका खेत बाजार में जाने तक 50,000 रुपए हेक्टेयर खर्च वो भी नहीं निकलने का भी आता
तो खेत साफ करना, बीज लाना, ट्रांसपोर्ट करके मंडी तक ले जाना, 1 हेक्टेयर के पीछे 50,000
खर्च आता है।
कितना पैसा बनने की उम्मीद थी?
2 लाख तक।
माने 2 लाख का तो आपका ओवरऑल नुकसान ही।
नुकसान।
अच्छा, ये 1 हेक्टेयर में आपने सोयाबीन लगाया है और कौन-कौन सी फसल आपकी खराब हुई है राजेंद्र जी?
प्याज है, तूर दाल है, बाजरा है, ये सब खराब हो गए और खेत में से पानी जा रहा है नीचे।
तो मट्टी भी निकल गई खेत की?
मट्टी भी निकल गई। खेत जो खाद डालता खाद वो सब खराब हो गए।
Soil erosion in farms, uprooted trees and damaged crops show how severely Maharashtra is impacted because of the floods. As per the state government, crops on over 50 lakh hectare across 31 districts in Maharashtra are damaged. Maharashtra government has claimed that it has already sanctioned compensation of over 2,000 crore rupees for over 31 lakh farmers. But the damage caused by these floods runs deeper than just crop damage. In many areas, the floods have washed away the fertile agriculture soil in farms, and the farms are now full of stones. Farmers of Ahilyanagar's Karanji village say it will take them 4 to 5 years to recover.
यहाँ पे 10 दिन बारिश चलने से कारण यहाँ पे खेती का बढ़िया नुकसान हुआ है। यहाँ पे मुख्य पीक है कि यहाँ पे खेती है कि संतरा, मौसम्बी, सोयाबीन, कांदा, यहाँ पे खेती का बाजरा, बहुत ही बढ़िया नुकसान यहाँ पे लगातार बारिश के कारण हो गए।
हमारा नुकसान इतना हो गया उसकी गिनती नहीं।
कुछ फिगर है आपके दिमाग में कितना?
फिगर हमको हमारी 5 साल लग गए थे डेवलप करते करते, अभी तो डेवलप करते जा रहे।
अभी जो हमारा नुकसान हुआ है, जो अभी मिट्टी लाने वाले उसका खर्चा भी नहीं निकलने वाला। सरकार जो दे रही मदद वो भी कम दे रही है। बनाने के लिए हमको कम से कम 4 या 5 साल लगेंगे।
The state government says that the situation continues to remain grim. Maharashtra government has sought centre's assistance and have asked for funds under NDRF quota. But the farming community and the opposition demands that the state government declare this a wet drought year. The state government is yet to make any announcement regarding this, but continues to assure that compensation will be disbursed at the earliest. The state government has begun surveys to assess the damage and determine compensation to be paid. But the opposition alleges the government is failing to act decisively, and the government says the opposition is using the tragedy for political gains, especially given the upcoming local body elections. While the politicians fight it out, the farmers we spoke to say the compensation may be delayed or insufficient. They say that even if they receive the compensation today, it could take them 4 to 5 years to recover. In Ahilyanagar, with camera person Swapnil Bandekar, this is Santya for CNBC TV18.
Right, it's time for a short break. Coming up, the government approves Pulses mission with 11,440 crore rupee outlay. Parikshit Luthra speaks with Devesh Chaturvedi, Agriculture Secretary, on the contours of this scheme. Stay tuned.
The Union government has launched the Atmanirbharta in Pulses mission. So what does this national mission on pulses really target? How will this help in increasing production of key pulses in the country? Joining us right now to explain this important scheme from the Union government is Mr. Devesh Chaturvedi, who is the Secretary, Agriculture and Farmers Welfare in the Government of India. Sir, thank you very much for joining us. Let me begin by asking you, how does this mission on pulses help in reducing our import dependency?
You see, pulses, India is one of the highest producer of pulses and also the highest consumer of pulses, because it is a very essential part of our diet across the country. So while we have tremendous achievement in past decade in terms of raising the pulse production from around 15-16 million tons in 14-15 to about 24-25 up to 25 million tons, but the rising income levels and the rising consumption patterns, changing consumption patterns have led to even more increase in the demand for pulses. So therefore now there is an import dependence of about 15 to 20%. And therefore, as part of the overall strategy of Atmanirbharta or self-sufficiency, we have launched this new mission, which is a renewed strategy for improving productivity, area expansion and assured income to the farmers.
Right. So do you have a target in mind as to by what extent will this bring down our dependency or imports of key pulses in the next few years?
So presently in 24-25, we were around 25.2 million tons as production, and about 6 to 7 million tons was imported. So what we plan is next 6 years we are targeting 35 million tons of production domestically, so that our import dependence comes to very minimal or zero. And for that, this about 10 million ton increase, it will be done partly by area expansion, but more significantly through productivity improvements.
Right. Now, the total outlay of this scheme is around 11,400 crores. Give us a sense of how this is going to be used in increasing the yield.
So, see, it has several components. So one of the key components is that the ICR and its chain of agriculture universities and other institutions will be doing cutting-edge research. They're already doing it, but they will be now expanded to cover hybrid seeds, cover high-yielding varieties of most of the pulses which are grown in this country, so that we achieve at least 30% improvement in productivity in next 6 years. In last decade, we achieved about 20% increase in productivity. But in next 6 years, we are planning to achieve 30% productivity. So once these seeds are the high-yielding varieties or the hybrid seeds, which are latest, which are climate resilient, which have high productivity, and also they are more resistant to pests and diseases, these seeds have to very quickly and efficiently go to the farmer's field. It is there that mission will now have the second role to play, that these breeder seeds will be converted into foundation and to certified through the state corporations and our own central seed producing agencies, so that they reach to the farmers, and we intend to cover 2 crore farmers with these high yielding varieties and improved seeds in next 6 years. And the second aspect will be that we have about 27.5 million hectares covered. This we'll be expanding to 31 million hectares through using the rice fallow land across the country, because as you know that this is pulses are the varieties which require less fertilizer, less water. So the rice fallow land can be easily utilized to convert it into, many farmers can immediately start growing pulses, and we will train them and will provide them seeds to ensure that the area expansion takes place.
Right. The government has also said that there will be 100% assured procurement of 3 key pulses: Urad, Tur and Masoor. But what is also being said that in order to make this plan effective, the government will also have to look at an import duty hike. Is that something that we can expect as a next step, sir?
You see, import duty is something which will be monitoring. And as you know that in last few months we worked with the ministries, other ministries, and had a decision of 10% import duty on chana and 10% on masoor, which helped not only keeping the market prices close to MSP, so the farmers got very good returns, but because the duty was not so high, it didn't have any impact on the inflation. So we will keep that policy overall to keep the import duty monitored. More than that, this assurance of procurement of these three important pulse varieties in which we are more import dependent is something which will ensure that the farmers are confident for next 4 to 5 years that whatever they will produce, if they want to sell it at MSP, they will be assured that all of their produce will be procured by us. And if the market is good enough, they can go to the market and sell it also.
Right. So, generally what you have done in past, like you've said, the government has hiked import duty of certain key agricultural items in the past. Would you say that something similar can be done and the government is open to that idea?
No, I won't say, we'll just say that we'll just see that whatever is coming should not harm India's farmers' interest. And to that extent, this assured procurement of these three pulses will be good enough an incentive for the farmers to keep on growing and sort of make them immune to whatever the import or export duty structures are or whatever the global prices are. So that will be a major strategy in this mission.
I would also like to ask you about increasing farm productivity. Now, this has been a major focus area from the government. Now, you've got the National Pulses mission, which has been announced on a larger scale. What is the plan that the government is working on as far as farm productivity is concerned?
As I mentioned, that farm productivity is one of the key sectors, because what we have as a strategy we are working is that we not only, because the area, you can say the net crop area is limited because of the fact that we cannot create land. Of course, we can reclaim some land which is otherwise cultivable but not under the agriculture practice. But more and more we are going for increasing the cropping intensity. So we can have more than one crop in a particular area. So cropping intensity has increased over the past many years, and that will be the strategy in future. And the whole idea of rice fallow land being converted into pulses area is to increase cropping intensity. And second aspect is to improve productivity to the levels where there is always a potential productivity of each variety which comes out, and the gap has to be reduced by better practices and by taking that seed directly to the farmers.
Right. I'd just like to ask you about the recent flood. There have been reports of heavy crop damage across the country. Could you give us an assessment of what's been the impact and how this is going to impact the total crop production in FY26?
So, of course, we had a very good monsoon across the country. There were very negligible districts where the monsoon was largely substantially below normal. But unfortunately, in some places there was excessive rainfall, especially in places like Maharashtra of late, and then Punjab. There was a huge loss, some areas in Jammu and Kashmir, Himachal, and other states also. But by and large, what we have seen, that losses, of course, that losses are being compensated through different ways. But overall, the productivity and production of food grains will not see any major dip as compared to last year. It will remain on the same level overall. There could be localized losses which have to be compensated, which are being compensated through the disaster relief operations and also through our crop insurance scheme where the states have adopted them.
Right. So the crop production will be in line with FY25
crop production,
numbers.
the general condition of Kharif crop is okay. And the Rabi prospects look very, very promising because of these rains and the reservoirs being filled up. The possibility of a bumper Rabi crop looks quite possible, and that will also offset any little bit of harm which happened in the Kharif due to these floods or some extreme weathers.
The government has also hiked the prices of the MSP for Rabi. How do you think this is going to help the farmers?
So Rabi MSP has been hiked before the start of the season. Technically the season starts on 1st of October, and the Union Cabinet announced the Rabi MSP on 1st of October. So that we have, if you see, there are 6 Rabi crops which are covered. So we have the pulses, we have the mustard, and we have the wheat. And we presume that all these crops will have major area expansion because the prices in the market has been very good for mustard, for masoor, for chana. And also for the wheat also, the prices are very close to the market rate, and we will be able to ensure that whatever is the demand for the country, if enough will be, wheat will be produced by our farmers.
Finally, inflation currently is at comfortable levels. What's your outlook on food prices going ahead?
So as mentioned, that the inflation, because of good production in last year 24-25, both in agriculture cropping sector as well as in the horticulture sector, especially the tomato, onion, potato, inflation has been quite reasonable low. Food inflation has been quite low. In fact, at times it has become negative for some crops. So that trend will generally continue for the next Rabi also. And there will be small minor changes because of festival season and other thing, but that will be much less as compared to what had happened in last year. So it will be a very low inflation scenario for next 6 to 8 months at least.
Welcome to Indianomics. The one sector that rallied last week in an otherwise ranged market were the banking stocks, after the Reserve Bank removed or proposed to remove a bunch of constraints and brought in more pro-market steps. The most important, according to me, banks can now fund corporates to do acquisitions. Second, the limit of 10,000 crore on total banking exposure to one group goes, that cap goes. Banks and their group companies can do overlapping businesses, which of course benefits a lot of people like HDB and, Canada Housing Finance. Risk weights, or the amount of capital that banks have to set aside for home loans and MSME loans, are likely to come down with the Basel III norms. And finally, very important, on the deposit side, premium to insured deposits won't be a flat rate. It will depend on how less or more risky a bank is perceived to be by investors. Now, to discuss how much banks and the economy will benefit, and also if the RBI has been too bold in removing some of the guardrails, I have with me two former RBI Deputy Governors, Mr. H.R. Khan and Mr. S.S. Mundra. And in a bit, we will be joined by Suresh. Okay, Suresh Ganapathy is there with us, the Managing Director and Head of Financial Services Research at Macquarie Capital. Gentlemen, good morning and thank you very much indeed for your time. Mr. Mundra, this deposit insurance marketization has not been discussed enough. Last week, we all went to town with this acquisition financing and this 10,000 crore cap. But the SBI chairman, when he spoke to us, said he spent 5,400 crore rupees in FY25 on deposit insurance and he expects it to come down. You think this is going to be a very big benefit for, SBI, BOB, HDFC, ICICI types?
Thank you, Lata. But I think, of course, this is a no-brainer. It's going to be an advantage. Those who are running their shop well, and when you do the risk assessment and risk level is found to be low, obviously, as it is proposed, the rate of premium would be low. So, it's going to be only one way only, that whosoever is working well is going to be beneficial.
But how much, sir? How much can it benefit? Any ideas?
Pardon?
How much can the benefit be in terms of lower costs?
So it depends on ultimately what kind of slabs RBI proposed to say come out with. But it could be even, I would say to begin with, it could be even 1/4 of what you are paying today.
Oh my God. Okay.
Quite substantially. Yeah, this is how it should be. Otherwise, it has no meaning.
No,
Having said that, Lata, let me quickly, I mean to say, is a great package. There are long outstanding demands and long overdue rationalization which has happened in this. Only there are a couple of areas where I feel probably is a kind of leap of faith by RBI.
Mr. Mundra, I'll come to that in 1 minute. Let me just finish this deposit thing because it is under discussed. And I will come to where you see the leap of faith, which is a little scary. Mr. Khan, do you think the Reserve Bank has put this leap of faith even on deposits? I mean, are we not, for instance, the trouble that RBL went when Vishwa Rahuja left, or Yes Bank, or even more recently, IndusInd? Already these banks, private sector banks, they don't have the, the sovereign guarantee which public sector banks are perceived to have. And over and above that, there have been one case or the other. Do you think the RBI is being too bold with respect to small private sector banks on this deposit issue?
No, just before I talk about deposit issue, let me just quickly add one introductory sentence to what you say, slew of measures taken by RBI for the banking sector, and you said about banking sector rally. I think if you see the last few months, it has been a phase of simplification, liberalization and rationalization. Yes. And the whole concept is what is being called as optimum regulation. Yeah. With bias for liberalization for the banks and ease of doing business. So this is in line with all those overarching principles. Coming to deposit insurance, I fully endorse my former colleague and friend Mundraji about this is a long-standing thing. It has happened. It's a good thing. But knowing the maturity of Indian market, one has to be a little careful about how it is communicated. If it is not communicated properly, there is a risk of run on some of the banks. So we have to properly communicate that and do a bit of customer education about it. Yeah. Otherwise, but there could be some problem down the line.
It's just about 3-4 years ago because of LVB, because of Yes, because of RBL. Even unrelated banks like IndusInd suffered because people were just moving out deposits. So I'm a little worried that this flat one has gone away. Suresh, your thoughts on whether you will up the ante in terms of margins and lower operating costs for banks because of the deposit insurance. As Mr. Mundra says, it can be 1/4 of 5,400 crore for RBI, for SBI. That's a big deal. I didn't expect it to be so much. And plus, are there more credit opportunities because of, acquisition finance?
Look, I mean, this is, if I were to really look where my analysts at and look at the overall numbers, at an overall operating expense level as well as at the overall PAT level, I mean, even if it is a number as large as 1/4, which I doubt, but could be the case in certain entities, it doesn't move the profit parameters in a big way, Lata. I mean, right? So it is not that my earnings have to be changed about 10-15% on the back of this particular issue. There would be some 2-3% impact on earnings coming from a lower deposit cost. Just one point here that I would like to mention for the benefit of audience here is that the way the scheduled commercial banks in India have operated, never in the history, at least the time that I have tracked, a single depositor has lost money when it comes to scheduled commercial banks failing. Because at the end of the day, the RBI steps in, a forced merger takes place, and eventually the depositor gets back the entire money, right? So there is never a single rupee of deposit that is lost. It happens in cooperative banks, not in scheduled commercial banks.
Okay.
The premium pricing has to take that factor into account because depositors have never ever lost money in case of scheduled commercial banks.
Okay. No, my only fear is that the Reserve Bank has made life difficult for itself. We know that in Yes Bank's case, in several other LVB case, they went and looked for the buyer. They made life more difficult for themselves, is what I thought, especially for small private sector banks. Mr. Mundra, your leap of faith, I want to come to that sentence. Where are you uncomfortable with the removal of constraints?
Yes, Lata. I was telling, of course, I said great package, over 22 measures, and some of them were really long overdue. Some of them really had become outdated. But there are a couple of areas where I feel it more like a leap of faith. Of course, RBI, I'm sure RBI must have done its best. But having said that, it seems from the total package that a lot of faith, a lot of belief has been put into the market economic mechanism and the board oversight. Now, as we all know, there is a sizable section of industry whereby not by any motive, but by their whole construct, by their design, and also the tenure of leadership. Both the things, board oversight as well as market discipline, may not be equally effective on them or equally applicable to them as it is on the other section of the society.
Okay.
In that situation, how much could be expected from this discipline, self-discipline to come is something I think maybe RBI will have to keep supervisory antenna very, very sharp.
Which specific rule? Which specific rule are you referring to?
Specific rule would be difficult because how do you distinguish within an industry? But probably the level of supervision, constant supervision, those are the kind of things. At least in initial years, it has to come into play. That is one area. And second area, when it comes to M&A financing, again, it was a long outstanding demand. Nothing wrong in that. It opens an avenue for the banks. I am little more worried about the aftermath of such financing. Because if I go back to my experience with infra financing, what typically happens, let me tell you, that generally these are some of the large players who would be playing a major role in assessment and deciding the finance which is to be done. Then it gets distributed among the smaller players also.
That's right.
Who normally follow the assessment done by the
large bank.
Fine up to that point also. The point comes later on because these large players, they have two things. They have a better capability to absorb the losses if they come out of this kind of financing. Or second, which I have seen in most of the cases, I think they have seen the early signs and they have been able to exit from the exposure.
Yeah, that's
they have distribution and all that.
Yeah.
While the smaller players, they continue to hold it. And is a temptation because if you can't go and do a large scale lending and all that, and if you have liquidity and you have to beef up the balance sheet, it looks like a very, very convenient avenue.
No, that's
so great level of underwriting, but I think if it is not sharp enough, then it was an experience. We have seen it. It's not a.
I agree.
I'm little worried about it.
I agree, sir. And that's my question to Mr. Khan as well. Are we sowing the seeds for the next AQR, sir? I mean, now things are brilliant. You know, low leverage, banks, very low credit cost, ultra low. We haven't seen those numbers in our lifetime. I'm sure you will know, your memories stretch back. But, you know, if you get into, at this point, over 10,000, okay, that 10,000 crore I thought could have become 20,000 crore or 25,000 crore. Do you want to remove the cap altogether? Are we inviting trouble? And also, that little bit of a leg up we thought bond markets are getting, that also goes. So are you happy with this 10,000 crore cap going?
Oh, well, Lata, I have a vested interest here. I was part of the committee which had recommended that part of the borrowings by the large corporates, they have to move to corporate debt market, because the whole idea is that the banks are getting overexposed and they are not really, they will have asset liability mismatch, they will have a skill gap. So let it be market mechanism to a certain point. That was the whole idea. And it has run for a while, but there has not been really any assessment. Actually, it was brought down from 25,000 to 15,000 and 10,000. As you said, possibly we could have increased the threshold and seen how it is working. So that is one area one was to look at, because the rationale given is that individual bank level, there is a group exposure limit. So we need not so much worried about the system level exposure. But there could be some risk lying there. So one has to be very, very watchful. On the merger and acquisition finance, I think this is their demand for a quite long time. In fact, you should know that it is not totally no. In fact, there is some element of merger and acquisition finance exists now. For example, if you want to invest overseas, buy a company overseas, there is a finance available from the bank. And if there is a joint venture partner in infra project to buy out his share also, acquisition finance is available. But what is being done is a broad sweep. But let us wait for the draft guidelines. I hope they will maintain certain minimum level of equity from the promoter, because let there be no gold plating happening. But on the point of, just quickly on the point of what my friend Mr. Mundra said on board oversight and supervisory intent, I think they are very, very important points. And if you are giving so much of relaxations in the board and corporate governance standards.
Mr. Khan, I'll come back with those details. We have to run into a commercial break. One word from you, Suresh Ganapathy. Do you think credit growth is going to sizably improve because acquisition finance has come in? I mean, banks don't know whom to lend to. There aren't even any takers. Will this open an avenue sooner rather than later?
Look, these things are good supply side reforms in the longer run. In the near term, there is a significant demand issue, right? For example, a lot of these acquisition financing, Lata, in the private credit markets, if you look at it, happens at an IRR of 15, 16, 17%. Now, that's a portfolio that banks won't take necessarily, right? So you are looking at a reasonable chunk of acquisition credit which banks won't finance because it will not fit their risk appetite. So you have to look in that context. So while I'm not specifically put a particular number to this particular M&A related thing, but maybe perhaps a percentage point here or there could be an improvement in credit growth, but not more than that. Longer term, obviously, corporates are flush with liquidity, there is excess equity, capital markets are buoyant. So, and even ECB rules, for all that ECB rules have been relaxed. So why not? Corporates can move towards ECBs rather than relying on some of these markets too.
Okay, got it, Suresh. I have more questions on all the capital market limits that are being raised and other issues by the banking reforms. We are back in a minute after break. Welcome back to Indianomics. We're discussing the bunch of banking reforms announced by the Reserve Bank on October 1st, along with the monetary policy. I've been speaking with former RBI Deputy Governors Mr. S.S. Mundra and H.R. Khan, and with Suresh Gadapati, the Managing Director and Head of Financial Services Research at Macquarie. Gentlemen, thank you very much for your patience. Mr. Khan, what was the original reason why acquisition finance was not permitted? Was it because, if I remember right, Y.V. Reddy once said that you want banks to lend and grow the pie rather than helping corporates take over one another's. This was 2004, I think, when he said. Was that the only reason? And therefore, now it goes because capital market is anyway giving growth capital.
No, the whole idea is that you should be financing not the same asset again and again. You should be financing further. That was the whole reason. And the whole idea was, as I mentioned, in Indian system, in many cases, we have seen how the corporates and promoters have done huge gold plating. And you have to be extra careful and see that their stake is there in that. Otherwise, they go into many companies with very shallow stakeholding. And when there is a difficulty, you throw the baby with the bathwater. So that was the whole idea. But globally, this merger and acquisition finance has been there, and banks develop expertise in this area. But otherwise, what happens, the corporates have to take very high cost money from NBFC or alternative investment funds.
That's right.
And so to that extent, if it is done carefully, it is done properly, I think this is a good source of revenue. But as I told you, you have to look for the
finer rules. Yeah,
but because there has to be some minimum stake has to be ensured.
Come from the corporate. Yeah, absolutely, sir. Absolutely. Now the overlapping, the restriction that banks and their associate companies should not do overlapping business. Suresh, clear winners here, because this is a pain, for HDB and Canada and stuff like that.
Now, look, here is where I at times disagree with the Reserve Bank of India, in the sense that, first of all, this rule should have not been in place. You give the license to operate as an NBFC and do overlapping business, and you do that for 20 years, and then suddenly you wake up on the 21st year and say, now you cannot do it, and now you please restructure. That's completely bad regulation, right? Then you are trying to change the law of the land at your whims and fancies, which should not be the right way to go about it. So I think this is a very practical and a pragmatic move done by the Reserve Bank of India, and I would appreciate RBI to get rid of this particular rule. It's because a lot of these guys are already doing businesses, and in many cases, a lot of the businesses which are not being done in the bank is being done through NBFC, right? So to that extent, getting rid of this rule is the right and the pragmatic approach. Otherwise, it would have created a chaos, again, merging, letting go of businesses. It's going to be quite a messy affair.
Yeah, this was cleaning up of a rule which was neither here nor there. And I don't know how RBI slipped into it as well. It's almost by mistake that it has happened. Mr. Mundra, there are a lot of pro-capital market steps. It seems to be only bringing the limits in line with inflation. For instance, funding IPOs, 10 lakh has become 25 lakh. Loans against shares, 20 lakh has become 1 crore. Okay, 5x. But still, the point is 1 crore itself is not a great deal of money. You think these are par for the course, or do you think you are doing the wrong thing at the wrong time? Because there is a lot of froth in terms of people borrowing for F&O, etc.
No, Lata, I think I look at it in a different way. Number one, as you rightly said, part of it is inflation adjusting.
Yeah.
But you see, these ceilings are only applicable for the banks. These ceilings were not applicable to the NBFCs. They were already doing the large ticket financing in this area, even much more than what is being permitted to banks now. So to my mind, is not going to, in overall kitty is not going to change anything substantially. Maybe a part of business which was happening at NBFC may move to banks and can add to their profitability to some extent. But I don't see it as something which is going to bring any seminal change. It's all already there.
Yeah, fair enough. I thought so too. But the market was obviously excited about it. Suresh, what is your sense about this Basel III norms being changed? You're going to get probably to keep lesser capital for MSME and housing finance loans. Does this create a virtuous cycle? It's only 27. We have some time. But a good one, you think?
Yeah. Look, I think our risk weights have always been higher than internationally recommended Basel III standards. So in that sense, in certain segments like mortgages, specifically, Lata, to argue, banks have had historically very low loss rates. Okay, and the way the Indian market perceives mortgages is completely different from where some of the other markets are. And we really don't have a large securitized pool, home equity markets and stuff, right? So to that extent, it is a natural course of action to bring down the risk weights on mortgages because empirically there is evidence to prove that the loss rates are also low. The only thing is from a benefit standpoint, look, currently the system in a way is demand constrained and there is a lot of capital, right? Banks today, if I'm not wrong, are sitting at the highest levels of capital that at least I have seen in my last 20 years of career. The common equity tier 1 at an aggregate level for system is 12 to 13%.
Yeah.
We didn't even have a common equity measurement 10 years ago, right? So there is plenty of capital. So further relaxing is not going to move the needle in a big way because banks anyways didn't have a capital as a constraint. But longer term, okay, positive.
Okay. One word, Suresh, from you. Is there a seminal change? Are investors looking at RBI making banks more business-like?
Yeah, I mean, people do appreciate the progressive approach of the RBI. My simple point is it's a very pragmatic way of looking at it, right? So on one hand, you may be doing an M&A financing. At the second hand, on the other hand, you're also doing an ECL provisioning, which is making the bank's balance sheets more robust, right? Compared to a very rule-based, formula-based approach. So you are following a very pragmatic and a practical approach towards governing the entire system.
Okay. I guess that's why banks are getting a look in now. Mr. Mundra, last word. We only have a few
and I'll
seconds.
keep it very, very simple. Number one, I would say the sense I get that RBI is not now only going through the motion of listening to the stakeholders, but really listening to them and picking up some of the right point. And the second one, obviously, I think RBI has a greater comfort now around the dynamics of the market as well as the flow of information which is available. So which can, keep them enabled to keep a real live watch on the development.
Yeah, I mean, RegTech and SupTech have both improved a lot, I would assume. Therefore, that's why they can take care of supervision better. I still worry that, if we have given too much of what you call in Hindi, deal for the kite, and whether a time may come when, the very clean balance sheets may be upset. It just worries me because we have seen through 2 cycles of bad loans. I was a reporter even in 2004 when we had all those steel NPAs. And then the second cycle when there were infra NPAs. So I worry if we should, if we have given away too much. But as you say, maybe supervision and board supervision, RBI supervision, board supervision will come up to speed. Thank you very much, Suresh, Mr. Mundra and Mr. Khan.
Thank you. Thank you very much.
Well, this Diwali, when you're looking to buy home appliances, electronics for your houses, from an investor standpoint, there will also be the option to invest perhaps in an electronics company. Yes, LG's much awaited IPO is hitting the bourses on October 6th and between October 8th. It's an 11,600 crore rupee offer for sale from the parent, and the implied market cap at the higher end of the band is closer to $8.7 billion or roughly 77,000 crore rupees. I'm Mangalam Malu, with me Shilpa Ranipeta, and we're in conversation with Mr. Sanjay Chitkara, who is the Chief Sales Officer, and Mr. Atul Khanna, who's the Chief Accounting Officer of LG Electronics. Thanks a lot, gentlemen, for joining in, and festive season greetings to you guys. What's interesting is similar time last year, we had another Korean company make an offer for sale. That was that of Hyundai Motors. What is it with Korean companies wanting to cash out of, their positions in India? Because the obvious question is, what is the rationale? You're at the higher end of the issue price. Your business is valued at 35 times. The parent company is trading at around 16 times. So apart from value unlocking, what is the rationale?
See, we filed our DRHP sometime in the month of December.
Yes.
And as per SEBI guideline, we were given 1 year time for listing ourselves, and we started our roadshow sometime in the month of March. So as per our BRLM guidelines, they advised us to list ourselves just before Diwali. See, Diwali is a very important and it's a big season for our industry, and where consumer sentiments are high and our sellouts are very good. So I think that's a right time for this IPO. And talking about our parents, I think it hardly matters where the parents are. Today our focus should be how the Indian subsidiary is doing their business and how they are growing and reinvesting in the market. I think the focus should be on that. And in that sense, LG is creating a benchmark. See, we came in India 28 years ago. And at that time, very few global players could be able to recognize the long-term growth potential of India when we started our business. And from last 28 years, we have been working very hard to make consumers' lives good. And I think this IPO is a new future journey for us.
That's showing in your numbers. You're a market leader across a lot of the segments that you operate in, market makers in a lot of segments as well. Some of your metrics are leading the industry by a factor of over 2, and all those are very well considered. What we're very curious about, again, is that, what does the parent do with the money that they get? They'll be getting around 11,600 crore rupees, right? So we've had a lot of MNCs on record say that they're looking to cash out on their India chips to be able to reinvest in their own business back home. I just wanted to understand how that money will be utilized by them, because no money is coming into the company. It's an OFS.
So you rightly mentioned, it's a OFS where 15% equity parents are liquidating. And as I mentioned, LG, we are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh, where our $600 million US dollar investment we are doing. And this is not only a conceptual stage. We have already done the groundbreaking ceremony in the month of May. The construction has started, and our plan is that by end of next year, sometime just near to Diwali, we start production there in our first line. And there will be a phase-wise investment. And by 2029, we'll finish this project. Notably, this plant is much bigger than our existing 2 plants. In size-wise, it would be roughly 3 times bigger, and we are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in Tier 2, Tier 3 town. Introduction of many new products. We are also scaling up our B2B business. That's our focus area. That is the HVAC, information display panels, e-blackboards. So a lot of exciting things are going on in LG these days.
So we'll come back to each of these things a little more in detail, but if we're still to talk about the IPO, right? If we look at the pricing also, you are priced at about 33, 35 times your FY25 earnings, which is still lower than some of your listed peers, but your numbers, or whether, like he's mentioned earlier, right, your financials are much ahead of your listed peers, whether it's even your return on net worth, even your PAT margin is much better than the industry. So on the face of it, it does look like the IPO is very conservatively priced. What's, what is the sort of rationale behind this, conservative valuation that you're looking at? Is it that you're looking at leaving more value on the table for investors?
So you are very much right that any IPO of any company would depend on market sentiments as well as the strong fundamentals. Yeah. Our fundamentals are very strong, and it has the IPO price band has been consistently directed and guided by our BRLMs, banking partners, and we are following their guidance and making it a room for our investors also to take some portion of that money into their own hands. Right. So that is a very positive move, and we cannot call it as exactly the very lower times in terms of conservative. But yes, it is, I will say, optimally priced in terms of market sentiments as well as our banker guidance.
All right. So optimally priced, leaving value on the table. The question is what happens later, because the current price is nothing but the present value of future cash flows discounted to time zero. Let's talk about your numbers. Sales over the last 3 years have compounded at around 11%. Your margins have seen an improvement. So EBITDA has compounded at over 25 to 28%. Do you believe that these are numbers that can sustain going forward, or will you accelerate the pace of growth?
Let's not forget that we are serving to a structurally massive growing economy.
Right.
It's a 41 billion TAM for our products. If I leave aside the mobile phone business, and it's going with a 14% CAGR growth as per that share report, and it will become 73 billion US dollar market for us. And premiumization is happening. Currently, the India is sitting at a level of, say, around 17% as per that share report, and it will grow up to 25-27%. And LG has very strongly positioned itself as a very premium brand in India. So we believe that we will be the biggest beneficiary of this premium drive. And let's not forget that the penetration rate of our products in India is very low. A product like microwave, just 4% of household have, and air conditioner just 11%, a washing machine 21%. If we compare the other major economies like China or USA, they are sitting at 80-90% level.
So will you grow faster than the projected market growth?
Definitely. Being a sales leader, my intention is to...
That's your intention. Next to you is the accounts leader.
Our endeavor is always to expand our margins, and there are some reasons behind that we are expanding. We are doing a lot of investments into structuring our Indian, I would say, local insights as well as local sourcing, reducing the dependency on overseas buying. We are procuring almost 54% of the components and sub-assemblies in-house, as well as our key endeavor is to all produce key components, heart of the product in our in-house factories.
So how much margin headroom do you have out here? You said that you will obviously grow faster than the 14% projected by Redseer. Margins may 100 basis points, 200 basis points?
See, we cannot call it exact a number.
No, just a range.
But yes, we have to surpass our past performance in terms of margins as well.
Right. You spoke about localization and and you're looking at producing more components locally. Roughly 54% is what you said. Right. In terms of components also, and usually that's been one pain point for many consumer durable companies, especially when we see inflation and raw material prices going up and down. So how much do you produce right now within India, and how much are you looking at increasing that number to? And specifically, I'm talking about components.
So currently, so we are fully aligned with Make in India drive.
Yes.
And 95% of our products, the finished goods, we are producing in India. Just 5% some premium products we are importing. 54%, as Atulji has mentioned, our localization is currently. And our endeavor is every year 2 to 3% we keep on improving it so that it reduces the frequency, the currency change fluctuation and other forex pressure. Our biggest strength is our in-house production of our compressors. See, that's the heart of refrigerator and ACs. And very few manufacturers, the brands who are manufacturing compressors also in-house facilities. So we have that facilities. Apart from that, many other key assemblies like heat exchangers, PCBs, and some other important assemblies we are doing in-house. And a lot of drives and projects are going on to improve localization. Roughly 283 vendors we have developed over the year. And they are associated with us more than 13 years. And 65% of our raw material we procure from them.
Okay. What about LCD panels? Is that something that is still imported for televisions, and what's the plan there?
In panels, module panel, right, we are started procuring from one of the local supplier, right, even up to the size of 55-inch, full HD and ultra HD TVs. Though for premium most products like OLED and QNED, still there is a room to particularly procure locally, but they have to pass on our quality standards.
Since you're increasing your procurement from local sources and obviously dependence on overseas sources, etc., are reducing, I'm just reading some of the numbers. You know, the royalty that you've paid to the parent in the first quarter was 117 crores, 455 crores in the previous year. The year prior to that was close to around 400 crores as well. In FY25 and rather FY24 and FY23, you've paid out about 4,500 crores in dividends, cumulative dividends to the parents as well. With increased focus on localization, do you think there is the royalty which remains capped at 2.3, 2.4%, or is it a chance that they will probably increase it from here on as well?
So royalty, particularly the royalty expense, is coming to the tune of 1.8 to 1.9% of your total revenue.
Yes. Correct.
We are paying royalty on domestically produced products, right? And we are not for, we have our royalty rate, you are rightly said, it is 2.3% from home appliances and aircon products category and 2.4% for television segment, home entertainment segment, where we are not forcing any such change in couple of years, and we are following all SEBI guidelines, and our board will take approval along with the minority shareholders if we want to do so in coming future. But we are not forcing.
There is no plan to increase it.
No plan to increase it.
And changing the royalty rate is not only going with the SEBI guidelines only and board approval, minority shareholders approval, but there is a other stringent norm of transfer pricing adjustments and tax regulations. That also comes into the picture. And we have settled down those 2 years back, effective 2023 beginning. We have increased the royalty rate with a delta of 0.4%.
Got it.
And that too was only because of transfer pricing adjustments impact only.
All right.
There was no intent, and we are not forcing any such change going forward period in a couple of years.
And what about the dividend payout? Because obviously 85% owned by the promoter, while minority shareholders and those who apply in the IPO will be beneficiaries of an increased dividend payout. The biggest beneficiary will be the parent. So what kind of dividend payout plan do you have?
So we have a dividend policy, set dividend policy. Though in dividend policy we cannot cover any dividend rate, because the dividend rate decision would be taken by the board along with our factors considering the operative cash flows, earnings, the near-term capex outlook, all those factors. Board will take a call on that. Our endeavor is to pass on the dividend, as we are getting a news that our industry peers are also passing dividend, because it is a reward for the shareholders basis their investment.
Got that. And what about market share? Got to ask you that, because you're a market leader in a lot of the categories that you operate in. You only have to lose market share, because once you're the leader, any new competitor comes in, and we've seen a lot of activity take place in all the segments that you operate in, be it air conditioners, be it TVs, be it even something as simple as home appliances, where services company, urban company, they are also getting into looking to get into air conditioners and all of that and stuff. So how do you maintain your market leadership, grow faster than the industry, as Mr. Chitara has been promising, and yet open your margins up for expansion from here on? It's a tough equation, right?
Yeah. So see, in a short term, of course, the growth and market shares are important, but without profits, even growth is not sustainable. Let me tell you, we are 28 years old brand. Currently, if I talk about our market share, for washing machine, we hold 33.5% market share. Our TV shares are 27.5. Refrigerator is also 29 plus market share. And this year also, if I talk about current year, from Jan to July basis, we further improved our market share. In refrigerator, we improved by around 1.6, in TV 1.7%. Air conditioners, despite of there is a very intense competition in the AC market, but we improved our AC shares also by 1% this year. It shows that our leadership and our market share are not built on a short-term disruption in the market. There is a long-term strategy behind it.
I'm sorry to interrupt you here, because you said your washing machine market share is 33.5%. It was 35.8% 2 years ago.
I think all of them have been a slight decline.
A slight decline across the board.
In the first year, it's improved a little bit, but if you look at it consistently since 2022 to now, there has been a 2 to 3% decrease in the market share overall.
Least 2 to 3%.
And you've called that out in the DRHP also, where you've spoken about intense competition, especially in the inverter air conditioner, and you called out, even in the room air conditioners, because of your not being present in 1 or 2 segments, also there has been some impact. So if you look at it from a yearly trend, it is actually decreasing. So how do you then maintain the share?
See, and I appreciate why you mentioned this, but there is another flip side of the side advantage point is, if you see our premium product shares, like OLED TV, this year we improved our OLED shares by 4%.
Got it.
And it is now touching 62.3%. And side-by-side refrigerator, it's touching 44%. And that also we improved. So our focus is more expanding the premium product coverage.
What proportion of your revenue is from premium products across all categories, and what's your target here?
So, as I mentioned, the premium portion for industry is between 15 to 17%, but we are outperforming. It's nearly ranging 25 plus.
And you expect that to go to closer to 40 in the next 3-4 years? Is that possible?
So what so our future plans are, or what we are driving these days, we want to increase the accessibility of premium products to the larger audience.
Okay.
Where we want to take these premium products to the masses. And that will be done by improving the affordability of premium products.
Okay.
So we are doing a lot of value engineering to improve the affordability of premium products. And that is one of our growth strategies.
And your 35,600 sort of touch points that you have, consumer touch points, how do you plan to increase that? What's your supply chain in terms of the front-end supply policy here?
So you rightly mentioned 35,000 is our touch point, and we are present at all formats of the business. We are also available on e-com on 2 players. But our biggest strength is our own exclusive brand stores. We have 777 exclusive brand stores in India. And it's, I feel a lot of pride of telling that it's 1.4 times of second largest peer in terms of, and these brand store shows your real brand strength, because the partners get so much confidence that on a single brand alone they can sustain their profitability. Our idea is to expand our business to tier 2, tier 3 town.
Correct.
And in time to come, we will open new brand stores in smaller cities because our consumers are very aspirational. They want to try premium products, and we want to take these premium products to smaller towns and expand our coverage for premium products.
But, you are largely an offline player now. Can you help me understand what your online-offline mix is? And online, I think you're present only on 2 e-commerce marketplaces, right? But online as a segment is really growing, and every sales online festive, you see, it's home appliances, consumer durables that really sort of lead the way, right? So how are you planning to increase your presence in the online space, and how do you see the mix also going forward?
So we are all available on all formats of business, and we never aggressively push our products to any specific channel.
Got it.
We want that our consumer buy our products wherever they are comfortable, and we are the leader in all the formats of business. We have our own e-commerce website also where our products are available, and online is a modern channel, and it's a faster way to reach to our customers. And we are focusing all the channels, and our strategy is that all channels should coexist.
Perfect. So we have just a minute to wrap this. So we'll just do a quick fire here. You have to answer in as little words and as quickly as possible, right? Which one do you believe will be the category that will grow the fastest in your overall portfolio?
Air conditioners.
Air conditioners. Which will be the margin driver for the business in the next 3 years?
Or B2B businesses.
How much will that account for in your overall sales?
Currently it is around 8%, but it will definitely, the contribution will go up.
And services as a proportion of your sales are
2%.
how much? How much will that grow to?
It is definitely 70-80% it will grow.
One new category that you probably are looking to enter that you're not already present in?
See, it's a competition-sensitive information. I cannot disclose right now, but there are plans are going on.
One category which you don't believe is ripe for you to enter?
I don't think so, any category.
You shut your mobiles business, so one thought that,
See, that was not a local decision. We did this in year 2021. And because we wanted to focus on where our strengths are there, that is appliances and TV. And we want to optimize our resources and investments.
A competitor that you are constantly keeping an eye out on?
Our last year performance.
That's a good one. Final question, 30,000 sales and 3,000 crore PAT by FY27, possible?
I believe, yes, we would be reaching that number.
Mid-teens margins possible over the next couple of years?
See, yes, it is possible. We have to do some re-value engineering into our business, as we are doing continuously, increasing our localization rate and operational
We are confident.
excellence.
Yeah, and another 10% supply coming from the promoter over the next 3 years. That is obviously imperative.
We have to follow the
because-
SEBI guidelines.
All right.
Okay.
Thank you.
All
Thank you
right,
so much.
thank you so
Thank
much.
you.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. SEBI has approved Lenskart's DRHP for its upcoming IPO. As per the offer document, the IPO will consist of a fresh issue of equity shares worth 2,150 crore rupees, along with an offer for sale of up to 13.2 crore shares by existing investors and promoters.
IPO-bound Boat posted a net profit of over 60 crore rupees in FY25, a significant turnaround from last year's loss, driven by product innovation and cost control. Despite a slight revenue dip, the company achieved 142 crore rupees EBITDA and received SEBI's nod for its IPO.
JSW One Platforms, a B2B e-commerce marketplace, has raised 575 crore rupees from SBI, JSW Steel and others. The fresh capital will drive JSW One's next phase of growth through accelerated investments in its proprietary technology platform, expansion of operations and strengthening of its NBFC arm.
EcoX has secured $4 million in a strategic funding round led by Dovetail Global Fund PCC, Nav Bharat Investment Fund and Narnolia Velux Fund ahead of IPO preparation. The fresh capital will fuel technology enhancement, talent acquisition, expansion and strengthening clean technology solutions.
Morphing Machines, a fabless semiconductor or IP company, has raised 38.36 crore rupees in a Series A funding round from IAN, Alpha Fund, Speciale Invest, Ivy Cap Ventures and others. The fresh funding will accelerate deployment of Redefine into consumer cloud data centers, hyperscalers and other such use cases. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Agentic voice AI solution for banking and financial services, Grey Labs AI, has raised 85 crore rupees in a Series A funding led by Elevation Capital with participation from existing investor Z47 and leading angels. Now, this funding coincides with the launch of its flagship voice AI agent platform, reimagining customer conversations in BFSI, from sales and service to collections and renewals, with multilingual human-like voice agents that combine compliance with empathy. In just 18 months, Grey Labs AI has signed up over 50 institutions and now wants to scale to 300 clients. Joining me now is Aman Goel, the co-founder and CEO of Grey Labs AI. Aman, welcome to Startup Street. You've just launched your flagship voice AI agent platform. Aman, tell us what sets it apart from legacy call center automation or analytics tools, and what is the moat Grey Labs is building?
Sure, Shruti. First of all, thank you so much for inviting me. Really a pleasure to be here. So historically, the solutions that have been offered in the market are very basic. So if you call a bank today in the call center, there is a basic IVR flow which can, route the call to the correct agent, or it can send you your account balance over SMS.
Sure.
But for most of the times, you have to explain your query to several agents, several telecallers, because one agent is not able to completely resolve your issue. So what we are building is a full stack contact center which is powered by AI. So the AI will not just send you basic details like your account balance, etc. It can completely convince you to purchase a product from the bank side. It can collect EMIs. It can resolve your query. It can raise a ticket. So the fact that we are building a complete suite as a solution rather than just a basic technology is what differentiates us from the other solutions in the market.
Okay, you've raised 85 crore rupees in Series A. How do you plan to deploy the capital, and why do you believe, Aman, BFSI is the perfect use case for voice AI in India?
So we plan to deploy the capital majorly in the research and development part of the product. So, the problem we are solving is very complicated because of the sheer size and scale and the diversity of our country. There are so many languages, there are so many accents, dialects, right? So we are building, if we have to solve this problem at a large scale, we have to make sure that we cover every part of the value chain.
Sure.
So that requires deep research, that requires deep development. So that's why that's a major part of where our investment will go.
Okay. Human-like empathy, multilingual fluency, compliance, that's a tall order. How have you engineered this balance of efficiency and trust?
Yes. So that's one of the questions we get asked often from our customers also. See, so most of the companies are building very horizontal solutions, which means they have to book an alarm. They have to, request an alarm. They have to book a flight ticket. They have to book a cab, order food. Everything has to be integrated in one solution. So rather than going very horizontal, we are going very deeply into one vertical, which is financial services. So I'll give you a simple example. Civil, CIVIL versus CIBIL score, right? The difference happens in a financial services domain and not any other domain, as an example. So our software, because of the constraint in one domain, we are able to offer much higher accuracy and much better solution, which offers, as the parameters you mentioned, empathy, efficiency, accuracy, etc. And we need to make sure that the entire solution is resident within Indian boundaries. This is as per, SEBI, IRDA, the regulatory guidelines. So that's why the whole thing has been engineered from the ground up.
Okay, Aman, in just 18 months, you've onboarded 50 plus BFSI clients from RBL Bank and AU Bank to SBI Life and ICICI Prudential. What's driving this rapid adoption?
I think the biggest thing that is driving the adoption is the impact we are creating, right? In many of the companies, we have been able to show the conversion rates of telesales calls, which are much higher than the human telecallers. And that impact is what is driving word of mouth, where executives from one of the company, we are able to give the reference to other companies, other customers who are looking out for such solutions in the market. Plus, we are, we are not building a mass market product, as in we don't want to target 10,000 customers. We want to target the top 500 companies of the country. So with that focus on the market, we try to offer highly personalized service, which means that the CEO himself is available at all times, right? So that customer experience which we are offering to our enterprise clients, the kind of experience that nobody is able to offer, that also is driving the adoption of our product.
All right, Aman, BFSI is a highly regulated sector. How do you convince conservative institutions to trust AI with consumer, customer-facing conversations? And also, if you could tell us what's the revenue model for Grey Labs AI with hundreds of millions of conversations already being processed? How fast is the business growing? And are you closing on profitability?
Yes, so I think you asked the most important question, because these are customer conversations. These are important. They contain some sensitive information, sensitive data. So see, as a very important principle, we do not store any data of any of the end consumer on our servers. The data belongs to the regulated entity, which means the bank. They continue to own their customer data, the call recordings, etc. Plus, we have taken care of ensuring that we comply with all the regulatory guidelines, the data security guidelines, which means we are SOC 2 compliant, we are ISO compliant, we have third-party data security audit done of our softwares, we are DPDP compliant. Right? This gives a lot more comfort to the Chief Information Security Officer of the financial institution who is looking to buy our product. We are, all as I said, even for processing of these call recordings or interactions, the data and everything remains within Indian boundaries. It does not go outside. So by the DNA of the team, the product, the platform, the technology, everything has been tailored and designed for financial institutions. So that's the first part of your question. The second part of your question was around the pricing model. So we charge on a per minute basis, which means, you do 100 minutes of calling through our platform, 100 minutes into the unit rate. That's just an example. In terms of profitability, so typically, see, I come from a Marwadi family. I'm, business by nature. I've been a second-time founder. So I strongly believe that businesses are meant to generate profit by creating value for the customers. So default state, yes, the business is not burning money. But because we are investing in opening an office in Delhi. We are opening an office in Bangalore. We are hiring people in teams which don't directly generate revenue. As an example, we hired a finance controller. We hired someone in the people function, the HR function.
Sure, man. Yeah, so sorry, we've completely run out of time, and we wish you the very best with all your growth plans and your target of reaching 300 clients. Many thanks for joining us on Startup Street today.
Thank you so much for having me here.
Moving on the hot seat, Pune-based health tech startup FlexifyMe is taking a big step forward in its mission to make physiotherapy smarter and more accessible. Now, the company has raised 20 crore rupees in a pre-series A round led by Midcap Ventures, with participation from Signal Ventures and existing investors. The fresh capital will be used to expand hybrid care centers, launch AI-powered posture and gait labs, and strengthen clinical research partnerships. FlexifyMe's platform combines AI with expert physiotherapy to identify the root cause of chronic pain, helping users avoid unnecessary surgeries and improve mobility. Joining me now to discuss this further is Manjeet Singh, the co-founder of FlexifyMe. Manjeet, thank you so much for taking time out and being here with us on Startup Street. Before we get into the fundraise, if you could in 30 seconds just tell us about FlexifyMe, what it offers and the gap that you're trying to address.
Yeah, first of all, thanks Arundhati for having us. So FlexifyMe, we're a chronic pain management platform, and the focus for us is to increase the quality of life, because what has happened is, the quantity of life has improved in the last 50 years, but the quality has gone down. So people are living more in pain, but for a longer period of time. So our focus is to help people live completely without pain.
Last month you raised about 20 crore rupees led by Midcap Ventures. How exactly will this funding sort of help accelerate your hybrid expansion plans and also your new AI-driven posture labs?
Sure. See, one of the biggest problem in this specific space of the chronic pain management is that there is no standardized diagnosis that happens. So once you go to one physiotherapist or second physiotherapist, so they do the complete treatment as per their own understanding. So what we have done is, with the help of our AI-powered posture analysis, so we standardize the diagnosis, we understand the root cause of the pain, and that helps in solving the problem. And our approach is going omni-channel, because That is what works in India. So currently we have 7,000 online patients. So we currently have 4 offline centers in Pune, and in the next 15 months, so we are targeting about 20 centers across Pune, Mumbai, and Bangalore. So that will, help us in doing an omni-channel play in the chronic pain segment.
Right, so an omni-channel play there. Can you sort of give us, a sense of your current revenue run rate or, your user growth and what scale you are targeting over the next 12 to 18 months with this fundraise?
Sure. So currently we have roughly around 7,000 patients that we are working with. So we are roughly doing about 1 crore monthly. So in the next 15 months, the target is once we have about 20 centers, so we'll reach to about 3.5 to 4 crores monthly revenue.
Sure. And what sets FlexifiMe's AI-powered physiotherapy apart from, traditional clinics or other digital health startups offering pain management solutions?
So the biggest differentiator that we have is, again, the patented technology that we have developed to understand the root cause. So we do a static posture analysis because right now the biggest reason for the pain is the posture. We are doing a sedentary life in which we're sitting in front of the laptop for 9, 10 or more hours. That is basically completely destroying our posture. So the first thing that we do is identify the static posture analysis and muscle mobility, joint strength. So it's a complex analysis that we do that helps us understanding why that pain is there. And then we start working on the root cause of the pain so that it's not a temporary relief, but a complete relief from the pain in the long term.
So you're looking at complete relief of pain in the long term. You've also mentioned sort of expanding globally, right? So which markets are at the top of mind for you right now, and how will you sort of localize your model to suit different healthcare ecosystems?
Sure. So currently also by word of mouth, so we have almost 20% of our clients are from outside India, majorly 3 large markets. So one is US, second is UAE, and third is UK. So these are the 3 large outside India market that we focus upon. And currently the idea is our technology, we are taking it under FDA approval. So once we get FDA approval, so that is the plan. The first country that we start targeting is US and UAE are the 2 main markets that we'll focus upon.
US and UAE, and what's the revenue mix that you're hoping to see going forward?
So in terms of currently the revenue that we have is about 30% coming from outside India, but in next 15 months, so we are looking at roughly 40-45% of our revenues coming from outside India.
Sure. And, you're already working with enterprises and insurers, right? So how important are these partnerships to your growth, and what's the roadmap for scaling your B2B offerings?
So it's again plays a very important role because now healthcare is moving more towards the insurance driven, the market. So that's where we basically are working with insurance players. And the biggest challenge with insurance players right now is there is an increasing cost of surgeries. And, there was a study which was done that 70% of the surgeries which are done in India are not really required. And mostly people are getting pushed into surgeries. So that's where we come handy. We help insurance companies as well as individuals to recover without any surgery. And that's a win-win both for the insurance players as well as for the end users.
All right, Manjeet, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this journey going forward.
Sure. Thank you so much for having us. Thank you.
Well, with that, it's time for us to head into a short break. But coming up, Bengaluru-based enterprise tech firm Beyond Square Solutions has raised $4 million in a Series A funding. How does it plan to use the funds? We find out on the other side.
Welcome back. You're still with us on Startup Street. Bengaluru-based enterprise tech firm Beyond Square Solutions has raised $4 million in a Series A funding round from Avant Global Corporation to accelerate the global expansion of its flagship product, Finalizer. The round will be executed in stages through new share issuances, convertible warrants and subscriptions from existing investors.
And Arundhati, that's not all. Finalizer, developed entirely in India, is a financial consolidation and reporting platform that automates close compliance and reporting for CFOs, offering real-time insights across multiple entities and geographies.
Absolutely. And joining us now to discuss this further is Venkatachalam PK, the co-founder and CEO of Beyond Square Solutions. Venkatachalam, thank you so much for joining us on the show today, and congratulations on the $4 million that you've raised. If you could start off by telling us how this capital infusion will specifically accelerate Beyond Square's global growth and product roadmap for Finalizer.
Thank you very much for having me in this program. Avant Global is a firm that's based in Japan. I think they're a global leader in financial reporting. And this is a great impetus for us because it's going to fuel both product innovation and also it's going to fuel product geography expansion. We're looking at product innovation primarily driven by AI. And we're looking at growth and expansion across Southeast Asia, Middle East, and Europe.
Sure. This is Shruti quickly stepping in. Give us a sense of your offerings. You know, Finalizer operates in a competitive financial consolidation space. What sets it apart from global players like Oracle, Hyperion, or SAP BPC?
Well, it's a wonderful question. I think Finalizer is probably the only unified platform that automates the internal and external reporting requirements for the CFO office. So if you're looking at this reporting gamut of requirements, we're looking at close management, we're looking at financial reporting, we're looking at financial consolidation, and then disclosure management. So Finalizer is the unified platform that connects all of this, kind of driving unparalleled value to our finance teams.
Sure, and you're already serving over 100 enterprises across 45 countries, right? So what's your current revenue run rate and which regions are driving the most traction right now for you?
Yeah, so about 25% of the BSE 100 companies are our clients. We have about 120 clients today. I think it's spread across 25 industry verticals. We have about 3,000 entities using Finalizer. About 30% of them are outside of India. We expect to grow by about 10 times over the next 3 years.
Okay. Like you mentioned earlier, you're targeting markets like the Middle East, Europe, and Southeast Asia. What's your go-to-market strategy for these regions? Will you look at local partnerships or acquisitions?
We're looking at, we have a very strong partnership with the Big Four Consulting and some of the leading consulting firms. We do have PwC, Deloitte, BDO are some of our leading partners, the consulting space. We're looking at both establishing local niche partners as well as leveraging these global partners for growth. And some of the key drivers for growth would be the fact that Finalizer is probably, again, the only platform which is zero code, which is kind of completely configurable by the end business users. Given that the compliance and the regulatory requirements are constantly changing, for the business users to be empowered to actually configure the platform by themselves is a very key driver. And that's going to fuel a lot of our growth.
Sure, and you currently have a 40-member team, right? How will this fundraise sort of help you scale talent, especially in tech and customer success, to sort of support these international ambitions?
Absolutely. Given that it's a made in India product and it's made globally, and we want to take the likes of SAP and Oracle, and this investment from Avant is a testimony to that, and that's going to kind of seed some of the talent acquisition that we would like to have in the product space. Outside of the product, in terms of global expansion, again, I think the expertise that Avant would bring in terms of access to international markets, in terms of their strategic business expertise, will also help in this expansion, in this journey.
Okay. You've mentioned plans to deepen automation and compliance intelligence. Can you share how these upgrades will enhance Finalizer's value proposition for CFOs?
Great question. I think the larger ambition or the vision for Finalizer is to kind of make financial reporting autonomous, very much like your self-driven cars, where it can be real-time, where it can be autonomous, where it can be insight-driven. Today, the finance users spend a huge amount of midnight hours in generating these financial reports. And if you have to achieve this, I think it's a fairly complex space. And for us to look at zero touch, end-to-end automation of this data, all the way starting from their underlying operational systems and then driving it all the way to their financial reports, I think is a fairly complex journey, which requires a very robust and a very deep tech platform. And that is what we've invested in the first 7 years. And probably we are seeing some of those benefits come through. And that hopefully will kind of make this expansion happen.
Sure, and if you could quickly tell us in 20 seconds, looking ahead, do you see Beyond Square positioning Finalizer as a standalone SaaS leader or part of a larger enterprise ecosystem through, potential strategic partnerships?
I would say standalone SaaS leader. Of course, our partnership with Avant will deeply help in driving product innovation and expansion, but we are looking at establishing Finalizer as a standalone SaaS leader.
All right, with that, we'll have to wrap up our conversation. Venkatachalam, many thanks for joining us on Startup Street today. Wish you the very best with all your growth plans.
Thank you very much for having us. Thank you.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
India is a very unique consumer market, and the insurance case makes it very, very interesting. Why? On one hand, the insurance density, penetration as well as coverage in India is considerably low. But the same leaves a great deal of interest around how insurance industry scripts the catch-up towards the goal of insurance for all by 2047. Now, to understand any market, the most crucial aspect is to understand the consumer. For insurance space, it's the policy holder. Policy Bazaar, through its second edition of the flagship survey, How India Buys Insurance, attempts to do exactly that. Now, to speak about this particular survey and break down the nuts and the bolts of it, we are joined by, first of all, Anand Roy, the MD and CEO at Star Health Insurance. After that, Venkatachalam Iyer, Managing Director and CEO at Tata AIA Life Insurance, as well as Saravir Singh, the Joint Group CEO at PB Fintech. Saravir, I want to understand something from you. According to you, even today, do you think claims, settlement or denial of claims is still the single largest factor that, prompts a policy holder to go ahead and buy an insurance policy or not? What are the findings of your survey, of your report that threw up in terms of what is the single largest factor which sort of, tell a policy holder that he needs a policy and goes ahead and buys it?
Sure. So, yes, we surveyed over 3,500 consumers across 30 plus cities in India, across income classification, town strata, etc. And one of the things that we have consistently found, this is the second edition, is that there is still concern or skepticism about the real moment of truth, which is a claim. So, insurance is a very simple product. You pay a premium and you pay that in the hope that if there is some problem or if something happens, you will get your claim. And what we find is that now the discussion has got a bit more nuanced. It's not just about whether my claim is settled or not. It's also how my claim is settled. Was the process cashless? Was the process smooth? Did I get 100% of my claim or not? And people are also concerned about the time it takes. For instance, in health insurance, there is concern around discharge, like how long will it take to leave the hospital. Now, that is the story on the health insurance front. In term insurance, interestingly, what we find is that more people hear about successful claim stories. See, the claims are very less frequent in term insurance, as one would expect. So those stories are not that well known. But when somebody hears that somebody has actually got 1 crore rupees or 2 crore rupees from an insurance company, right, that is a very powerful motivator. So in our report, we find that last year, 15% of people bought term insurance based on having heard a claim story. This year, that number has gone up to 30%. So I think, for us in the industry, I think it's very clear. We need more claim stories. We need to convince or show customers that yes, they actually gain by buying insurance.
Venki, I want to come to you. As Sarabveer was also pointing out, if indeed the story around successful and transparent claims is so strong right now and it's improving every year, do you think it can actually work in the favor of insurance sales and coverage as well, where policyholders do get encouraged in the best way that they could through actually these successful claim stories?
Firstly, let me compliment Policy Bazaar on this news survey. Not just on the survey, but I think the demonstration of great purpose in bringing protection to almost every part of India today. And we've been very closely partnering with Policy Bazaar for several years now. Now, to your question, you're absolutely right. I think each time we have a story about successful claim settlement, we've seen consumers really feeling great about it. And I'm not really surprised at this 15% going to 30% plus. What we have realized is there is more. We need to really capture this a lot more. Today, there is a Policy Bazaar at the forefront. As an industry also, we should make awareness about this even more pronounced. What we have seen is the choice of an insurance company based on its efficiency in terms of claim settlement comes after the decision on buying the product. Okay, the choke point lies in coming to the decision of buying the product first. So, that's part of the report also as to why there is so much more to be done when it comes to creating awareness about protection and term insurance. Once that happens, you go to Policy Bazaar screen today, you have the claim settlement ratios also very clearly listed out for choice. From a claim settlement standpoint, let me also assure our listeners, our viewers today, that most insurance companies today have a claim settlement ratio north of 95-96%. So most claims are definitely settled in term insurance. These are also very clearly regulated by IRDAI in terms of turnaround times and so on. So unless there's a disclosure issue, unless there is some kind of a fraud issue, really, most claims get settled.
Having a health insurance, of course, is one thing, but the bigger thing here is to have a health insurance which is enough for you and your family. Now, I want to come to Anand for this question, and these are 3 questions, but all related to each other. As you come across multiple cases, Anand, of individuals, is the trend encouraging in terms of are people getting enough insurance for themselves and their family? If not, do they acknowledge the fact that there is some bit of vacuum? Do they know that there is vacuum? And is there an effort in life to sort of cover that gap that they see in terms of enough insurance and insurance?
See, first, let's understand that health insurance, speaking from the perspective of health insurance, it is absolutely a necessity. And I think it is incumbent upon all of us here to promote the cause of health insurance, because after roti, kapda and makan, I think health insurance has become something which is absolutely a necessity. And it's for all segments of the society. I think when people are trying to buy health insurance, they have to evaluate maybe 3 items which they should consider. Which city are they living in? And we are very happy to tell that we are seeing people now buying higher limits of health insurance itself in the bigger cities, especially where earlier 5 lakhs or 10 lakhs was a norm. We are seeing now coverages going up to 50 lakhs and 1 crore even. And, the cost of treatments in the larger cities are obviously higher. And so people are recognizing that and buying those kind of products. But most importantly, as you mentioned, the penetration of insurance in India is still very low. And people who have health insurance also need to evaluate what is their coverage. And almost all companies today offer various add-on products where they can bring their coverage up to the current market standards, whether it is in consumables or in robotic surgeries and so on and so forth. So not only while buying a new product, the consumer should evaluate which is the best of benefit for them, but also existing consumers of health insurance should continuously evaluate their coverage according to their lifestyle and their current stage in life, and move the coverage higher and higher, which insurance companies do allow as well.
Saravir, I want to come to you, and this is on an age-old problem that you're speaking about, that is awareness. Do you think even today that remains to be a single largest deterrent which comes in the way of people taking the step towards buying a health insurance policy, towards buying a term insurance policy?
So I think, yes, there are, I would say the glass is half full, as in most things in life. So on one hand, in health insurance, we find that awareness now is quite high. So over 80% of people say that they are aware about health insurance. Now that's the good news. The not so good news is that only 20% people actually buy. So the gap between awareness and action is still very, very high in the case of health insurance. In the case of term insurance, unfortunately, even the awareness is very low. Less than half the people actually understand what term insurance means. And then of those 45-50% people who are aware, only 10% people are buying. So I think in term insurance, our job is very well cut out, that we need to promote awareness also about the product, about the fact that you can pay X and you can get up to 500 times the premium that you are paying. I think the one thing that the industry needs to move, see, we focus a lot on products. We talk a lot about features, this thing, that thing. But consumers don't think like that. Consumers, as a consumer, I like to think in terms of stories. If you explain to me what happens, who has benefited from this thing versus, someone who has not benefited, those are the stories that I think we as an industry must tell more often. That what are the benefits of having the insurance, who benefited, so that I can also identify with that person. I think the second thing, which again the industry has been on this path, but we need to do more of, is simplification. I think products should not be made more complex. I think products need to be made more simple, and they should be very straightforward, that you will pay this, these are the conditions, and you will get this. And I think the third thing which we all always have to do is to make the process of claims, etc., again simple, and in my opinion, sometimes we can make it just transparent. Many times if you can explain to people what happened and why it happened, I think that helps a lot, and it just builds trust. See, insurance is a business of trust. We need to build trust in the product, in the process, and the more we can do about that through stories, I think the better off we'll be.
Anand, I want to come to you with a very interesting finding from Policy Bazaar survey also, in terms of how India buys insurance 2.0. I was reading it in the report that just about 28% of the respondents ranked health insurance above equities, mutual funds and government bonds. What would you say, how dire is the situation when you read something like this, and how can it be changed in terms of awareness and people understanding what health insurance policy does and how important it can get?
Yes, I think as Saravir mentioned, the awareness factor has been quite high as far as health insurance is concerned, especially after COVID. People do understand the need for health insurance, and the unfortunate situation is that typical, tendency is that nothing is going to happen to me. Things may happen to my neighbor or my friend, but nothing's going to happen to me. And then the reason why you buy insurance is to save yourself from some kind of unfortunate incident in the future. And health insurance has to be purchased when people are otherwise healthy and not when an incident happens. So I think, that kind of mentality does exist, but over time, and I think over, communication by all insurance companies, all stakeholders, I think this is changing. And I would say that we are seeing that health insurance has already become the largest segment in the general insurance industry. It is also the fastest growing. Partners like Policy Bazaar have also contributed significantly to make this happen.
Coming to you, Venki, and a large space, term life insurance, to be honest, very, very, not so well understood even today by policyholders. And I think that's the reason why we still point out many problems here. What are the big problems here when it comes to term life insurance? A completely different ballgame. And how is the industry thinking about addressing those problems?
Yeah, I think the point about awareness has been very clearly put forth. One other thing on awareness I see is, in our industry, there's a large value of claim that is still unpaid. People who have policies maybe have not spoken to the nominees honestly about the policies. So these claims are also, lying without getting paid. The other thing is we all over time, during the early years of life, invest for anything that has a benefit for the person also. We think about family, legacy, etc. usually later on in life. And term life is all about leaving something for your family. I think data on health records or income documentation to make the process more seamless would be according to me some choke points. So I think we have a long way to go, and the effort is well and truly on.
Saravi, to end the first part of the discussion on the survey, on the report which Policy Bazaar has released, according to you, single largest problem in terms of findings of the survey that comes in the way of adoption of health insurance and life insurance? And let's end this discussion on a positive note. What is the single largest encouraging thing that the survey throws up in terms of, which gives you a lot of optimism for the next 10 years in terms of insurance in India and for the goal of insurance for all by 2047?
Yeah, so I think, Yash, the first part is that there is awareness in health insurance. We need action, right? So the awareness to action gap is high. We need to do that in health. In term insurance, we need to improve both. The single biggest reason I feel the barrier, if you think about it from the survey, is that people underestimate the cost of not having insurance. So I think that lack of awareness is the single biggest, awareness of your financial outcome is the single biggest challenge. The positive side, like you said, is the fact that people who have got claims, as those stories spread, people are able to appreciate the value of insurance. What we have seen is once you've got a claim, you really value the insurance. And I think as we go forward, that gives me a lot of hope. The industry is very focused on paying claims. And as those, people, positive examples spread through and we can tell more stories, then I think we will be in good shape.
Well, I guess that's the perfect, conclusion when it comes to the first segment of this discussion on the Policy Bazaar Insurance Show. On the other side of this very short break, we discuss something which bothered me about, what happened to a policyholder very recently I came across, and, what are the do's and don'ts in terms of ensuring that this unfortunate incident does not happen to you. We discuss all of that on the other side of this very short break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to the Policy Bazaar Insurance Show. Now, as promised in the first segment, we discuss this very unfortunate incident. Just last month, I came across an insurance accident. A 67-year-old lady was missold 61 life insurance policies. This was sold through 6 life insurance companies within a period of 5 years. Now, this had some ULIP policies, some long-term policies, all of which practically had nothing to do with what the individual required. This was all done by the lady's relationship manager, who first gained her trust and then, despite the insured's denial to have any insurance policy with any kind of lock-in, sold her exactly that. The relationship manager went to the extent of forging signatures to sell more insurance policies, and when the cover was finally blown, she had already left her financial planning firm and fled the country. Now, fortunately, all life insurance companies, acknowledging this as a case of mis-selling, returned the premium which was paid by this individual. But there's a lot to learn and understand here for policyholders who let their financial planner take decisions for their investments. Not saying that there's anything wrong to have a financial planner through whom you plan your finances, but all I'm saying is that it is very important for you to acknowledge your role, understand what should you cross-check, what should you understand, and what should you let the financial planner decide. Venki, as I said, I mean, when you hear such stories, it does create a lot of deficit in your mind. Though here it wasn't the insurance companies, but at the end of it, a part of the ecosystem which sort of left you in distress. According to you, in a situation like this where you have a financial planner, you yourself are not being able to plan your investments, your insurance, your personal finance needs, what should an individual be careful of not, taking those things lightly when somebody is taking the decision on your behalf?
Let me, yes, firstly acknowledge insurance products are slightly complex, right? And the responsibility lies with A, the insurance companies, of course, and B, the advisors as well. In some distribution, in some parts of our distribution, we are very clear to not be selling investment-linked policies to people who are age 60 years and above. And for such senior citizens, the onboarding process becomes one where on a video we have the policy features being validated, spoken about, recertified, okay, reconfirmed before being issued as a case. It's important. So, and then comes the responsibility on part of the customer as well. Now, insurance policies come with a 30-day free look period during when the terms and conditions of the policy can be re-looked at, and then the decision can be made against continuing with the policy or not. But I think it's not, while it, like you rightly said, it's good to be trusting your financial advisors, but it's always, each time you sign a check, look at the fine print, see what the documentation is saying. On our part, I think the need to simplify all of this is definitely there. One idea that we at Tata AI are going to be doing is like in airlines, where you have a list of items that are not supposed to be carried. We are talking about features that the policy is not going to be covering, more importantly, than the long list that it covers, because people do not go through that long list.
Saravi, to you, like we say, do not share your OTP with any unknown individual, right? What is that one complete no that you should be careful of as policyholders when trusting someone with your decision to buy a policy or a financial product?
So, yes, I'll just make it 2-3 points. I think the first thing, as Venki also explained, is that whoever may be suggesting the policy to you, do your own research. It is not very hard in today's day and age. There are platforms like Policy Bazaar. There are other platforms where you can go and just research. You don't need to, buy, but you need to research. Second thing I would say is that if something is too good to be true, then it's most probably false. Third thing I would say, buy from an advisor who is licensed. There are regulated intermediaries directly from insurance companies you can buy. So, I think both you should be the advisor should be trustworthy. Then good news is that the regulator has thought a lot about customer protection. So, when you get the policy, you can check the policy. Now, there is a CIS, which is a customer information sheet, where you can see the salient features of the policy. So, you can again check against what you understood versus what is written over there. And finally, there is a free look period. The free look period has now been extended to 30 days. So, within 30 days, you can cancel the policy, no questions asked, you can get your money back. If one thing I would just advise consumers, if something is too good to be true, don't believe it. All financial products have a risk return spectrum. Long-term products will take time before they deliver returns to you. So, just be wary of that, of buying something which sounds too good.
Anand, final question to you. What are certain red flags that individual companies should place within the system when something like this is happening? How do you reach out to the individual directly and at least inform them, get a consent from them and a reconfirmation whether they are giving consent to the financial advisor to take any particular decision which is termed as a red flag for the insurer? How should that practice evolve amongst insurance companies and within insurance companies?
Yeah, absolutely, Yash. I think, mis-selling and some amount of suppression is a constant issue in this industry, and I think that has to be solved through technology. Just like when one is visiting a doctor, one intends to disclose every health parameter which one has. Similarly, when buying a health insurance plan, it would be ideal if the consumer can disclose all kind of health related issues he or she or the family members have. And do not leave it to the distributor or the advisor to fill in the proposal forms. Please do fill up the proposal forms personally and sign them yourselves. And on the policyholders' protection, the regulator has done multiple things in the last couple of years, and I think that just goes to strengthen the ecosystem, where consumers should check once they receive the policies and the customer information sheet that whether everything has been properly understood And also in health insurance, there is this concept of pre-existing ailments. So if the pre-existing ailments disclosed by the consumer has been captured in the policy or not, these are some of the small checks that has to be done while buying this product, so that at the time of claim, there is a good experience and there is no to and fro. I think this is something which is very critical and is a very important thing for everyone to understand. Yeah.
It's been a good episode today. We've spoken about what is India thinking when it comes to insurance, in terms of buying, in terms of not buying, in terms of what should be done to get an individual to the doorstep of the insurance company and make him buy the right product. Also, we've spoken about what should you do if somebody is taking the decision on your behalf when it comes to your financial investments. What are the do's, what are the don'ts, and how to protect yourself in such situations. But with that, it's curtains down on this episode. We will return with another interesting topic, another interesting set of guests from the industry to break that down for you, our policyholders. Till then, stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Presented by Policy Bazaar. Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
India is a very unique consumer market, and the insurance case makes it very, very interesting. Why? On one hand, the insurance density, penetration as well as coverage in India is considerably low. But the same leaves a great deal of interest around how insurance industry scripts the catch-up towards the goal of insurance for all by 2047. Now, to understand any market, the most crucial aspect is to understand the consumer. For insurance space, it's the policy holder. Policy Bazaar, through its second edition of the flagship survey, How India Buys Insurance, attempts to do exactly that. Now, to speak about this particular survey and break down the nuts and the bolts of it, we are joined by, first of all, Anand Roy, the MD and CEO at Star Health Insurance. After that, Venkatachalam Iyer, Managing Director and CEO at Tata AIA Life Insurance, as well as Saravir Singh, the Joint Group CEO at PB Fintech. Saravir, I want to understand something from you. According to you, even today, do you think claims, settlement or denial of claims is still the single largest factor that, prompts a policyholder to go ahead and buy an insurance policy or not? What are the findings of your survey, of your report that threw up in terms of what is the single largest factor which sort of, tell a policyholder that he needs a policy and goes ahead and buys it?
Sure. So yes, we surveyed over 3,500 consumers across 30 plus cities in India, across income classification, town strata, etc. And one of the things that we have consistently found, this is the second edition, is that there is still concern or skepticism about the real moment of truth, which is a claim. So insurance is a very simple product. You pay a premium and you pay that in the hope that if there is some problem or if something happens, you will get your claim. And what we find is that now the discussion has got a bit more nuanced. It's not just about whether my claim is settled or not. It's also how my claim is settled. Was the process cashless? Was the process smooth? Did I get 100% of my claim or not? And people are also concerned about the time it takes. For instance, in health insurance, there is concern around discharge, like how long will it take to leave the hospital. Now, that is the story on the health insurance front. In term insurance, interestingly, what we find is that more people hear about successful claim stories. See, the claims are very less frequent in term insurance, as one would expect. So those stories are not that well known. But when somebody hears that somebody has actually got 1 crore rupees or 2 crore rupees from an insurance company, right, that is a very powerful motivator. So in our report, we find that last year, 15% of people bought term insurance based on having heard a claim story. This year, that number has gone up to 30%. So I think, for us in the industry, I think it's very clear. We need more claim stories. We need to convince or show customers that yes, they actually gain by buying insurance.
Okay. Venki, I want to come to you. As Saravir was also pointing out, if indeed the story around successful and transparent claims is so strong right now, and it's improving every year. Do you think it can actually work in the favor of insurance sales and coverage as well, where policyholders do get encouraged in the best way that they could through actually these successful claim stories?
Firstly, let me compliment Policy Bazaar on this news survey. Not just on the survey, but I think the demonstration of great purpose in bringing protection to almost every part of India today. And we've been very closely partnering with Policy Bazaar for several years now. Now, to your question, you're absolutely right. I think each time we have a story about successful claim settlement, we've seen consumers really feeling great about it. And I'm not really surprised at this 15% going to 30% plus. What we have realized is there is more. We need to really capture this a lot more. Today, there is a Policy Bazaar at the forefront. As an industry also, we should make awareness about this even more pronounced. What we have seen is the choice of an insurance company based on its efficiency in terms of claim settlement comes after the decision on buying the product. Okay, the choke point lies in coming to the decision of buying the product first. So, that's part of the report also as to why there is so much more to be done when it comes to creating awareness about protection and term insurance. Once that happens, you go to Policy Bazaar screen today, you have the claim settlement ratios also very clearly listed out for choice. From a claim settlement standpoint, let me also assure our listeners, our viewers today, that most insurance companies today have a claim settlement ratio north of 95-96%. So most claims are definitely settled in term insurance. These are also very clearly regulated by IRDAI in terms of turnaround times and so on. So unless there's a disclosure issue, unless there is some kind of a fraud issue, really, most claims get settled.
Having a health insurance, of course, is one thing, but the bigger thing here is to have a health insurance which is enough for you and your family. Now, I want to come to Anand for this question, and these are three questions but all related to each other. As you come across multiple cases, Anand, of individuals, is the trend encouraging in terms of are people getting enough insurance for themselves and their family? If not, do they acknowledge the fact that there is some bit of vacuum? Do they know that there is vacuum? And is there an effort in life to sort of cover that gap that they see in terms of enough insurance and insurance?
See, first, let's understand that health insurance, speaking from the perspective of health insurance, it is absolutely a necessity. And I think it is incumbent upon all of us here to promote the cause of health insurance, because after roti, kapda and makan, I think health insurance has become something which is absolutely a necessity, and it's for all segments of the society. I think when people are trying to buy health insurance, they have to evaluate maybe three items which they should consider. Which city are they living in? And we are very happy to tell that we are seeing people now buying higher limits of health insurance itself in the bigger cities, especially where earlier 5 lakhs or 10 lakhs was a norm. We are seeing now coverages going up to 50 lakhs and 1 crore even. And, the cost of treatments in the larger cities are obviously higher. And so people are recognizing that and buying those kind of products. But most importantly, as you mentioned, the penetration of insurance in India is still very low. And people who have health insurance also need to evaluate what is their coverage. And almost all companies today offer various add-on products where they can bring their coverage up to the current market standards, whether it is in consumables or in robotic surgeries and so on and so forth. So not only while buying a new product, the consumer should evaluate which is the best of benefit for them, but also existing consumers of health insurance should continuously evaluate their coverage according to their lifestyle and their current stage in life, and move the coverage higher and higher, which insurance companies do allow as well.
Saravir, I want to come to you, and this is on an age-old problem that you're speaking about, that is awareness. Do you think even today that remains to be a single largest deterrent which comes in the way of people taking the step towards buying a health insurance policy, towards buying a term insurance policy?
So I think, Yash, there are, I would say the glass is half full, as in most things in life. So on one hand, in health insurance, we find that awareness now is quite high. So over 80% of people say that they are aware about health insurance. Now, that's the good news. The not so good news is that only 20% people actually buy. So the gap between awareness and action is still very, very high in the case of health insurance. In the case of term insurance, unfortunately, even the awareness is very low. Less than half the people actually understand what term insurance means. And then of those 45-50%.
Madhya Pradesh after consuming a contaminated cough syrup. The affected children were initially being treated for common cold but subsequently developed acute kidney failure. In response, Madhya Pradesh police have arrested a government doctor for prescribing the cough syrup called Cold Riff. A special investigation team has also been formed to probe the syrup manufacturer based in Tamil Nadu. Authorities have also exhumed the body of a 2-year-old girl for post-mortem examination to determine whether the cough syrup was responsible for her kidney failure. When Network 18 inquired why the postmortems were not conducted earlier, the STM dodged the questions. We get you this special report from Madhya Pradesh's Chhindwara.
Initial report of the postmortem is now making it very clear that cause of death of 2-year-old girl from Parasia, she died because of kidney failure. But the most important question, what led to kidney failure, this is yet to be established, and that is possible only after final report of the postmortem and after getting the Visa report. So we are waiting for the final report of the postmortem, which will establish what finally led to this kidney failure, whether it was cough syrup. So this is yet to be established. The total number of casualty because of this cough syrup in Chhindwara district stands at 14, and more than 6 kids are still there in different hospitals in Nagpur. इसमें जब हम प्रिस्क्रिप्शन को देखते हैं तो इसमें फिर एक सरकारी अस्पताल का प्रिस्क्रिप्शन, वही कोल्ड ड्रिफ, और एक माँ के सामने अब सिर्फ एक चारा रह गया है कि वो बैठकर अपने बेटे की तस्वीर देखती रहे। किसको जिम्मेदार मानते हैं आप?
वो सायरब को ही मानीजिए। इतना पढ़े लिखे नहीं है कि डॉक्टर बन जाते, नहीं तो पढ़े लिखे रहते तो। अब वो डॉक्टर ने जो लिखा है वही समझिए उसको।
जो रिपोर्ट आई तो किडनी वाली मैडम ने से मैंने पूछा भी था, उन्होंने बताई थी कि इसकी रिपोर्ट में इंटरनल इंजरी हुई है इसकी किडनी में। तो मैंने कहा मैम ये इसको कब से प्रॉब्लम, तो उन्हें स्पष्ट बोलती थी कि इसकी जब से तबीयत खराब हुई है तब से उसको ये प्रॉब्लम हुई है।
वजह उसकी सिरप ही रही।
अब उन्हें ऐसा स्पष्ट मैडम ने ये नहीं बताई कि आपने जो दवाई पिलाए उससे हुई।
So the most important question, why this postmortem report is coming so late? In fact, our network, we have been raising this question even after 14 deaths of kids in Chhindwara district during the past 1 month. Why no postmortem has been conducted by the administration, by the district administration? कि जो postmortem क्यों नहीं कराएगा?
क्योंकि उसमें पेरेंट की कंसेंट लगती है।
मैं पेरेंट्स से मिला हूँ, पेरेंट्स कह रहे हैं कि वो उनको प्रशासन ने पूछा भी नहीं।
कहाँ पे दिखाया?
मैं यहाँ पे नहीं, नागपुर में नहीं। मौत होने के बाद जो जिला प्रशासन है उसने पूछा भी नहीं।
मौत कहाँ पर हुई थी?
मौत नागपुर में हुई, लेकिन आपको जो सस्पिशन जो लगातार एक के बाद एक मौतें हो रही थी और एक जिम्मेदार एसडीएम होने के नाते आप पूरे मामले को आप देख रहे थे, तो आपके मन में आया, प्रशासन के मन में आया कि इनका पोस्टमार्टम करा लिया जाए।
You are trying to put words into my mouth which I will not utter.
देखिए पहले आप कह रहे थे कि आपने, देखिए पहले आपने ये कहा कि आप इसलिए नहीं कराए क्योंकि कंसेंट नहीं मिली। जब मैंने कहा कि मैं एक ऐसा केस है हमारे पास जिसमें कंसेंट देने को वो तैयार थे, इसका क्या जवाब?
पोस्टमार्टम में क्या निकल के आता है? What is postmortem? आप बताइए ना।
आप बताइए, मैं मुझे कुछ नहीं आता, आप बताइए।
आप इस तरह से, मतलब एक तो मैं काम करने के लिए जा रहा हूँ, आप मुझे जबरदस्ती घेर रहे हैं, ये कोई तरीका होता है? आप मेरी बीच गाड़ी में खड़े हुए हैं।
नहीं, बीच गाड़ी में बिल्कुल नहीं खड़ा हूँ मैं आपसे।
क्लियर करिए, मुझे फील्ड पर जाना है, समझे?
तो बस पोस्टमार्टम के लिए हमको आपको ये बात जाननी, बस
क्या
कि पोस्टमार्टम क्यों नहीं कराए गए?
क्योंकि पोस्टमार्टम में किडनी का आता है, जो बायोप्सी कराई थी 3 किडनी की, उसमें किडनी का डैमेज आया ही हुआ है। पोस्टमार्टम में अलग से क्या निकल के आएगा? टॉक्सिन्स के लिए अलग से सैंपल भेजे ही हुए हैं।
देखिए 2 तरह के पोस्टमार्टम होते हैं।
साइड होइए प्लीज, है ना, मुझे लेट हो रहा है।
आप मतलब अच्छे से याद करके बताइए।
नहीं सर,
पोस्टमार्टम के लिए किसी ने पूछा ही नहीं।
नहीं,
क्योंकि अभी हमें प्रशासन के एक एसडीएम है, वो कह रहे थे कि परिवार वालों ने मना कर दिया।
नहीं सर, अपने पास कोई नहीं आया सर।
नहीं पूछा।
Then finally one body of a girl, this girl, Yogita. It was exhumed and then it was sent for the postmortem, and we have got this report of the postmortem at this point of time. Why this postmortem was important? Because there are two types of postmortem. If it was not a police case earlier, then okay, it cannot be done because of no medical legal case is there. But the administration could have conducted the postmortem on the basis of pathological report. They are getting, repeated deaths, and if it is a cause of what is the cause of these repeated deaths? So to find out the cause of these repeated deaths, suspicious deaths, the administration could have taken the call itself, and they have in fact done this postmortem earlier. Had it been done earlier, obviously the casualty could not have gone to this extent of 14 kids die after 1, 2, 3, 4 deaths. If this postmortem was done, then casualty could have been less.
Right, eye-opening report from Madhya Pradesh. Moving on, 31 out of 36 districts of Maharashtra continue to grapple with torrential rains and floods. CNBC-TV18 Santya Gora travelled to the flood-affected areas and reported on the loss of lives and livelihood. Crops over 50 lakh hectares are damaged. Crops like cotton, soyabean, oranges, pomegranate, maize, bajra, pulses and onion have been damaged. Here's a ground report.
Rajendra Akolkar of Ahilyanagar, Maharashtra owns 4 hectares of land. He sowed soyabean, bajra, pulses and onions, hoping to earn at least 2 lakh rupees from soyabean alone. But nature had different plans.
वो सब खराब हो गए ले उसका खेत बाजार में जाने तक 50,000 रुपए हेक्टेयर खर्च वो भी नहीं निकलने का भी आता
तो खेत साफ करना, बीज लाना, ट्रांसपोर्ट करके मंडी तक ले जाना,
50,000
एक हेक्टेयर के पीछे 50,000
खर्चा आता है।
कितना पैसा बनने की उम्मीद थी?
2 लाख तक।
माने 2 लाख का तो आपका ओवरऑल नुकसान ही।
ओवरऑल नुकसान।
अच्छा, ये 1 हेक्टेयर में आपने सोयाबीन लगाया है और कौन-कौन सी फसल आपकी खराब हुई है राजेंद्र जी?
प्याज है, तूर दाल है, बाजरा है, ये सब खराब हो गए और खेत में से पानी जा रहा है नीचे।
तो मट्टी भी निकल गई खेत की?
मट्टी भी निकल गई। खेत जो खद डालता खाद वो सब खराब हो गए।
Soil erosion in farms, uprooted trees and damaged crops show how severely Maharashtra is impacted because of the floods. As per the state government, crops on over 50 lakh hectare across 31 districts in Maharashtra are damaged. Maharashtra government has claimed that it has already sanctioned compensation of over 2,000 crore rupees for over 31 lakh farmers. But the damage caused by these floods runs deeper than just crop damage. In many areas, the floods have washed away the fertile agriculture soil in farms, and the farms are now full of stones. Farmers of Ahilyanagar's Karanji village say it will take them 4 to 5 years to recover.
यहाँ पे 10 दिन बारिश चलने से कारण यहाँ पे खेती का बढ़िया नुकसान हुआ है। यहाँ पे मुख्य पीक है कि यहाँ पे खेती है कि संतरा, मौसम्बी, सोयाबीन, कांदा, यहाँ पे खेती का बाजरा, बहुत ही बढ़िया नुकसान यहाँ पे लगातार बारिश के कारण हो गए।
हमारा नुकसान इतना हो गया उसकी गिनती नहीं।
कुछ फिगर है आपके दिमाग में कितना?
फिगर हमको हमारी 5 साल लग गए थे डेवलप करते करते, अभी तो डेवलप करते जा रहे।
अभी जो हमारा नुकसान हुआ है, जो अभी मिट्टी लाने वाले उसका खर्चा भी नहीं निकलने वाला। सरकार जो दे रही मदद वो भी कम दे रही है। बनाने के लिए हमको कम से कम 4 या 5 साल लगेंगे।
The state government says that the situation continues to remain grim. Maharashtra government has sought center's assistance and have asked for funds under NDRF quota. But the farming community and the opposition demands that the state government declare this a wet drought year. The state government is yet to make any announcement regarding this, but continues to assure that compensation will be disbursed at the earliest. The state government has begun surveys to assess the damage and determine compensation to be paid. But the opposition alleges the government is failing to act decisively, and the government says the opposition is using the tragedy for political gains, especially given the upcoming local body elections. While the politicians fight it out, the farmers we spoke to say the compensation may be delayed or insufficient. They say that even if they receive the compensation today, it could take them 4 to 5 years to recover. In Ahilyanagar, with camera person Swapnil Bandekar, this is Santya for CNBC TV18.
Right, it's time for a short break. Coming up, the government approves Pulse's mission with 11,440 crore rupee outlay. Parikshit Luthra speaks with Devesh Chaturvedi, Agriculture Secretary, on the contours of this scheme. Stay tuned.
The Union government has launched the Atmanirbharta in Pulses mission. So what does this national mission on pulses really target? How will this help in increasing production of key pulses in the country? Joining us right now to explain this important scheme from the Union government is Mr. Devesh Chaturvedi, who is the Secretary, Agriculture and Farmers Welfare in the Government of India. Sir, thank you very much for joining us. Let me begin by asking you, how does this mission on pulses help in reducing our import dependency?
You see, pulses, India is one of the highest producer of pulses and also the highest consumer of pulses, because it is a very essential part of our diet across the country. So while we have tremendous achievement in past decade in terms of raising the pulse production from around 15-16 million tons in 14-15 to about 24-25 up to 25 million tons, but the rising income levels and the rising consumption patterns, changing consumption patterns have led to even more increase in the demand for pulses. So therefore now there is an import dependence of about 15 to 20%. And therefore, as part of the overall strategy of Atmanirbharta or self-sufficiency, we have launched this new mission, which is a renewed strategy for improving productivity, area expansion, and assured income to the farmers.
Right. So do you have a target in mind as to by what extent will this bring down our dependency or imports of key pulses in the next few years? So presently in 24-25, we were around 25.2 million tons as production, and about 6 to 7 million tons was imported. So what we plan is next 6 years we are targeting 35 million tons of production domestically, so that our import dependence comes to very minimal or no, zero. And for that, this about 10 million ton increase, it will be done partly by area expansion, but more significantly through productivity improvements. Right. Now, the total outlay of this scheme is around 11,400 crores. Give us a sense of how this is going to be used in increasing the yield. So, see, it has several components. So one of the key components is that the ICR and its chain of agriculture universities and other institutions will be doing cutting-edge research. They're already doing it, but they will be now expanded to cover hybrid seeds, cover high-yielding varieties of most of the pulses which are grown in this country, so that we achieve at least 30% improvement in productivity in next 6 years. In last decade, we achieved about 20% increase in productivity, but in next 6 years, we are planning to achieve 30% productivity. So once these seeds are the high-yielding varieties or the hybrid seeds, which are latest, which are climate resilient, which have high productivity, and also they are more resistant to pests and diseases, these seeds have to very quickly and efficiently go to the farmer's field. It is there that mission will now have the second role to play, that these breeder seeds will be converted into foundation and to certified through the state corporations and our own central seed producing agencies, so that they reach to the farmers, and we intend to cover 2 crore farmers with these high yielding varieties and improved seeds in next 6 years. And the second aspect will be that we have about 27.5 million hectares covered. This we'll be expanding to 31 million hectares through using the